Measures North West Limited undertook a contract for 5 lakhs. On 1st January 2022, the company furnishes the following detail for the year ended December 2022. Moral of the story, 1 year data they have given. Material consumed 165,000. What we will do? We'll take it in the debit side of the contract. Direct expense, debit. Wages, we'll take it in the debit. Material returned to stores, we will credit it. Material stolen from site, we'll credit it and we will charge it to costing P&L, basically abnormal loss. Insurance claim admitted, this will be adjusted in costing P&L. We have nothing to do. In costing P&L, what they will do? They will take only 4,000 as a loss. Here we have nothing to do. Work expenses, 20% of wages, 30,000 into 20%. 6,000. Office expenses, 10% of the works cost. So whatever the works cost will be there, of that how much? 20%. Sorry, 10%. Little bit. Material in hand, we are going to show it in the credit. Cash received to the extent of 90% of work certified, which is 2,70,000. Try to understand. They have given a hint here regarding work certified. What they are telling? Your work certified is there, no? Of that, 90% is cash received, which is working out to be 2,70,000. So work certified therefore is rupees 3 lakhs. Work certified is how much? 3 lakh. Anyone any doubt in this? No? Cost of work certified, they only have given 11,000. Plant sent to site costing rupees 60,000 with the scrap value of 10,000 and its useful life is 5 years. Try to understand. Depreciation information they have given. 60,000 is the cost of that. Correct? 10,000 is the scrap value. So this will be useful for 5 years, which means depreciation for a year will be 10,000. But worst part is, of the 10,000, only 146 days we are using in the 365 days. Rupees? Depreciation is 4,000. Hope it's clear. Hello? Any doubts? Fifth, right? What jatra these guys? To show the answer they won't give. Quickly tell me. You know this, no? You have paper, like questions in your hand. No. Take photo of this quickly and help me out when calculating faster. Don't sit like nicely had food. You have PDF. That's what I have asked. So you'll help me out. First what? 2 material. How much? 1 lakh. Okay. 2 labor. Next. Wages. Then what? 5,000 you told. 2 direct expense. How much? Next. Are you read the lines. The next line is what? Material returned. Buy material. How much? Next. By costing P&L. How much? That is not necessary. 2 works expense. How much? 6,000. So your total works cost will come to how much? 165 plus 30 plus 5 plus 6. Of that 10%. 20,600. Any other expenses there? 2 depreciation. How much we got? 4,000. Next term. That's it. How much is the total cost here? Debit side. 2 lakh. By cost of construction. How much? Did they ask cost of material issued to site? That will be, oh wait, give me a second. See here, here, important. Cost of material consumed is 165,000 guys. Cost of material consumed is 165,000. That means issued is not 165,000. Why sir? Try to understand. 165,000 we are able to consume only. To consume only we are using 135,000. Correct? How did you get 135,000 sir? Some X amount of material they had sent. In that 5,000 we have returned. 10,000 we lost. After that, left closing material is there. Material at site. After that 15,000 material we still held. After this we are able to get 165,000. That means X is how much? One lakh 95, yeah. Remember this 1,95,000. So it is 2,60,600, no? Office expense won't change because you have to take material consumed only, no, to arrive at works cost. Any doubt in this? Correct. Now, to cost of construction 2,45,600 by WIP. You know that consists of two things: value of work certified, cost of work uncertified. Value of work certified, how much sir? Value of work certified we computed somewhere 3 lakhs. Uncertified 11,000. Total 3,11,000. 3,11,000. So we'll get a notional profit. Sorry? 65,400. 65,400 will be our notional profit. But listen, how much is the work certified guys? 3 lakh. What was the value of the full contract? 5 lakh. Moral of the story, 60% of the work is done, not done. Correct? So more than half, which is 2/5 of the notional profit shall be, 2/3 of the notional profit shall be transferred to P&L. To P&L account. 65,400 into 2/3. However, you are not receiving 100% of the cash. They are retaining 10%, which means that profit we should not take. Only 90% profit we should take. 39. To WIP, provision for contingencies. 65,400. 65,400. 26. Hope it is clear. Hello. 3,11,000 was contract. Profit transferred is 48,000. How come 48,000? Just check cost of construction is correct or no. Total 195 plus 30 plus 5 plus 6 plus 20, 600 plus 4000. 2,66,600 minus 15,000, 2,45,600. Value of work certified 3 lakh only we got. Cost of work uncertified 11,000, 311,000. So 245,600 minus 311,000, 65,400. Okay. So 65,400 2 by third. Which paper it is? Question number 5. 65,400 on that. No worries. That also we got so much only, no? How much is 65,400 into 2 by 3? 40? No worries. Hope you guys understood this thing. Or give me a second. 48,000 90 100 question mark. $50 333 divided by 2 into 3 80,000. They are getting profit of 80,000. 3,11,000 minus 80,000. 2,31,000. So they are getting a cost as 2,31,000 now. How is that possible? Leave, no worries. To material. Then how much they are taking? No. 1,65,000 if you take, how much it will get? Contract 2,36,600. Balancing figure. Total. There I told, and by material at site. How much is material at site? That you should take, no, credit side. I'm telling that number I told here, I forgot. So I think it will become 2,30,600. So 2,30,600. So notional profit will be 80,000. 8,400. 8,400. So 8,400. How much? 48 to 40 you are getting. 32. Hope now it's clear. Yes, you understood what I. Basically, material at site we should take it in the credit side, no? Next, December 23, na? No MCQ? Okay. 4B. Prepare a contract account, show the amount to be credited to P&L. Okay, so basically they are trying to tell that there is notional profit, no loss and all. Mohit is a leading civil contractor. Give me a second. I think that day after getting that we might have worked out in note, right? Because I remember getting 48 to 40 or something like that only. That day also I think we did the same thing. We left material at site. So Mohit is a leading civil contractor who prepares his account on 31st March each year. He commenced the contract. The information is as follows. Material cost, labor cost, 4 months salary. Can I tell everything? Debit, 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 debit. A machine costing 260,000 remained in use for the size for the 2/5 of the site for the 2/5 of the year. Its working life is estimated to be 7 years with the scrap of 15,000. So 2,60,000 minus 15,000 divided by 7 years will give me depreciation for the year. Multiply with 2 by 5 will give me depreciation for this particular contract. How much? Depreciation cost is 14,000. I hope it is clear. A supervisor is paid 8,000 per month and has devoted 1/2 of his time on the contract. So 4,000 per month is relating to this particular contract. And thing is, see there, 1st July to 31st March they have given, which means 9 months, right? So how much is for 9 months? Don't take it for a whole year. 36,000. Supervisors, 36,000 relating to this particular contract. All other expenses amounted to 136,500. Material at site, closing, should be taken in the credit side. Don't forget. That's why we took 4,000, not 8,000. The contract price is 20 lakhs. On 31st March 2023, 2/3 of the contract was completed. Awesome. Work certified, how much they haven't given? They have told how much is completed. However, the architect gave certificate only for 50% of the contract. And 7,50,000 has been paid on that account. Oh, one more thing here is value of work certified will be 50% of the contract, which is 10 lakh. One thing is clear here. Boss, work completed is 66.67. But work certified is only 10 lakh. Moral of the story, there is a work uncertified. But cost of that they haven't given. In that scenario, what we should do, sir? We have done this kind of sum when we are in solving in class. Remember, you should do like this. Mark it as LMR, like this kind of question might come. First, quickly tell me, to material, how much? Hey. lakh? 3,85,000. Later, what is there? 4 lakh. Next, which one? 67. Next, how much? We computed now. 14,000. Depreciation 14,000. Next, 4,000 into 9, 36,000. Next, closing, 35. Any material returned or loss, etc., etc.? Anything else? That's it, right? Cost of construction. How much is the total of debit side? $10 lakh? 10 lakh? 10 lakh 49,000. Okay. So that will be your cost of construction, right? By WIP, listen here. Now very important, concentrate, everyone concentrate. Listen, 10 lakh 49,000 I have incurred. Agreed? Hello. 10 lakh 49,000 I incurred. Agreed? But this is to complete. How many percentage of contract I incurred? 66.67 percentage. I have incurred 10 lakh 49,000 to complete 2/3 of the contract. Then whole contract will cost me how much? 10 lakh 49,000 is for 2/3. For 1 how much? Sorry? 500. This will be my estimated total cost of contract. Anyone, any doubt in this? Hello. Estimated total cost of contract will become 15,73,500. No doubt in this. One more thing we know. Total contract of that 50% is certified. Can I tell 50% of this will be work certified? Cost of work certified, not value. How much? 7,86,000. Guys. Total cost incurred till date is 10,49,000. Of that 7,86,750 is cost of work certified. Remaining should be cost of work. How much it is? 2,62,000. Value of work certified. Cost of work uncertified. Value of work certified is very simple. Out of the contract, they are certifying 50% of it. Total contract price was 20 lakhs, right? 20 lakhs of that 50% is work certified. 10 lakh. Cost of work certified we have done here. 2,62,250. Anyone, any doubt in cost of work uncertified? No doubt? So total 12,62,000. 2 lakh? 2 notional profit. By notional profit 2,13,250. 2 P&L, 2 provision. Basically WIP provision. P&L how much, sir? Try to understand, guys. 2,13,250 and 50% of the contract is done. Moral of the story, 2/3 we are going to transfer. However, try to understand. Value of work certified is 10 lakh. Agreed? But cash received is only 7,50,000. So how many percentage is retained? 25% is retained. Correct? Because out of 10 lakh, 75% is given. 25% is retained. So how much into 75%? 1,06,000? 625. So remaining? Huh? 1,06,000? 625. Oh, same. 2/3 of that 75%. 66.67 into 75% is 50. Hope it's clear. No doubts. This 4B na. Oh, here they have given our. I think 3 attempts nicely they had given a same question if I'm not wrong. June 24. 4B. No MCQ? Same question. Take it as a homework. Next up. Same question, no? Actually, I'm feeling bad for those students who would have thought in June 24. Hey, in December 23, they asked this kind of question. So, this kind of question won't come in June 24. Same question. And let's say the same student went for December 24 also. 2 attempts continuously they had given. Are they mad or what to give the same kind of question for the 3rd attempt? Damn sure this time it won't come. Imagine. Depression only. If at all December 24 they go like this. So don't ignore any questions. Just because it has already come like that. In fact, in CMA if it has come, then you should do double hard work. There is a high possibility of coming again. June 25. Listen here. 4B. Prepare contract account for both the years. So 2 years data they have given and determine the profit. PQR Limited undertook a contract on 1st April 2023 for the construction of building at a contract price of 45 lakhs. During the first year, the following amounts were spent, against which the sum of 16,87,500 was received by the contractor. Moral of the story, they had given this information to compute the work certified. 16,87,500 is 90% of the work certified. So work certified will be how much? 16,87,500 divided by 0.9. 18 lakh 75,000 divided by 45 lakhs. So first year it is 41.67% work done. So you should transfer 1/3 to the profit. Of course, after adjusting that 90% cash retained. Material used, it will be debited in the first year. Correct? Wages debited, overhead debited. Using that, we'll find out cost of contract. We'll find out cost of contract. In the cost of contract, using that cost of contract, we are going to take value of work certified. Yes, they haven't told anything about cost of work uncertified. Assuming there is no cost of work uncertified, we are going to find out notional profit. Notional profit 1/3 after adjusting 10%, that is remaining 90% will be taken to P&L, remaining will be taken to WIP provision. Next year, same debit side will take WIP value of work certified as a opening balance. Credit side WIP provision opening balance. Or you can net it off and write also, no problem. Then we'll take this as debit, 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 In the second year, the contract was completed. Awesome. There won't be any WIP. Straight away it is contractee account. Okay. There won't be any notional profit. There will be profit. A sum of 26 lakh was received by the contractor. So in contractee account, 2 times it will come. First year, by bank, 16 lakh 87,500. Second year, to contract account, 45 lakhs. To contract account, 45 lakhs. By bank account, 26 lakh 25,000. Got it? So I will show it here only. Is that fine? First year you see material used, wages, overhead, WIP. WIP you know, right, how we got 18,75,000. Using that we got to know how much is our cost. First find out cost. 7,87,500 plus 4,50,000 plus 1,12,500. Cost of contract is 13,50,000. That we will take it in the debit side. Cost of contract is 18,50,000, whereas WIP only value of work certified is there, that is 18,75,000. So notional profit will come to 5,25,000. Of the 5,25,000, we know that only 1/3 will be transferred only to the extent of cash received. $1,57,500. So remaining we are going to transfer to provision for contingency. First year, hope it is clear. Second year, in the contract account, by bank, as I already told, and balance. Second year, opening balance after adjusting provision as well as value of work certified, all the expenses incurred during the period. We'll get to know how much is the cost of construction. That we are going to compare with the by contractee, not WIP. Not WIP, by contractee, because contract is done. So value of contract was 45 lakh. So whatever the balancing figure, that will shall be transferred to P&L. And in contract account, you can see first year closing balance, opening balance of second year. During the year we received this much contract charged. So balance, they only have to pay us. Hope it's clear. Simple, no? Compute? You can do. Last time we did, no? In the same contract account, year 1, year 2. In question, I think in study mat, year 3 were there. Year 1, year 2, year 3. 3 years were there. MTP. Set 1 now. No MCQ. No MCQ. 4B. Escalation. And remember, in escalation, guys, only to the extent of standard material to be used, labor to be used, only to that extent we will be ready to pay. For example, standard material to be used was 1 lakh kg. Actually used 1,50,000 kgs or 1,10,000 kgs. Now try to understand. Extra money, whatever I have to pay relating to escalation, I will be paying only relating to 1 lakh kgs. Why, sir? That extra 10,000 you use because you are this thing. Mistake it is. Your control wasn't there. Why I should pay for that extra 10,000? I will pay relating to standard quantity. I will pay relating to standard hours, not actual hours. Labor, you should have completed it in 2 lakh hours. You are completing it in 2,20,000 hours. Boss, relating to the 2 lakh hours, whatever extra I should pay, that I will pay. That 20,000 I won't pay. You didn't control your employees wasting time. Why I should pay for that? So always remember, escalation clause, extra whatever we pay only towards standard quantity and standard hours. Hope it's clear. Listen. Deluxe Limited undertook a contract for 5 lakhs on 1st July 2022. On 30th June 2023, 1 year data, don't take it as 9 months, 1 year data. When the account were closed, the following details about the contract were gathered. Material purchased, 1 lakh. Purchased, not consumed. Wages, general expense, plant purchased, material on hand at closing, wages accrued, of course it's expense, you have to book it. Work certified, cash received, depreciation on plant, work uncertified. The above contract contained an escalation clause which reads as follows. Clause means provision in the contract. In the event, guys, in the event of prices of materials and rate of wages is increased by more than 5%, the contract price would be increased accordingly by 25% of the rise in the cost of material and wages beyond 5% in each case. What is this, sir? Try to understand, decode this. How to decode this, sir? Very simple. Let's say planned material cost is 1 lakh. Planned material cost is 1 lakh. Escalation clause comes into picture only when material cost goes somewhere beyond 1,05,000. Up to 1,05,000, this provision won't come into picture at all. Okay. Now let's say material cost became 1,30,000, which is more than 1,05,000 now. Moral of the story, escalation clause activated. Escalation clause activated. That doesn't mean that they will be ready to pay full 30,000. That doesn't mean that they are going to pay full 30,000. Why, sir? Try to understand what provision says. Contract price would be increased accordingly by 25% of the rise. So they won't pay whole 30,000. They will pay only 25% of 30,000. If at all they had given only so much, but they have given one more thing. What is it? In the cost of material and wages beyond 5% in each case, which means 25% of 3 lakh also they won't pay. They will pay how much is beyond 5%. That is beyond 1,05,000 extra you are incurring. That is 25,000. Correct? They will be paying you 25% of 25,000. How much? 6,000. Anyone, any doubt in this computation here? Decoding of this escalation clause. Anyone, any doubt? You understood now? Now, it was found that since the date of signing the agreement, prices of material and wage rate increased by 25%. Boss, 25% is increased. That means more than 5%. Moral of the story, escalation clause is getting activated. The value of work certified does not take into the effect of escalation. So that escalation you have to calculate and add it to WIP. Prepare contract account. Working should form part of your answer. Very simple. Listen here. How much is the material consumed? 1 lakh minus 25,000. Agreed? 1 lakh minus 25,000. 75,000. Agreed? Listen here very carefully. Very carefully. 75,000 I am incurring because cost is 25% more than estimated. Agreed or not? That means, what was my estimated material cost? Try to understand. Now cost is more by how many percent? 25% than estimated. That means 125 means 75,000. 100 means question mark. 60,000. Correct? This was my estimated cost. And how much was my tolerance level? 5% over this. That means my tolerance level was 60,000 plus 5%, which will come to 63,000. Correct? But actually we are incurring 75,000. Up to 63,000, it used to be no escalation, nothing. That means extra 12,000 we have incurred. On this they will be ready to pay that escalation, but not whole 12,000. Why, sir? They will pay only 25% of the 12,000. Rupees 3,000. Extra relating to material is rupees 3,000. If at all even didn't understand, now try to understand through wages once again. Wages, how much we are incurring actually? Wages paid 45,000 and accrued 5,000, which means 50,000. Hello. Guys, yes or no? But this 50,000 I am incurring because my cost has increased by 25%. Try to understand. My planned wage was not 50,000 when we were doing contract. 50% is 125% of our planned wages. Then planned wages was how much? Rupees 40,000. Correct? What does our contract says? Boss, up to 5% you have to keep the tolerance. Up to 42,000, this escalation clause won't apply. Okay, but it is going more than 42,000. How much? 8,000. What escalation clause says? More than that 5%, that is more than that 42,000. Whatever the extra you incur, of that 25% you can recover it as a escalation here, which is 2,000. So escalation could be recovered. Material 3,000, wages 2,000, total 5,000. Anyone, any doubt in this? Mark it as LMR. I'll show the answer here only. See there. Material 1 lakh, wages 50,000. What else? General expense 10,000. Depreciation 5,000. General expense 10,000, plant depreciation 5,000. Got it? Okay. Nothing was there in the credit side because no material left at site. Oh, it's there. 25,000. Correct? No? It's there, 25,000. So, how much is 1 lakh 50,000? Wages is 50,000, no? General expense 10,000, no? 1 second. Depreciation was 5,000, no? Total 1,65,000. Credit side, material at site is there, 25,000. Keep that thing in mind. So cost of construction is 1,40,000. That I will take it in the debit side. 1,40,000. Of course, I am going to compare it with the credit side WIP. Remember here 3 line items will come, not 2 line items, because escalation is there. So value of work certified, how much? 2 lakh. Work uncertified 15,000. Value of work certified 2 lakh. Uncertified 15,000. Escalation clause 5,000 extra. So 2 lakh 20,000. So notional profit 80,000. That 80,000, of course, we have to transfer to P&L as well as provision. How much to P&L we'll see. How much is the work certified they are telling? They are telling work certified is 2 lakh, where the contract was of 5 lakh, which means 40% complete, right? 40% complete. In fact, contract price now will go to 5 lakh 5,000 because of that escalation. Still 40%, one third no. So 80,000 into one third. Best part is whatever the work certified 1 lakh 2 lakh, cash received is just 1 lakh 50,000. Moral of the story, cash received is 75%. How much it is? 20,000. 60,000 will go for the provision. Anyone, any doubt in this? Pakka. 20,000, 60,000. No doubt? Hello. Pakka. Shall we proceed? Next question, please. Set 2. No MCQ. No descriptive. June 24. No MCQ. 4B. Contractor has undertaken the construction 5 lakh rupees. So contract price began to execute on 1st Jan and they have given till 31st December. Moral of the story, 12 months later they have given. Machinery is there, let it be. Material, debit. Wages, debit. Direct expense, debit. Uncertified work, cost of uncertified, you have to credit. Wages outstanding, debit. Value of machinery, try to understand. Opening was 30,000, closing is 22,000. So I am going to take 8,000 as a depreciation, debit. Got it? Overheads, debit. Material returned, credit. Work certified, credit. Cash received won't come here. Material on 31st 12, credit. Material at site. It was decided that profit made on the contract in the year should be arrived by deducting the cost of work certified from the total value of architect's certificate, of course. Then 1/3 of the profit so arrived should be regarded as a provision, which means 2/3 should be transferred to P&L. However, cash received to the work certified also should be adjusted, which means 2/3 into cash received, see, 3,60,000, whereas work certified was 3,90,000. So what you should do, whatever the profit you get into 2/3 into 360,000 divided by 390,000 you should do. Remaining should go to provision. Hope it's clear. We have done this in study mat also. Nothing special is there in this. See here. Depreciation 8,000. Material, wages, outstanding wages, direct expense, overheads. Material returned at site. Cost of construction. In that WIP, work certified, work uncertified. So notional profit became 56 so much. In that, try to understand, 2/3 of 56,000 adjusted with the cash received, 34 will be transferred to P&L, balance will go to provision. Anyone any doubt in this? Simple now. Next one please. Company undertook the contract for a construction of a large building. The construction work commenced on 1st April 23 and the following data are available till 31st March. So 1 year data. Contract price is there, let it be. That is 33 crore 50 lakhs. Work certified 2 crores. Progress payment, leave that thousands only, let it be. Progress payment received 15,000. Material issued to site, we have to debit. Planning and estimation cost, we have to debit. Direct wages paid, debit. Material returned from site, credit. Plant hiring charges, debit. Wage related cost, debit. Site office cost, debit. Head office expense apportioned, debit. Direct expense incurred, debit. Work not certified, credit. Work certified, credit. The contractor owns a plant which was originally costing rupees 30 lakh, have been continuously in use in this contract throughout the year. Awesome. Residual value of the plant after 5 years is expected to be 5 lakhs, which means 25 lakh is depreciable amount. 5 years is a depreciation. Per year it is rupees 5 lakhs. So moral of the story, 5 lakh will be depreciation. You have to take debit, because that was there in the contract throughout the year. As on 31st March 24, the direct wages due and payable amounted to 2,50,000. So again debit, outstanding. Materials at site, credit. Prepare a contract account for the year. Very simple, guys. All the debits shall I write first? Material 8,500. Planning and estimation 1,000. Direct wages 4,020 plus 2,50,000. 2,54,020. This is what the mistakes will be done by students. Try to understand. Whatever the amount is given, that is already in thousands, which means already our wages is 40,20,000. 4020 000 40,20,000. For that we have to add 2,50,000. Hope you guys understood. Yes. So direct wages are 42,70,000. Now don't write 42,70,000 because everything is in thousands. 4270. Hope it's clear. Material returned from site 270. Credit. Plant hiring charges 2,000. Wage related cost 5,000. Sorry, 500. Site office cost 650. Head office expense 350. Direct expense 1,000. This depreciation 5 lakh. Don't write it as 5 lakh. Write it as 500. 500,000. Next, material at site 5 lakh. Don't write it as 5 lakh. Write it as 500. Got it? Okay, done. How much will be the cost of contract? 8,500, 1,000, 4,000, 270, 2,000, 500, 650, 350, 1,500. 18,770. So 18,000 is the cost of contract or cost of construction so far. Correct? Okay. We got 18,770 in the debit side. Credit side, work certified 8,500, sorry, 20,000. Work certified 20,000. Work not certified 1,000. Total will come to 21,000. Notional profit will be 21,000 minus 18,770. 2,230. Of that, first, guys, contract price was how much? 35,000. Work certified is 20. Oh, this is 18,000. 18,000. So notional profit is how much? 3,000. So let's see there. 35 is the contract price. 20 is work certified. So 20 divided by 35. Around 57%, which means 2/3 will be transferred. Correct? So 3,000 into 2 by 3 into, because out of 20,000, only 15,000 is cash received, 75%. 3000 into 2 by 3 into 15 by 20. 1500. 1500 will go to P&L, 1500 will go to provision. Hope it is clear. What? Notional profit, how much we got? 3000, no? How come these guys are getting 2150? Work uncertified, how much did we take? Sorry. Work uncertified was 150. I took this number. I problem. I mean, it was proper last 20 days back. Accordingly, this will change. Okay. Just we took the wrong number there. That's it. All other calculations and all is. Next one, please. Set 2 now. Cost price is not fixed in case of escalation clause. Cost plus contract, is it fixed? No. De-escalation clause. De-escalation clause means negative. Prices won't increase, that kind of thing. So in none of this, cost price will be fixed. I mean, actually it should not be cost price, it should be contract price in first place. Got it? Next. No? Descriptive. June 25. No MCQ? For B now. Oh, here answer question they have given now. What she is telling? Prepare a contract account, contractee account. This thing we have already done. Name change. Next up. In examination only 4B it is. Just like degree exam. Fixed numbers. This is also done. Next up. This escalation clause thing done. Next up. Next paper. December. Value of work certified. Value of contract into work certified percentage. Value of contract into work uncertified. Cost of work to date minus cost of work uncertified plus material in hand plus cost of site. That is going to give you cost of work certified. Value of work certified minus payment made to contractor will be retention money. Option A. 4B is there. Same. That one thing. That thing. With that we have completed contract revision. Now we'll do standard will do, no? That will be easy. Patapat it will get over. No. We'll take a break for 3-4 minutes and we'll start. Okay. Now we'll be discussing standard costing. Okay. What do you mean by standard costing? Sir, try to understand it's not a method of costing like all these what we have discussed, contract, process, all this discussed. No, it's not a method. It's a technique. Okay. So here we are not trying to determine the cost. Here we are trying to control the cost. So it's a technique of cost control. It's a technique of cost control. And what does that do, sir? Nothing. Here will be determining some predetermined cost. We'll be determining cost before we are incurring that. That thing we call it as standard cost. That we will compare it with the actual cost. So trying to make sure our actual cost don't exceed our predetermined cost. So that predetermined cost itself, we call it as a standard cost. That predetermined cost itself, we call it as what? Standard cost. Got it? Okay. So basically here we will be restricting the total cost to the extent of cost which is predetermined. And standard cost means nothing but our predetermined cost. Sir, how the standard costing process will work? First we will set the standards, guys. First we will set the standards. Predetermine the cost that we are going to, then we will incur the cost, no, that data. We are going to compare our predetermined cost with the actual cost and we'll find out any deviations are there or what. If any deviations are there, we will check whether it's favorable deviation or unfavorable deviation and we will analyze why it has happened and we will take the corrective measures for that. Listen here, how to determine, sir, whether it's favorable or unfavorable? Very simple. If at all our actual cost is less than our predetermined cost, favorable. I thought my expenditure will be 10,000. Actual expenditure came only to 9,000. Good, bad? Good, favorable. That is, if my actual is less than standard, favorable. If the actual is more than standard, adverse. If the actual is more than standard, adverse. Got it? Cost generally for standard cost purpose, we will divide it into 3. Material cost, labor cost, overhead. However, overhead related stuff you guys don't have, don't worry. It will be covered in the management accounting. Okay, sir. So management accounting people don't have material and labor or nothing like that. In management accounting, we have material, labor, overhead. In costing, we have only material and labor. First, we will be discussing material cost variance. Listen, we have material cost variance could be divided into, see, I am not going to explain the formula and all again. Yes, hope you remember the explanation for formula, right? Hope you don't have to by heart it. You remember the concept, why it is so? Oh, you remember biryani, na? Oh, nice. Now listen. And one more thing. Always remember here, standard means standard for actual. Standard means standard for actual. Standard means not standard for standard. What nonsense are you talking, sir? What the hell is standard for standard, standard for actual? Try to understand. If I tell standard cost rupees 1 lakh to produce 100 units. To produce 100 units. But actually I am producing 160 units. Guys, try to understand. And I am incurring the cost of 1,40,000. Immediately what we will tell, oh my god, our actual cost is 40,000 more than the standard. Correct? But the thing is, base itself is wrong. Why? That 1 lakh is for 100 units. 1,40,000 is for 160 units. So what you should do, the standard cost you should convert to the actual output. How, sir? For 100 units it was 1 lakh. If at all we wanted to produce 160, question mark, 1,60,000. So standard is 160,000, actual is 140,000, 20,000 favorable, guys. 20,000 favorable. Hope it's clear. So always remember, standard means always and always and always standard for actual. Standard for, hope it's clear. So material cost variance. Cost variance means total cost. Total cost. That is, we are going to compare the standard cost with the actual cost. What? Standard cost with the actual cost. Standard cost means what, sir? Standard quantity. Standard quantity. Try to understand. Consumption. We are talking about raw material here, not finished goods. Standard quantity into standard price. Standard quantity for actual output. Keep that thing in mind. Standard quantity for actual output. So standard cost is standard quantity into standard price. Actual cost is actual quantity into actual price. What? Standard quantity into standard price is standard cost. Actual quantity into actual price is actual cost. If the standard cost is more than actual cost, favorable. If the actual cost is more than standard cost, adverse. Why? Because we are incurring more than what we planned. No. Is it good or bad? Bad. That's the reason. Okay. Now, sir, this cost variance will be relating to two reasons. This cost variance will be relating to two reasons. One, due to usage. One more, due to price. Okay. Due to usage wise, sir, we are using more or less compared to what we planned. Price, we are paying more or less as per what we planned. Always remember, usage. Usage means relating to quantity now. That is, how much was the quantity we planned? Standard quantity. Minus, how much is the quantity actually we consume? Actual quantity. Standard quantity minus actual quantity into standard price. Why, sir? Because usage variance is related to production manager. He or she is least concerned about what the hell you actually pay in the market. For them, you promised at standard price, no? So they will be taking the variances in the standard price. So usage variance, guys, usage variance, standard quantity minus actual into standard price. Standard quantity minus actual quantity into standard price. Now, if at all you consumed more than what you planned, that is actual is more than standard, adverse. If at all you consumed less than what you planned, standard is more than actual, then favorable. Hope it is clear. Next one is price variance. You paying more or less. Here we are going to hold purchase manager responsible. Purchase manager responsible. Remember always, purchase manager work is only one thing. How much ever the, I repeat again, how much ever our production manager asks to get, so much they should get. Not standard quantity. How much our production manager actually asks to get. How much our production manager will actually ask to get? Actual quantity. Correct? So standard price minus actual price into actual quantity will give you price variance. Standard price minus actual price into actual quantity, not standard quantity, will give you price variance. If the standard price is more than actual price, what is the meaning of that? You paid less than what you planned, favorable. If at all your actual price is more than standard price, you are paying more than what you planned, which is adverse. Hope it is clear. Standard price minus actual price into actual quantity, that will give you price variance. Come again, material cost variance, standard cost minus actual cost. Standard cost means standard quantity into standard price. Actual cost means actual quantity into actual price. That could be divided into usage price. Price variance is standard price minus actual price into actual quantity. Standard price minus actual price into actual quantity. Whereas usage it is standard quantity minus actual quantity into standard price. Guys, usage variance could be further divided into two if at all more than one material are there. Usage variance could be further divided into two if at all more than one material are there. Which are those two, sir? Mix variance, yield variance. Mix variance, yield variance. What do you mean by yield variance, sir? Yield variance we also call it as sub-usage variance. Yield variance we also call it as Sub-usage variance. What do you mean by that, sir? You are using more or less than what you planned. Correct? Now, that is due to quality. That is due to quality. So, what you are going to do, sir? You are going to compare your current standard with the revised standard. Current standard with the revised standard. Okay, sir, but how to arrive at a revised standard, sir? Very simple. Your actual quantity in the standard ratio. What? Actual quantity in the standard ratio. Your actual quantity in the standard ratio will give you revised standard quantity. Total of the actual quantity divided in the standard quantity ratio, you will get a revised standard quantity. Now, revised standard quantity will be your new standard. Revised standard quantity will be your new standard. So, in yield or sub-usage, what you are going to do is, you are going to compare your old standard with the new standard. That is, standard quantity minus revised standard quantity into standard price. Standard quantity minus revised standard quantity into standard price. Now try to understand. Old standard was 10,000 kgs. Now because of the quality issue, you are changing it to 11,000. Earlier you expected cost to be of 10,000 kgs. Now it is of 11,000 kgs. Good to bad? Bad. Adverse. So always remember, if RSQ, revised standard quantity, is more than standard quantity, adverse. If the revised standard quantity is less than standard quantity, favorable. Hope it's clear. Pakka. Next one is mix variance. That is, you are using actual quantity, I agree, but are you using the standard ratio? Might not be. So what is the difference? That is, instead of standard quantity, we'll take revised standard quantity minus actual quantity. That is, as per the new standard, what is the difference? That is, RSQ minus AQ into standard price. So RSQ is new standard. So that will be treated as standard. So if RSQ is more than actual quantity, good, favorable. If the actual quantity is more than revised standard quantity, adverse. Hope it is clear. Yes. So guys, once again, material cost variance, standard cost minus actual cost. Standard cost is standard quantity into standard price minus actual quantity into actual price. That could be divided into price, usage, price, standard price minus actual price into actual quantity, usage, standard quantity minus actual quantity into standard price into standard price. Usage could be divided into yield, mix. Whenever more than more than one particular raw material is there, okay, mix. First, yield, standard quantity minus revised standard quantity into standard price. Yield, that is yield. Mix is revised standard quantity minus actual quantity into standard price. Sir, what happens if I take ulta? Like what? Actual quantity minus revised standard. Nothing will happen. But while writing adverse favorable, you should be careful. You should know when it is adverse, when it is favorable. Got it? Only that time you should be careful. Now, whatever the formula I am telling, in that order, if you get positive, it will be favorable. If you get negative, it is adverse. But if you do ulta, then you should be very careful what it is. Okay. One last time, shall we revise every formula? Material cost variance. Standard cost minus actual cost. Standard cost is standard quantity into standard price. Actual cost, actual quantity into actual price. That could be divided into usage variance, price variance. Price variance, standard price minus actual price into actual quantity. Usage, standard quantity minus actual quantity into standard price. Usage variance could be divided into yield, mix. Yield, standard quantity minus revised standard quantity into standard price. Mix, revised standard quantity minus actual quantity into standard price. Correct? How to arrive at revised standard quantity? Actual quantity in the ratio of standard. Actual quantity in the ratio of standard. Hope it's clear. Pakka. And one more thing, remember. actual quantity means you should not take what you purchased. You should take what you consume. Now, while arriving at consumption, you should be very careful. Sometimes there will be two things. Standard will be one only, but actual will be two things. One, opening stock, one more, purchase during the period. One is opening stock, one more will be purchase during the period. In that case, what you should do, sir, apply FIFO. Apply FIFO. What do you mean by that, sir? Let's say, actually you are consuming 600 kgs. Opening 200 kgs of 4 rupees was there. Purchased 800 kgs of 5 rupees was there. Now, while computing actual cost, please be careful. Please be careful. 400, opening 200 was there. That will be used first. 200 into 4 rupees. Plus, remaining 400 we are assuming to be consuming out of purchase. So, out of 800, I will take 400 into 5 rupees. So, always remember, if they don't give what basis you should take the actual quantity, actual cost, use FIFO. Whatever opening is there, that thing will come. And remember, the difference will come only in the usage variance. Why, sir? Try to understand. Sorry, not usage variance, cost variance. That's the only place where you will take the actual price for both, as well as price variance. Price variance, generally they will ask you to purchase it, calculate it on the purchase basis. Reason being, generally our opening stock and standard will be same. Cost for opening stock, actual cost of opening stock, actual price of opening stock, standard price will be same, because generally standard price will be fixed on the basis of previous year's data and all. So their price variance won't be there. Standard price is 4 rupees. Actual price is 4 rupees. Will there be any deviations? No. If deviations will be there, that will be relating to that 5 rupees what you purchased. So only that variance will come. So generally price variance will come relating to purchased units, and in cost, while computing cost, that time variance will come. Got it? In all other places, it is standard price. So whether you have 2 price or 3 price or who cares? Standard price will be one only, no? That is your material cost variances. I hope to some extent you are able to recall everything. Because if at all I keep explaining why that formula has arrived again and again, like that day it will need 2 days. So we are not doing that. We'll proceed. Labor cost variance. Labor cost variance, guys, that is standard cost minus actual cost. Standard cost means standard hours into standard rate. Actual cost means actual cost into actual rate. Now, guys, standard hours means, always remember, I told you in labor chapter also, here also I am telling again, standard hours should include normal idle time. For example, if they ask me, sir, you have to complete this marathon in 20 hours. Standard hours allowed is 20 hours, right? Now, do you think marathon actually takes 20 hours? The answer is no. They might have computed 16 hours. 2 days. 16 hours. 2 hours normal idle time. Time given is 20 hours. If at all they give only 16 hours, can we literally sit for 8 hours continuously 2 days? No. So always remember, when computing or when giving standard, already standard hours will be inclusion of your normal idle time. Over and above standard hours, if you get anything idle time, that will be always and always abnormal idle time. Abnormal idle time. By the way, what do you mean by idle time? Time paid but not worked. Correct? Now listen. Labor cost variance. Standard hours into standard rate minus actual hours paid. Actual hours paid into actual rate. Correct? Labor cost variance could be divided into 3 or 2 depending upon idle time there, idle time not there. Idle time there, idle time not there. If idle time is not there, then it could be divided into rate and efficiency. If idle time is there, then it could be divided into rate, efficiency, idle time variance. Rate, efficiency, idle time variance. First one we are going to discuss is rate variance. Rate is very simple, guys. Standard rate minus into actual hours paid. Actual hours paid. Overall you have to take. So try to understand. Standard rate minus actual rate into actual hours paid will give you rate variance. Okay. If at all no idle time, actual hours worked as well as actual hours paid will be same only. Now rate variance, standard rate minus actual rate into actual hours paid. Correct? Efficiency means, boss, in how many hours you should have completed the work, how many hours you have taken. If you have taken less than standard hours, favorable, you completed work very fast. If at all you have taken more than, then it is standard hours, then it is adverse. Because the work of 8 hours, you are taking 10 hours. Got it? So efficiency variance is standard hours minus actual hours into standard rate. Standard hours minus actual hours worked. Actual hours work, not paid. Why, sir? That paid and work difference will be there. No, that is your idle time. No, actual hours paid minus actual hours really worked. That is your idle time. That will be treated as idle time variance. That will be treated as idle time variance. That is actual hours paid minus actual hours work into standard rate is your idle time variance. Listen here. Idle time variance is always and always and always adverse. It cannot be favorable. How can the idle time be favorable? Me paying for you guys and you are chilling. How it will be favorable? Mental peace. Working on ourselves, sir. I was thinking. No. So idle time is always adverse. Idle time is always adverse. Hope it's clear. So guys, labor cost variance divided into 3. Labor cost variance, basically standard cost minus actual cost. Standard cost means standard hours into standard rate. Actual hours paid minus into actual rate. That could be divided into 3. Rate variance, efficiency variance, idle time variance. Rate variance, standard rate minus actual rate into actual hours paid. Idle time variance is actual hours paid minus actual hours worked. Your idle time into standard rate. Efficiency variance is standard hours minus actual hours worked into standard rate. Actual hours worked into standard rate. Your efficiency variance, if at all more than one type of labor is there, you can divide it into mix and yield. Okay, mix and yield. And mix here, we also call it as gang variance. Mix, we also call it as what? Gang variance. Hope it is clear. Now, yield variance is nothing but revised standard hours minus standard hours into standard rate. Mix is revised standard hours minus actual hours work into standard rate. Yield is revised standard hours minus standard hours minus revised standard hours. If you know the conclusion, it won't matter. You know what you are comparing. Yield is standard hours minus revised standard hours into standard rate. Mix is revised standard hours minus actual hours into standard rate. Always remember, for these two as well as efficiency, it's actual hours worked. Okay. And revised standard hours, how to arrive at it, sir? Actual hours worked in the standard ratio. Actual hours worked in the standard ratio. And remember guys, in the question, if they tell something like standard hours produced, what? Standard hours produced. What do you mean by that, sir? Standard hours produced means, guys, standard hours for the actual output. Actual output what we produce, per that standard hour is how much? That's what they mention it as standard hours produced. That's what they mention it as standard hours produced. Hope it's clear. So standard hours produced means what? Standard hours for actual output. Sir, but if different class of labor are there, then how can we divide the standard hours for actual output? Sir, divide it in the standard ratio. They will give standard number of employees, standard hours, actual number of employees, actual hours worked, actual number of employees into actual hours, we will get the actual hours paid, actual hours worked, etc. But standard hours, don't multiply standard hours into that, telling that this is the standard for actual. No, that will be standard for standard. They will give one line telling standard hours produced. That standard hours produced is the standard hours for actual output. That you divide in the standard employee ratio. That you divide in the standard employee ratio. I think if I am not wrong, 2 or 3 questions like that we have solved already. Correct? Okay. Fine. Now shall we see questions? Before that, shall we one last time shall we revise all 2, 3, 3 plus 2, 5, 5 plus 5 plus 6, 11 formulas. Yes. Material cost variance, standard cost minus actual cost. Standard cost means standard quantity into standard price, actual quantity into actual price. That could be divided into price variance, usage variance, price variance, standard price minus actual price into actual quantity, usage variance, standard quantity minus actual quantity into standard price. Usage variance could be divided into 2. Yield mix. Yield is standard quantity minus revised standard quantity into standard price. Mix is revised standard quantity minus actual quantity into standard price. Revised standard quantity is nothing but actual quantity in the standard ratio. By the way, standard quantity is nothing but standard quantity for actual output. Hope it's clear. Labor cost variance, standard hours into standard rate minus actual hours paid into actual rate. That could be divided into 3. Rate variance, idle time variance, efficiency variance. Rate variance, standard rate minus actual rate into standard actual hours paid. Standard rate minus actual rate into actual hours paid. Idle time into standard rate. Idle time is nothing but your actual hours paid minus actual hours worked. Efficiency is standard hours minus actual hours into standard rate. Actual hours worked, by the way. That will be divided into 2. Yield mix. Yield is also known as sub-usage. Mix is also known as gang. Yield, standard hours minus revised standard hours into standard rate. Mix, standard hours, revised standard hours minus actual hours into standard rate. By the way, actual hours means actual hours worked. And how to arrive at a revised standard hours, sir? Actual hours worked in the standard ratio. And material, opening stock as well as purchase they have given. Always remember, for the consumption you have to calculate on the basis of consumption, not on the basis of purchases. And if at all nothing is given, then use FIFO for that. For consumption, use FIFO. That is out of consumption. Beginning it will be out of the opening. Whatever the balance is there, that will be out of new purchases. Hope it is clear. Now if you guys are ready, we can see few questions. And standard hours produced means, hello, standard hours produced means standard hours for actual output. May I know the question number? Standard price for material per kg is 20. Standard price is how much? Standard usage per unit of production is 5 kg. And actual usage of production is 100 units is 520 kgs. Try to understand. Try to understand. Actual quantity consumed is 520 kgs. Correct? Standard quantity is 5 kgs for one output, but we are producing 100 output. So standard quantity for actual output, that is 5 into 100. 500 kgs. Got it? And standard rate or standard price is rupees 20 and actual price is rupees 22. Material usage variance they are asking. Usage variance is standard quantity minus actual quantity. Now only we can decide whether it's adverse or favorable. Adverse it is. We are using more into standard price. Rupees 400 adverse. Hope it's clear. Next. 8 now. Measures Picasso Inc. is a company which follows standard costing system. The details regarding the composition and weekly wages of the labor force engaged on job number XP25, which is scheduled to be completed in 30 weeks. Try to understand. This particular job number XP25 is there, no? This only is scheduled to be completed in 30 weeks. Try to understand. Then 30 weeks is nothing but standard for actual. If they just gave 30 weeks data, then we would have ignored it. But try to understand, for the particular job only we are planning 30 weeks. What is the standard, sir? We are planning skilled workers 75, semi-skilled workers 45, unskilled workers 60. Weekly wage rate were 60, 40, 30. Actual hours so much. The work on the job is actually completed in 32 weeks. Actually that is getting completed in. You as the cost accountant, you have to find out these variances. As the idle time variance is not given, only 5 variances you have to calculate. Okay. And always remember, in standard costing, it's all about putting numbers in the table. That's what matters in the beginning. Correct? Listen, 3 types of workers are there. Skilled, semi-skilled, unskilled, semi-skilled. Semi-skilled, unskilled. We need few informations. Standard hours, standard rate, actual hours, and by the way, remember here, they haven't given it in terms of hours. They have given it in terms of weeks. They haven't given in terms repayment in terms of hours. They have given it in terms of weeks. So we don't have to convert. If at all they had given payment for a per hour, standard hours they are given in weeks, then weeks you should have converted into hours by taking how many hours in a week, like that. Actual rate, and also we need revised standard hours. Shall we start now? First, standard. Skilled. We are planning for 75 workers, 30 weeks, which will come to. Skilled, we are planning 75 workers should work for 30 weeks. 2250. Next, semi-skilled, 45 employees, 30 weeks. 1000 weeks. Correct? Unskilled, 60 employees should work for 30 weeks. Should, I am not telling they are actually working. 1800. Standard rate they only have given per week, it is 60, 40, 30. Okay. Now, actual hours, try to understand. 70 skilled workers are working for 32 weeks. 2240. 30 semi-skilled workers are working for 32 hours. 32 weeks. 960. And 80 unskilled workers are working for 32 weeks. 2000. By the way, total of actual hours can I get, please? 5,760. And actual rates are 70, 50, 20. Revised standard hours are nothing but your actual hours in the standard ratio. You can take standard hour ratio or you can take standard employees ratio, because both are same only. Because multiplied with 30 now for everything. If at all this wasn't multiplied by 30, then it would be different. But as it's multiplied by 30, it is same only. So you can take either this for the calculation of ratio or either you can take this for the calculation of ratio. If I am not wrong, it is 5, 3, 4. 15 is common factor then. 5, 3, 8, 8, 4, 12. So how much is 5760 divided by 12 into 5? 2400. 5760 divided by 12 into 3. 1440. 5760 divided by 12 into 4. 2000. 1920. Hope it's clear. Now we have to compute few things. First one, what they are asking? Labor cost variance. Labor cost variance, LCV. Labor cost variance. What is the formula for labor cost variance? Standard hours into standard rate minus actual hours paid into actual rate. Standard hours into standard rate minus actual hours into actual rate. We got skilled, semi-skilled, unskilled. So standard hours are 2250, 1350, 1800. Correct? Standard rates are 60, 40, 30. Minus actual hours into actual rate. Actual hours into actual rate. May I know how much? First one 21 adverse. Next one 6000 adverse. Next one total 21,800 plus 6,000 minus 2,800. 30,000. Wrong. Sorry. 18,600 adverse. How come 18,600? I don't know. This basic calculation. Leave. 19,000 plus 6,000, 25,000. My bad. Sorry. Next what they are asking? Labor rate variance. I will just write the formula. You can calculate it now. Labor rate variance. What is the formula? Standard rate minus actual rate into actual hours. Okay. Next one, what they are asking? Labor efficiency variance. What is the formula? Standard hours minus actual hours into standard rate. Next, labor revised efficiency variance and mixed variance. So labor revised efficiency variance means change in efficiency, that is because of quality, which is yield. Labor yield variance, what is the formula? Standard hours minus revised standard hours into standard rate. Labor mix variance, hope it's clear. You can compute now. Yes. Yeah, here onwards I will just be doing this table, okay? Okay, that you can take photo or something and you can complete it. Next, December 23, MCQ 15. If a standard hours for 100 units of output are 800, actual hours taken are 760, so 100 units only actual output. So basically standard for actual only they have given, right? Labor rate variance they are asking. Standard rate 4 rupees, actual rate 4.5 into actual hours 760. 380 adverse. Hope it's clear. Next up. Five B now. Material, see there. Delta Limited furnishes the following mix to produce 1 unit of product R. Whatever the information they have given is to produce 1 unit of output. 3 kg of X, 4 kg of Y, 5 kg of Z at the rate of 300, 500, 400 per kg. During the month, 10 units of R are actually produced. So, I will just quickly do the table. Yes, we need standard quantity, we need standard price, we need actual quantity, we need actual price, we need revised standard quantity. Standard quantity, try to understand. For 1 unit it was 3 kg, for 10 units it will be 30 kgs, 40 kgs, 50 kgs. Standard prices are 300, 500, 400. Actual quantity are 32, 47.5, 43.5. Actual prices are 350, 550, 360. Revised standard quantity is nothing but actual quantity in the standard ratio. How much is actual quantity? 123. So 123 kgs in the ratio of 3:4:5. 123 divided by 12 into 3. 30.75. 123 divided by 12 into 4. 123 divided by 12 into 5. 51.25. Hope now you will be able to solve it, right? What is the cost variance formula? Quickly tell me. Standard quantity into standard price minus, okay, price variance, standard price minus into quantity variance, mix variance, mixer, revised standard quantity minus actual quantity into standard price, and yield into, got it up. Give me a second. If at all you are going to get like confused regarding, sir, with the revised standard should I reduce actual quantity or standard quantity to arrive at a mix and yield? If at all you confuse, I think that should be the only thing. Remember this code word called RAM. 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 What is that, sir? Revised standard quantity minus actual quantity. That is nothing for mix variance. Okay, so now you know that AQ if you take out, if you put SQ, that should be for yield. Okay, so RAM you remember for mix, it is revised and actual. Hope it is clear. Next, June 24 MCQ 15 15. This is nice. In a year 23-24, X and Co used 2820 for material at a standard cost of 11,562. So standard cost, your standard quantity into standard price is coming to 11,562. Correct? Correct? No. And your actual quantity is coming to 2820 kgs. Is that clear? Material usage variance they are telling 123 favorable. That means your actual quantity is more than standard quantity or less than standard quantity. Less than standard quantity. So if I write standard quantity minus actual quantity into standard price, that is giving us 123 answer. Sir, it's favorable, that's why you took plus. The answer is no. The formula, as per my formula, standard quantity is first, actual quantity is later. We know that favorable means standard quantity is more than actual. That means SQ is more than negative. Positive number is more than negative. So answer will be positive. If at all I had written it as actual quantity minus standard quantity into standard price, I would have taken it as minus 123. Why? I know that standard quantity is more. Negative number is more than positive number. So automatically answer you will get is in negative. Hope you understood. So if you change the formula also, that's fine, but you should know when it is favorable, when it is adverse. So standard quantity minus actual quantity 2820 into standard price is giving me how much? Or wait, let me reframe the formula. Standard quantity minus actual quantity into standard price. Can I write it as standard quantity into standard price minus, very good, actual price, your head, is equal to minus, 123, not minus, 123. Because standard quantity into standard price is more. How much is standard quantity into standard price? 11,562 minus actual quantity 2820 into standard price is equal to 123. Now I will take 123 this side. 11,562 minus 123. 439 is equal to 2820 into SP. How much is SP? Take your time. You have to press 8 digits. No, it takes a lot of time. 4.025. And you know that your standard cost is 0. Standard quantity into standard price is equal to standard cost. Standard quantity is equal to standard cost by standard price. Standard cost is 11,562. Standard price is 4.05. How much it is? 11,562 divided by 4.05. Option B. Hope it's clear. Next. 5 A or B? B. This was same like what we discussed in that weeks. There it was 30 weeks, here it is 80 hours. There it was 32 weeks, here it is 88 hours. Okay, can you do it? Next. December 24, right? MCQ 12. In a factory where the standard costing is followed, 4000 kg of material at the price of 10 rupees were actually consumed. So actual quantity are 4000. Actual price is rupees 10. Resulting in the material price variance of 2000 rupees adverse. That is, actual price is more than standard price. If at all you take standard price minus actual price, then answer you should write in negative. What will be the standard cost of material per kg? Very simple. Standard price minus actual price into actual quantity. That is coming as minus 2000. Correct? So I will write it as standard price into actual quantity minus actual quantity into actual price minus 2000. Standard price I don't know, let it be, but actual quantity I know 4000 minus 4000 into 10, actual quantity into actual price 40,000. That is equal to minus 2000. Standard price into 4000, that is equal to, very good, 30. SP is option B. Okay. Next. 5B. The following information is extracted from the record of Emon Limited, a manufacturing company using a standard costing system. Listen here. If you give an input of 100%, there will be a process loss of 10%. In standard only if there is a loss, that means there is standard loss, normal loss. Why, sir? Because it's a planned loss. Planned loss means always normal. You can't plan the abnormal loss. So actual output is 90 kg it seems, where the input given was 110. Leave that. Now listen, very important, this kind of question. Guys, what is the standard telling? Standard telling that, boss, if you give 100 kg of input, you will get output of 90 kg. Correct? Now listen, can I tell, to get the 90 kg of output, material S required is 60. Yes, actual output is also 90 or 90 only. Awesome. Your actual and standard output is matching. So you can take directly if you want, but still you can compute and take, which will come to standard quantity, material S is there, material T is there. Standard price, actual quantity, actual price, revised standard quantity. Now standard quantity is 60. Correct? This one it will be, for 90 required was 40. For 90 question mark 40. Because if at all actual output, if at all assume they had given it as 190, then you should take it here 190. And also here don't take it as for 140. Wrong. Why? They are only telling normal loss of 10 is there, which means if you give 100, output will be 90. So for 90 you should give 60. Hope it's clear. Standard prices are 20 and 10. Actual quantity are 44 and 66. Actual price are 25 and 5. Revised standard quantity is actual quantity in the standard ratio. 110 in the ratio of 6:4 or 3:2. Hope it's clear. Can you solve it? Hope you remember the formula. Done. Shall we go to the next one? May I know the question number? June 25 MCQ. Which of the following would not be used to estimate the direct material cost? Purchase contracts already agreed. Of course, you should use it. The forecast movement of price in the market, based on that only will decide standard price. Availability of bulk purchase discount, affecting the prices, no. Performance standard in the operation, who cares? That is required for standard quantity, not for standard price. Next up, the operation to produce a unit of product requires 9 hours, which means 9 hours is you have to work. Effectively, you have to work. Excluding break, you have to work for 9 hours. Budgeted idle time is 10% of the total hours paid for it to be incorporated. Try to understand. The wage rate is 16. Standard labor cost they are asking. Very simple, guys. We don't know standard hours. Don't take 9 hours as standard hours. Because standard hours should include normal idle time. What they are telling, standard hours minus normal idle time, that is 10% of the total hours paid, that is standard hours. 0.1 standard hours is coming to 9 hours it seems. So standard hour is equal to 10 hours. Correct? 10 hours into 16, 160. Therefore, standard cost per unit is 160. Hope it is clear. Next. QTR Limited, which is following standard costing system, furnishes the following information regarding production budget for December 2024. Product X 40,000 units, product Y 80,000 units. Okay. One standard hour represents 10 units of product X and 8 units of product Y. So standard production is in 1 hour, if you are producing X, 10 units. If you are producing Y, 8 units. Standard wage rate are 0.5 per hour. Okay. During the month, 15,000 hours were actually paid. Actual hours paid. 0.6 per hour. That is actual rate. Which include 700 unproductive hours due to unbudgeted holidays. Unbudgeted means not planned holidays. Abnormal idle time. Planned holidays means normal idle time. And also loss of production of 500 units, which means here you have given time but production is not there, which means relating to 500 units hours you have lost. Abnormal idle time. Actual production for the month was 48,000 units of X, 76,000 units of Y. They're asking you all the variances. Here if you think, oh, two type of labor is there, no. One type of labor, no mixed yield and all will be there. Two type of production is done. Now, guys, shall we compute the hours? Listen, always remember standard hours should be computed for actual output, not for standard output. Sir, why they have given that, sir? Who cares? Correct? No. Now listen. Standard hours will compute for X first. 1 hour, if you take, you can produce 10 units. Actually, if you are producing 48,000 units, how many hours you should have taken? Should have 4,800 hours. Got it? Product Y. If you take 1 hour, you should have produced 8 units of Y. If you took 1 hour, you should have produced 8 units of Y. You are producing 76,000 units of Y. Then how many hours you should have taken? 9,500 hours. Standard hours is equal to 14,300 hours. Anyone, any doubt in computation of standard hours? No. Standard rate though we know. They only have given rupees 0.5. Correct? Correct now. Actual hours paid, they are telling 15,000 hours. Awesome. Actual hours paid 15,000 hours. Actual hours worked, concentrate. You were there in the factory for 15,000 hours, no doubt in that. However, 700 was gone due to holiday. Sir, then why you are taking it as idle time? Sir, holiday, no. We are paying for that, no. They are not working. We are paying. How much? 700. Also, you are not producing 500 units, which you should have produced. You are getting paid, but due to machine breakdown, my employees are chilling. Some mechanic is repairing the machine. Everyone are standing and watching. For standing and watching, we have paid them money, no. How much we paid? Guys, relating to 500 units of exit sims. In 1 hour, we were planning to produce 10 units. For that 500 hours, how much was the budgeted hours? How much was the time given for that? 15 hours. That is also lost. So actual hours worked is equal to 14,250 hours. Actual rates 0.6. Actual rates rupees 0.6. Hope it's clear. No doubts. So everything you have now. Whatever the data is required, everything you have, you can apply that. This was 6B now. This was nice question. Nice question. Six B, no? 5. We got 14,300 only standard. Actual we got 14,250 only. Idle time 750. Done. Next. We'll do one thing. We'll take a lunch break and we'll proceed with this set. Like this mock test paper. Fine, no? (2:30) will start. Sure, sir. Correct. Fine, we'll start. December 23, set 1. May I know the question number? During a period, 13,600 labor hours were worked at a standard rate of rupees 8. Yeah. Actual hours 13,600. Standard rate rupees 8. Direct labor efficiency variance is 8,800. Adverse. They are telling standard hours minus actual hours into standard rate is coming to 8,800 minus adverse. Standard hours are less comparatively. What they are asking? They are asking you to find out how much is the standard hours produced. SH. So, can I write it something like standard hours we don't know. Let it be. Actual hours we know. 13,600. Standard rate we know. Minus 8,000. SH minus 13,600 is equal to minus 1,100. SH is equal to difference between standard cost and actual cost is called as. Shall we proceed? 15th one. Is this 15 by any chance? This is 14, ah. This should be 15 only, no? Next. Now listen. Standard material inputs requires 1000 kg of finished product are given below. That is, for 1000 kg you have to give an input of 1100. Standard. P 450, Q 400, R 250. Actual production is 20,000, which took so much. Very simple. Shall we do the quick table for this? Three materials are there. Huh? Which are those? Standard quantity, standard price, actual quantity, actual price, revised standard quantity. Correct? Huh? Now, standard quantities are, try to understand. For 1000 kgs, P you need is 450. Now actually we are producing 20,000 kgs. For that, question mark. 9,000. For 1000 you need 400. For 20,000, question mark. For 1000 you need 250. For 20,000, question mark. Hope it's clear. Standard price are 20, 40, 60. Actual quantities are 10,000, 8,500, 4,500. Actual prices are 19, 42, 65. Revised standard quantities are actual quantities 18,500, 19,000, 23,000 kgs in the standard ratio. Standard ratio are 9, 8 to 5. 9 is to 8 is to 5. 9 plus 8, 17, 17. Sorry. 1 second. 9 plus 8 plus 5, 22, 23,000 divided by 22. How much? 9,000? 409. Next. 8,364. Next. 5,227 kgs. Hope it is clear. How much is 23,000 divided by 1,100 into 450? Done. Fine. They have done it in different way. You just do it in a normal hour calculation. Next, next, set to December 23 MCQ 6 and 8. Which of the following would not be performance standard in operation? We have already discussed 6 and 8. Then labor mix variance they are asking. Certain process need a standard labor of 24 skilled labor hours and 30 unskilled labor hours, 60 and 40. Actual 20 and 25 labor hours were used 50-50. Then the labor mix variance will be, try to understand. They are not asking any actual numbers. Very simple it is. Try to understand. Actually, you are using two different kind of labors. But the thing is, you are paying them 50 rupees only. Correct? But standard, we wanted 24 skilled, 30 unskilled at the rate of 60 and 40. So, here, standard if at all you used, skilled if at all you used more for 50 hours, good it is. Unskilled if at all you used more, it is adverse. So listen here, how much is the total actual hours? 45. Hello. 45 labor, divide it in the ratio of 24 and 30. 4:5. 9. 9 into 4. Oh no, this is 4. This is 5. Total is 9. 45 divided by 9, 5, right? 5 into 4, 20. 5 into 5, 25. Correct? This is your revised standard hours. Revised standard hours. $20 hours is revised standard hours and actual hours are 20. Relating to skilled, there is no such variances. But coming to mix, relating to unskilled, revised standard is 25. Standard is, actual is 25. That is 40, right? Option C, 0. There is no variance. Got it? Next. Five. Manufacturing concern which has adopted a standard costing furnishes the following information. Standard material for 70 kg of finished goods is 100 kg. Try to understand. To get output of 70 kg as per standard, we have to give an input of 100 kg. Standard price is 1. So actually we are using 210,000 kgs where the, actually output is 210,000 kgs. Actual material is 280,000. So to get the output of 210,000 kgs, how much we should introduce? 3 lakh. So standard quantity is 3 lakh kgs. Standard price is rupees 1. Actual quantity is 280,000 kgs. Actual rate or actual price is 250,000 divided by 280,000. 0.9. If I am not wrong, this question we have seen in study mat. Next. June 24 MCQ. What is the labor rate variance if the standard hours for 100 units of output are 400 at 2 rupees and actual hours taken are 380. Rate variance they are telling 2 rupees 2.25 into actual hours 380. Standard cost of material for a given quantity of 15,000 while the actual cost of material used is 16,200. Material cost variance is 1,200 adverse. Next. Using the following information, calculate each of the 3 labor variances for each department. That is labor cost variance, labor rate variance, labor efficiency variance. Gross wages paid is there, standard hours produced, which means standard hours it is. Correct? Actual hours is also there. Standard rate is also there. Actual rate is 28,080 divided by 8,200, 19,370 divided by 6,395. Directly you can do everything. If at all you get it in decimals, I told you no. Better don't take it in decimals. Just expand the formula. You will arrive at AH into AR. Automatically, whatever the number is there, that only you take. Next. December 24, set 1. No MCQ. Question? This one, that study mate question, and also that standard hours produced I was telling, no? That thing it is. I mean, it won't worth 14 marks and all, but still. No, I mean, in examination also, if at all they give this kind of questions for 14 marks, you guys are lucky. The standard labor complement the actual labor complement engaged in a week for a job or as under standard number of workers in the gang, skilled, semi-skilled, unskilled, standard wage rate per hour, actual number of workers employed in the gang, actual wage rate per hour. During 40 hours work week, the gang produced 1,800 standard labor hours of work. What do you mean by this? Standard hours for actual output is 1,800. While telling theory, if you remember, I told you this. Standard hours produced means standard hours for actual output. That is 1,800. You have to divide that in what ratio, sir? You have to divide that in the ratio of skilled, semi-skilled, unskilled. You will get the standard hours. Skilled, semi-skilled, unskilled. Standard hours, standard rate, actual hours, actual rate, standard hours. Listen here. Standard hours they are telling we have produced 1,800 hours of work. Correct? 1,800 in the ratio of 32, 12, 6. That is 16, 6, 3. Sorry? Standard rates are 3 to 1. 3 to 1. Actual hours are 28, 18, 4, 28 into 40. 18 into 40. 4 into 40. Total of actual hours. 2000. Revised standard hours is nothing but actual hours in the standard ratio. Standard ratio we already know 16, 6 and 3. 1280, 480, 240. Actual rates are 432. Hope it is clear. Table is ready. You have to apply. That's it. Simple one. But you understood now this question difference. Next up. Set 2. MCQ 5. Praying that they should give it for 14 marks. Pray. In a period, 11,280 kilograms of material were used. Actual quantity 11,280. Standard cost 46,248. Material usage variance 492. That is standard quantity minus actual quantity into standard price 492 but negative because actual is more than standard. Adverse no. What was the standard allowed weight? That is standard quantity they are asking. Very simple. Standard quantity minus 11,280 into standard price is equal to minus 492. Standard quantity into standard price minus 11,280 into standard price is equal to minus 492. Standard quantity into standard price is 46,248 plus 492 is equal to 11,280 standard price. 492 I bought this side took that side. How much it is? 40? Who cares that? Answer I am asking. Don't take it as 5, it is S. 4. 4.14. 46,248 divided by 4.14. $11,000. I mean, might be rounding off things, that's it. Next, sorry, 5B. The standard set for material consumption was 100 kg. Opening stock 100 kg was there. Purchase made 500 kg. Consumption, actual consumption is 110 kgs. They are asking you to find out usage variance and price variance. 1. When variance is calculated at a point of purchase. At the point of purchase. First, usage variance. What is the formula for usage variance? Standard quantity minus into standard price. Standard quantity is 100. Actual quantity is 110. Standard price is 4.5, which will come to 45 adverse. Correct? Next, price variance. Standard price 4.5. Actual price 4.3, because they clearly told find at the point of purchase into 110. 20 favorable, right? Next, when the variance is calculated at the point of issue on FIFO basis, so this thing though won't change because the selling price is there, but here price variance 4.5 minus 4.5 relating to first 100 units, remaining 10 units, it is 4.5 minus 4.3, rupees 2 favorable, rupees 2 favorable. When variance is calculated on LIFO basis, 4.5 is standard, actual would be 4.3. Why? We bought 500. From 500 we will issue 110. After 500 issue is done, then we will go for opening LIFO into standard price. Actual quantity 110. Sorry. Favorable or adverse? Hope it's clear. No doubts? Next one. Standard price for a material is 20. Consumption is this we have already done, 500 into 20, 10,000. Next next one. This one also we have done. Next 5B or 6A? No. This also we have done already. Same question. Set. This also we have done. We got 10 hours. So 10 into 4, 40. Next. Same question. Fourth time it is getting repeated. This just now we have seen. Next up. So 2820 is the actual quantity. Standard cost is 11,562. Material usage variance 123 favorable, they are telling positive number, because I will be starting with standard quantity. So standard quantity into standard price 11,562 minus actual quantity into standard price is giving you 123. So standard price is equal to 11,562 minus 123 divided by 2820, 4.05 whatever it is, m plus 11,562 divided by MRC is equal to 2850. Option D. Next up. This is the same thing what they have given in the table earlier, if you remember. Try to understand. 40% of material A. Material B is 60%. A 40 will give, B 60 will give. Total 100 will give. However, loss of 10 is there, which means output you get is 90. That is, to get 90, you need to give a 40, but you are actually getting output of 360. 360, how much should be the A question mark? 160. So for 90, you have to give 60B. For 360, 240. This will be your standard quantity of A and B. Standard rates are 20 and 30. Actual quantity are 180, 220. Actual rates are 1834. Total is coming to 400. 400 in the ratio of 40-60, which will come to 240, 360. Revised standard quantity is 240, 360. Hope it's clear. Next up, set 13 MCQ. Which among the following is incorrect? Material mix variance is equal to RSQ minus AQ into SP. Correct. Material yield variance SQ minus RSQ into SP. Correct. Material mix variance RSQ minus AQ into what is the difference between A and C? D is the answer. SP minus AQ into SQ. What is that? They should only tell them. What is the formula actually? SQ minus AQ into next up. Material purchase 3000, value of material purchase 9000. Per unit it is rupees 3. Standard quantity for 1 ton of finished product you need 25 units. Okay. 2 rupees is the material per unit. Closing stock of material you are keeping closing stock of 50. Finished product during the period is 80. So to produce 80 how much you need? For 1 unit 25. For 80 how much you need? 2000 units is your standard quantity. Standard price is rupees 2. Actual quantity, try to understand. You purchased 3000. There was no opening stock. Still closing of 500 is there with you. That means your actual quantity is 2500. Got it? Actual price we know rupees 3 per unit. Purchase price. Next. That's all. With that we have completed standard costing. Hardly it took 1.5 hours. We'll start. Now we'll be revising budget and budgetary control. Basically, guys, what do you mean by budget? Budget is nothing but a statement in which we are going to keep the targets or set the targets, or basically it's a plan. It's a plan which will be there in terms of quantitative terms. Which will be there in terms of quantitative. That is, it can't be a qualitative one. It can't be just a statement. It should be having numbers in it. Quantitative statement for a definite period of time. It's for a definite or defined period of time. It is that particular statement we call it as budget, or in simple, future plan expressed in terms of numbers. Quantitative, I'm not telling amount. I'm telling numbers. Why, sir? What is the difference between amount and numbers? Numbers can be units also. Amount cannot be units. So budget can be prepared in terms of units, or budget can be prepared in terms of amount. Got it? Whereas the process of preparing this budget, we call it as budgeting. And because of implementing the budget, matching the actuals and taking the corrective functions and all, that thing we call it as budgetary control. Budgeting is the process of formulation of budget. Budgetary control is systematic process of planning, coordinating and monitoring the financial activities. Planning, coordinating and monitoring the financial activities, that we call it as what? Budget control. We call it as budget control. Got it? Guys, is forecast as well as budget same? No. Forecast talks about what might happen. Forecast talks about what? What might happen. Whereas budget talks about what should happen. Forecast talks about what might happen in future. Budget talks about what should happen in future. Got it? So forecast is concerned with the anticipation of the probable events, whereas budget is concerned with the planning of the event. Got it? Okay. Next up. Forecast may cover a longer period, whereas budget generally will be of a shorter period unless and until it is capital budget. Capital budget will be for a longer period. Forecast is just a tentative estimate. Budget is all about a target, fixed target. Forecast planning ends with the forecast preparation, where budget converts plans into action. Basically, budget starts once forecast ends. Specific to a business function, it is covering the entire business and it won't control, because it talks about what might happen. That's it. What should happen is the one which controls it. Okay. And what are the essentials of the budget, sir? It should be prepared for the definite period of time, and it should be prepared prior to the period starts. Then only it's called as budget. Otherwise, it will become actuals. And it should be in terms of quantitative or monetary statement, and it should be predetermined to attain specific objective. So benefits, all these things you see. Budget committee. Budget committee means the committee of all the managers generally. All the head of different departments will be there. All of them together we call it as budget committee, where they will sit together and they will prepare a budget for the organization with the coordination and all. And that budget committee is headed by budget officer. Generally it should be headed by CEO or MD, but they will generally delegate it to someone called as budget officer. Okay. Budget period, if it's a conventional approach, that is old approach, annual budget divided into 12 months, whereas flexible, it's a rolling budget, it keeps on updating, shorter budgets. Budget manual is basically, it talks about how the budget should be done, when scheduling, when budget should be prepared, when budget should be rolled out, for how many period it is, what and all aspects should be there, all those things. Who should be held responsible for budget? For their particular department manager. For example, sales department, sales manager will be held responsible. Budget control, same like a standard. First we will establish the budget, then we'll compare actuals with the budget, then we'll analyze why the variance is happening, and then we will take the corrective action. And if at all any updation is required in the budget, we will do that. Okay. What are the different types of budget, sir? Sales budget, this talks about sales volume as well as sales amount. Production budget, this talks about how many units to be produced during the period and cost of the production. Material budget, it talks about how much material required, raw material. Labor budget, requirement of labor. Overhead talks about allocation of overheads. Cash budget, projection of cash flows. And master budget consists of everything. Basically, it's a projected P&L, you can tell, master budget. Got it? Functional budgets like sales activity, production activity, procurement activity, like that. See, sales budget, production budget, purchasing budget, marketing budget, human resource budget, administrative budget, all those things. Cash budget is nothing but you will take all the cash projections. Generally, it should be like how the cash budget format will look like, sir. Generally, we'll take the opening balance of cash. For that, we will add inflows, projected inflows. We'll get the total cash available. From that, we'll reduce projected outflows. We'll get the balance. Got it? And also listen here, one more thing. Sales budget and all, how to estimate units to be sold, how many units we are going to sell, how to estimate that? Very simple, guys. Sales budget and production budget are relating to finished goods or raw materials? Finished goods. Sales budget and production budget are finished goods. That is, try to understand. Because we will sell or we will produce finished goods, no doubt in that, we will sell finished goods only. And starting point for any budget is sales budget. Because based on sales only, we will get to know how many units to be produced. Based on units, we will get to know how much is the raw material required. Based on requirement of raw material and other units, we get to know how much is the purchases to be made. How much should be the purchases and all. Got it? Procurement. So starting with sales. Now listen. Let's say opening we have 200 units. During the year we produce or we are planning to produce 1000 units. And at last we are planning to keep 300 units in closing stock. That means how many units we are planning to sell? Opening we already have 200 units and we are planning to produce 1000 units during the period, and 300 units we are planning to keep it as a closing. How many units we are planning to sell? 900 units. Very good. We are planning to sell 900 units. How, sir? Opening we had 200. For that we are adding what is produced during the period. So total is coming to 1200 units. But are we selling full 1200? No. 300 will be held with us only. So that will come to 900 units. So remember how to compute the sales quantity. That is units to be produced. Units to be produced. To that we are going to add the opening stock. We'll get to know how much is units available minus closing stock. We'll get units sold. Hope it is clear. Now listen. We are planning to sell 15,000 units during the period. How many units? 15,000 units during the period. And also we are planning to, or we have opening balance of 2,000 units. We have opening balance of 2,000 units. We are planning to keep 7,000 units. How much we are planning to keep? Not 7,000, 6,000 units. Now my question is, how many units to be produced? Very simple, guys. We are planning to sell 15,000 units. So we need 15,000 units, no doubt in that. Along with that 15,000, 6,000 we are planning to keep at the end. That means total we need 21,000 units. Just because we need 21,000, we don't have to produce 21,000. Why, sir? Because already opening we have 2,000 units. So moral of the story, 19,000 units is what you are going to produce. How did you arrive at 19,000? Sir, 15,000 is units to be sold. For that 6,000 is planning to keep closing stock. That will give us requirement. From that minus opening stock, what is available will show us how much to be produced. Got it? Let's say each and every unit will take 2 kg of material A and 3 kg of material B. So requirement budget, if you want me to do, it will be A and B. Now requirement budget will be relating to raw material, consumption budget. That is 19,000 units into 2 kgs, 38,000 kgs. 19,000 into 3 kgs, 57,000 kgs. Got it? This is your requirement. Now, just because this requirement is there, we are not going to purchase everything. What we should purchase, sir? Very simple. How much we are going to consumption. Also, after consumption, we are planning to keep closing stock. That will give us total requirement. Total requirement. We don't have to purchase total requirement. Why? We already have a opening stock. Hope it's clear. On the basis of flexibility, majorly we have two budget: fixed budget, flexible budget. What do you mean by fixed budget, sir? It is fixed for some level of activity. Finish. For example, if I prepare it for 80%, if I prepare it for 80%, fix, no change at all. It is fixed, no change at all. What do you mean by that, sir? For 80%, what is the budget? That is fixed. You can't change it along with your level of activity to compare and all. But flexible budget means, for example, you prepared for 80%. Now let's say you are producing only 60%. You can convert this 80% budget to 60% and you can compare this and this. You can compare this. So the budget which can change along with the level of activity, that budget we call it as flexible budget. Sir, but why fixed budget you can't change? Because fixed budget we don't divide it into variable, semi-variable, fixed and all. Because of which we can't find out for other levels. But flexible budget, what we will do is, we'll divide the total cost and all into fixed, semi-variable, variable. Variable, of course, it will change with level of activity. Fixed will remain same, irrespective of level of activity. And semi-variable, further we will divide it into, again, fixed and variable. Variable, fixed will remain same in this. That budget we call it as flexible budget. Okay, examiner's favorite. A fixed budget is a financial plan prepared for a specific level of activity or output which remains unchanged irrespective of a variation in the actual level of activity. Whereas flexible budget is a dynamic financial plan that adjusts based on the change in the level of activity or output. Got it? Something called as ZBB, zero-based budgeting is there. What is it? Or it is also called as PBB. Day before yesterday I told, hey, production, correct, production. That much clue I am giving. Very good. Production based, price based budget. Production based budget, no. Acting as if you haven't heard that word. What is PBB? Production based budget, your head. I haven't told production based budget. Production based budget, it seems. Priority based budget. Priority based budgeting, that is called as PBB. ZBB we also call it as PBB. ZBB is nothing but opposite of your incremental budgeting. What is incremental budgeting? Let's say material cost. Last time it was 1 lakh. This time what we will do, we'll just add inflation, etc. And for last time only we will keep adding it. That is your incremental budgeting. Whereas zero-based budgeting means base zero. What do you mean by that? You are going to start from scratch. You are going to start from scratch. That means for each and every rupee you ask for the budget, you should give reason. Got it? That is your zero-based budgeting. For example, if you are taking 10,000 from your parents last year, incremental, it will be like 11,000. Last year 10,000, this year 11,000. If at all they apply zero-based budgeting, then every year you should tell from rupees 0 till rupees 11,000 what you are asking, no? Why it is. You should tell this. Incremental budgeting is very simple. Last time 10,000, this time 11,000. Why that extra 1,000 is there? That's what will be addressed. But in zero-based budgeting, not from 10,000, it will start from again 0 only. It will start from 0 only. Hope it is clear. What are the features, sir? No assumptions from the past. Focus on decision making, priority based allocation, management participation will be there. All the steps and all you see, advantages or disadvantages, all those things. Performance budget means, guys, like generally government and all will use it. Why, sir? because here we will be not comparing our budgeted cost and actual cost. Here we will be comparing our budget with the output performance. We'll be comparing budget with the performance. Government won't compare. Okay, my NHI people won't compare. Okay, my cost became, let's say, 1000 crores. Is the standard cost? How much is actual cost? That thing they don't. 1000 crores. We plan to build 100 kilometers road. Is it really happening or what? Is that quality road is built or not? So we are going to compare cost with the output results. That kind of budget we call it as performance budget. Got it? These are the few things. I hope it's clear. Shall we see few questions? I think budget PYPs we didn't discuss, no? Right? That is not yet discussed, no? We'll discuss now then. No worries. Give me a second. Let me do a separate. Okay. June 23 MCQ. Which of the following is not potential benefit of using budget? More motivated managers, improved interdepartmental communication, enhanced coordination, more accurate external financial statements. More accurate external financial statement, because our budgeting and external financial statement has nothing to do. Correct? Next. 8B now. Hmm. 8B. Measures Jolly Limited manufactures a product X and Y during the year ended 31st March. By the way, what they are asking that you should check. Prepare a production budget and material budget showing the purchase cost of material for the year ended 31st March 2023. And raw material budget. Consumption budget. It is expected to sell 7,500 units of X and 37,500 units of Y at the rate of 60 and 32. The direct materials are A, B and C mixed in the proportion of 4:4:2 in the manufacturing of X and in the proportion of 3:5:2 in the manufacturing of Y. The actual budget inventory for the year as follows. Opening stocks, closing stocks they have given, anticipated cost they have given. First one they are asking is a production budget. Production budget means they are talking about finished product or raw materials. X, Y. Units to be sold. Units to be sold. How many units we are planning to sell, guys? 7,500 and 37,500. Correct? Add closing. Closing stock, how much we are planning to keep? Expected closing 2,000 and 3,500. Correct? So we need these many output. 9,500 kgs and 41,000 kgs. 9,500 kgs and 41,000 kgs. From that, if you reduce opening which is available, 1,500 and 3,000. That will give you units to be produced. X you have to produce around 8,000 kgs. Y you have to produce around 38,000 kgs. Correct? Hope it's clear. Now listen, raw material requirement. 8,000 you have to produce means if at all wastage and all they tell, this will be output. First you find out how much input should be given to produce 8,000 output. Then you should divide between A, B, C like that. For example, if they tell standard ratio between output input is 4:5. That means if you give input of 5, you will get output of 4. Now 4 means 8,000, 5 means question mark. You will get 10,000 kgs. That 10,000 should be divided between A, B and C. That will be divided between A, B and C. Now 8,000 will be, one more point was there. Thought of telling, but no. It will confuse you guys. That won't leave. Forget. Nothing will happen. Nothing. Think. Remove it. Basically, they might give again for the raw material also, they might give wastage further. Then here you found out wastage. Now that will be the output of raw material. For that input, how much again find out. If you remember that one material costing question, what we have done from the ICI material relating to that perishable goods. There. First the output raw material, output and input ratio was there. Then again the raw material ratio was there. Like that. Now listen. A, B and C. Right? A, B and C are in the ratio of 4:4:2 for the product X. So 4:4:2, 10, 800. 800 into 4, 3,200. 3,200 kgs of A, 3,200 kgs of B, 1,600 kgs of C. A, B, C. Got it? This 38,000 of Y takes 4:4:2, 3:5:2. Y takes 3:5. 3:1:2 now. 3:5:2. 3, 5, 10, 10. So 38,000, 3,800, 3,800, 11,400. 90? 19,000. 7,000. Got it? Now total requirement of A will be 3,200 plus 11,400. 14,600. 22,200. 9,200 kgs. What is this, sir? This is requirement. Consumption. Just because consumption is so much, are we going to purchase so much? No. Add planning closing stock. How much you are planning to keep the closing stock? 2,400, 5,800, 17,300. 2,400, 17,300 minus opening stock. Opening stock is 3,000, 2,500, 16,000. Got it? We'll get to know how many units to be purchased. 15,000, sorry, 14,400 kgs we have to purchase. $14,000. Okay. Next up. Next up. These many units to be purchased. At the same time, they are asking it in terms of value also. Purchase price for these are 1086. 1,40,000. Got it? Huh? These are your production budget as well as purchase budget. Hope it's clear. Which question it was? We got this answers only, no? No, no. Total purchase cost, how much you got? Just check. Hope it's clear. No doubt. Next question, please. What did I say? No, I was doing something. So I was like waiting for you guys to stop so that I can start. Easy Walk Limited produces and sells a single product. Sales budget for calendar year 2022 by quarters are as under. First quarter we are planning to sell 40,000, second quarter 48,000, third quarter 60,000, fourth quarter 72,000. Material cost question now. The year is expected to open with the inventory of 12,000 units of finished goods. Opening stock is 12,000 and planning to close with 16,000 units. Production is customarily scheduled to provide for 70% of the current quarter sales demand plus 30% for the following quarter sales demand. The budgeted selling price per unit is rupees 40 and variable cost is 35. Fixed overhead is 4,40,000 which are evenly distributed throughout the year. Required. Prepare a quarterly production budget for the year. Calculate which quarter it is expected to break even. Okay. So, listen. Simple question. Simple question. Very simple. Very, very simple. We'll send both of you out now. Will send out. No justification required. Quarter 1, quarter 2. Chatre. Units to be sold. How many units we are planning to sell, guys? In each and every quarter. Quick. If for some reason I shared that material, okay. Huh? 72,000. Okay. We are going to add closing. But listen here. Closing, what they are telling. We are planning to wait. They are talking about production only directly, right? They are telling we are planning to produce. Very good. We are planning to produce 70% of the current quarter and 30% of the next quarter demand. Correct? So, directly production only I will find out. Production. 70% of current quarter. 40,000 into 70%. 70 or 75? 28. And 30% of next quarter. Total? 45,400. Got it? Second quarter, 70% of 58,000. 40,600. 30% of 60,000. 58,600. Got it? Quarter 3. 42,000. That is 70% of 60,000 and 21,600. How much? 63,600. Sorry? But you know, by any chance, do you know the next quarter sales? So what you can do? What you can do? So try to understand. Opening stock they have given. Quarter 1. How much? Hey. Opening stock how much they have given? 12,000, no? So 12,000 opening was there. Correct? We produced 45,400. We sold 40,000. So how much was the closing for the first quarter? 17,000. Now 17,400 was opening in second quarter. Produced 58,600. Sold 58,000. 18,000. 18,000 was opening in the third quarter. Produced 63,600. Sold 60,000. 21. We opened with 21,600. We produced how much we don't know. But we sold 72,000. Net we are left with closing of 16,000. Closing of 16,000. How much it is? 16,000 plus 72,000, 88,000 minus 21,600. 76,400. We are planning to produce 76,400. Anyone, any doubt in this production? Hello. $66,400. Hope it's clear. Next, what they have asked? Calculate the break even, right? That is very simple, guys. Normally find out a break even. What do you mean by break even? Where the cost is equal to revenue. Now, if you sell X number of units, let's say you will be able to achieve break even. So sales at break even will be 40x, 40 rupees into x number of units, 40x. Cost also will be equal to variable cost of 35 plus fixed cost of 4,40,000. X is equal to 440,000 divided by 5. 88,000 units. Correct? Now try to understand. First quarter we are selling 40,000. Second quarter we are selling 58,000. Total is 98,000. Which means by the end of second quarter we will be able to make break even. Understanding? When you sell 88,000 units, it will become break even. In the first quarter we sell 44,000. Second quarter 58. That means 98. Over and above the break even. So in the second quarter we will be able to complete break even. Hope it's clear. 7A, right? Did we get this? 42,400, 51,600, 63,600, 66,400? Correct. And break even point will be achieved in second quarter. Hope it's clear. No doubt? Pakka? We'll proceed. Which one? This one. What you will understand in this? Then, oh, you are writing? Right. As if, why you should not write? As if we are not doing marathon. Right. I mean, right. Right, madam. Regular class, if you don't write, when will you write? In marathon, you will write. In marathon, you can't write. Why? It's called revision, no? So in regular class only you should write. Right. Regular class is going on, no? Done. Next up. If the organization has all the resources it needs for production, that means there is no key limiting factor. Then key limiting factor will be what? Sales demand, no? Just because you have resource, you can't produce how much ever you want. You will produce only relating to demand available. Correct? Thank you. Next up. 7. Place. You know, right? What is place? Order place. Chinnu chinni. Couples. This is chinni. Huh? Concentrate. I don't know actually. Last 15-16 days, the sweating in hand and all wasn't there at all. Now I'm sweating like crazy. I don't know whether it's cursing or all of the sudden environment changed. Seriously, my hands were sweating when I was in 10th, 11th. What's she telling? Relevance? No, what is the relevance?
We see from the what? 50 days we said that next month
If you cut like this, hand blood only might start. You never know. Thursday is what?
we will not touch it. We will be for
Jack and Johns Limited submits the following budgeted figures of revenue and expenditure for the month of July. Okay. Sales, purchase, wages, expense. The following further information is available. 10% of the purchases and sales are on cash basis. Advance payment of income tax in the month of December is 2 lakh. Plant purchased and price to be paid in the October is 80,000. Time lag, credit sales 2 months, credit purchase 1 month, wages half month, expense half month. Prepare a cash budget for 3 months starting from October. That is October, November, December they are asking. When the cash balance was 2,70,000. October, November, opening balance of cash. In the month of October, how much is the opening balance of cash? 2 lakh. Correct. For this, we are going to add cash receipts. Cash receipts. First one we are going to take is cash sales. Try to understand what they are telling about cash sale. About cash sale, they are telling that 10% of the sales is cash sale. 130, 140, 150, 160, 1... Who cares? For us, it starts from 160, 164, 178. October 160, November 164,000, 1. Hope it is clear. Credit sale. Huh? Oh, I wrote only 1,64,000. Sorry. I thought cash sale is just 10% of sales. My bad. So, credit sale is 2 months. That means in the month of October, credit sale of August will be collected. In the month of November, credit sale of September will be collected. In the month of December, credit sale of October will be collected. Correct? So, how much was the credit sale of August was? 14 lakh into 90%. 15 lakh into 90%. 16 lakh into 90%. This is what we are going to collect in the month of October, November, December. Hope it's clear. 12 lakh 60. 13 lakh. 14 lakh. This is collection from. Very good. Creditors, right? Because they will give goods also, they will give money also. That only happens in dowry. Bride as well as money. Here, you give money, they will give goods. So, debtors it is, not creditors. Done. Purchase what they are telling, that is outflow, leave. Any other inflow is there, just check. No other revenue? Seriously? Done. So, first year, how much is the cash balance? I mean, not cash balance, cash available. How much? Minus cash payments, right? We'll start from cash purchases. Okay. 10% of the purchases are cash purchases. 96,000, 80,000, 1 lakh. 96,000. Oh, that was 9 lakh 60, no? I wrote 96,000. Now, what they are telling about credit purchase? 1 month credit. That means September month it will be paid in the month of October. October month it will be paid in the month of September. November month it will be paid in the month of December. So 9 lakh into 90% will be paid in the month of October. Payment to debtors, right? Yes. 9 lakh 60,000 into 90%. 8 lakh? 8 lakh into 90%. Hope it's clear. Next up, wages. Half month credit period. What do you mean by that, sir? In the month of October, October month half will be paid. Other half will be paid in the month of November. That means same thing we applied in September also. Half of the September month is paid in September. Other half is paid in the month of October. So in October, how much we are paying? Half of October, half of September. 6 lakh 60 into half, 330,000. Understanding? In the month of November, how much we are paying? Half of October, half of November, 360,000. In the month of December, we are paying half of November, half of December, 760, half of that, 380,000. Correct? Next, expenses also half month. What do you mean by that? Half of September, half of October will be paid in the month of October. Half of October, half of November will be paid in the month of November. Half of November, half of December will be paid in the month of November. Sorry, December. Hope it's clear. Next. Advance payment of income tax. Sir, that's asset no, sir. Who cares? Outflow, no? December, 2 lakh. Hope your cash flow, you remember cash flow statement accounting wasn't there? Huh? Corporate accounting. AS3. AS3 wasn't there. PP, POP, POP, POP that they will put to hand, no, plaster of Paris. PP, AS10. Huh? It was too rush. I went and I just found some way out. Except Kadlekai, everything was there. Hardly I saw 3 to 4 shops. All other clothes, bags. These kids. Plant purchased and price to be paid in the month of October, 80,000. Next. That's it now. Find out the closing balance of October fast. First one how much?
14,36,000.
Not total balance. 2 lakh. So opening balance is, cash available is, huh?
68,000.
Balance. Cash available. Balance. 3 lakh 80. Hope it's clear. Akka. 7, you know. Anything else is there? Or to whom? Chinni? She gave no. At least for me, though, now it's not possible. You are in which year of degree? Third sem. For you also not possible. 15, 21 years is the legal age, no, to get married. ಅವ್ರ ಮನೇಲಿ ಅದಕ್ಕೆ ಕಾಯ್ತಿದ್ದಾರೆ 21 ಆದ ತಕ್ಷಣ. The budget that is prepared first of all is, very good, budget with key factor. First we will find out maximum how much we can achieve, no? Based on that, to achieve that, what is required will be done. Generally sales budget, if at all any restrictions are there, that will be done first. As per sales, demand is 1 lakh, but production could be possible is only 90,000. That means you will start with 90,000 or 1 lakh. Ask them to get face ID card, fake ID card. They will helping you. You will go and sign, as a witness. Okay. See, sir, witness is also there. From which side? Chinni side or Chinnu side? Question number 7A, right? Court side. Go ahead. A department of Sonex Limited, a manufacturing company, attains sale of 6 lakh at 80% of its normal capacity, 4 lakh 80,000. Correct? Oh, sorry, 6 lakh is the 80%. That means 100% is 7 lakh 20,000. 7 lakh 20,000. Its expenses are as given. Office salary 90,000. General expense 2% of sale, whatever it is. What they are asking? They are asking you to prepare a flexible admin, selling and distribution cost, operating at 90, 100, 110 of the normal capacity for the month of September. Okay. All fixed costs are assumed to be remain unchanged even if it is 110% of. So 3 levels they are asking, right? 100, 90, 100, 110. Correct. So, how much is sales at 80%? 6 lakh. At 90%? Very good. 6 lakh? 75,000. At 100%? 7 lakh 50,000. At 110%? Sorry, not 9 lakh. 8 lakh 25,000. This is your sales. Correct? Now listen. Office salary 90,000 will be fixed irrespective of the level. Correct? General expense 2% of the sales, which is 675,000 into 2%. 13,500. Depreciation 7,500 irrespective of whatever it is, it will be 7,500 only. Correct? Rent and rates also it will be 87. Huh? This is your administration cost. How much is the admin cost? One lakh? 1 lakh? 1 lakh? Got it. Selling. Salary is 8% of the sale. Seven lakh 50,000 into 8%. 8 lakh 25,000 into 8%. Travel expense 2% of the sales. Sales office 1% of the sales. General expense 1% of the sale. That's it, no? Selling. Selling, may I know how much it will be? 81,000. Hope it's clear. Distribution we'll see. Wages 15,000. Rent 1% of the sale. Other expense 4%. 27,000, 30,000. Distribution cost, please. Uh, 250 now. Hope it's clear. Clear? Admin, how much we got? 119 750, 121 250, 122 750. Selling 81 90 99. Direct expense, sorry, distribution expense 48 750, 52 500, 56 250. Correct. Next up. 14, not 14.
No, sir. No MCQ.
Sure. Practical problem, please. 3 and 5. Which of the following budget recognize the difference between fixed, semi-variable, flexible? Next. More accurate external financial statement. An examination repeated. Crazy. 7.
Already given, but with anticipated values differently. Similar sum we did in the big
Similar sum we have done. We'll do it again. No. Regular class, no, we'll do it if it's repeated also. When we do revision of this, that time let's not do this. Next time we'll skip. Similar we have done, no? There I think it was half of this. 10, 8 and 6. Here it is 20, 16, 12. Correct? Okay, we'll proceed. I think PYP everything is done. I don't know, I will go to hell only. MCQ 5 Correct. Smart. Next. Compute and estimate the profit of the factory at 60% and 80% of the working and offer your comment. So basically they are asking you to do flexible budget, that's it. Factory is currently working at 50% of the capacity, producing 5,000 units. At 60% it will become 6,000, at 80% it will become 8,000. And right now the cost is rupees 90 per unit, house sir, material 50. So that will be variable in nature. Correct? Labor 15, fully variable. Factory overhead 15, in that 6 is fixed it seems. So 6 into 5,000. So 30,000 is the fixed factory cost. Variable is rupees 9 per unit. Correct? Administration overhead 5 is fixed. 5 into 5,000. Rupees 5 per unit is variable in nature. Got it? Current selling price is rupees 100. At 60% working, material cost per unit will increase by 2%. Selling price will fall by 2%. At 80%, material cost will increase by 5%. Selling price by 5%. Compute and estimate the profit. They're asking 60 and 80, right? Why you are doing all these things? In nursery school, you should not do all these things. If you do in nursery only like this, after you growing up, at the age of 20, 21 and all, what you will do? Let's assume you join some CMA class, some professional course. In that classroom also you do like this only. Tomorrow bring your parents, okay? And now show your hands. Where is the stick? Small kids or what? Huh. 50 rupees right now it's there. Correct? Ah? But if at all you work at 60%, per unit it will be increased by 2%. How much it will be? 51 ah? 51 into 6,000. 3 lakh? 6,000. If at all it goes to 80%, it will increase by 5%. 52.5. How much is 8,000 into 52.5? Labor rupees 15. So 15 into 6,000. 8,000 into 15. Variable cost 9 per unit. 9 into 6,000. 8,000 into 9. Fixed overhead. Fixed factory overhead actually. That is 30,000, 30,000. Huh? Sorry? Admin overhead 5 rupees per unit. How much admin overhead? Variable admin overhead 5 rupees per unit. No. 5 into 6,000. 25,000 each. No. Next. That's it. How much is the cost? Total cost. Five lakh and 7 lakh 7,000. Sales. Try to understand. Selling price, if at all you increase your production to 60%, will fall by 2%. Right now it is 100. So if it's fall by 2%, it will go to 98. 98 into 6,000. 5 lakh. If at all it falls to 80%, it will fall by 5%. So rupees 95. 95 into 8,000. Correct? This will be A. This will be B. Profit. A minus B na, B minus A na? 53,000. 53,000. Hope it's clear. Next up. Hmm? 7, This we have done in study mat, if you remember. Advertisement, it's fixed. Salary is fixed, expenses fixed. What they are asking, required to prepare a selling overhead budget from the estimate given below for the following sales. First, when the sales are 80,000, how much? 90,000, how much? 1 lakh, how much? When the sales are 80,000, 90,000, 1 lakh. Correct? First, advertisement, that will be fixed. 1000. Correct? Expenses of sales department will be fixed. 1000. Salaries also fixed, expenses also fixed. So 750. Salesman remuneration 3000. Sales commission 1% on sales excluding agent sale. First one, sales excluding agent sale is 80,000 minus 8,000, which is basically 72,000. Of that, 1% is 720. 90,000 minus 10,000 is 8,000. 8,000 into 1% is 800. 1 lakh minus 10,500 is 89,500. Of that, 1% is 895. Correct? Next. Carriage outward 5% of the sales. So 80,000 into 5% is 4,000. 90,000 into 5% is 4,500. 1 lakh into 5% is 5,000. Agent's commission 7.5% on agent sale. 8,000 into 7.5% is 600. 10,000 into 7.5% is 750. 10,500 into 7.5 is 788. Total cost, please. Please don't take this 80, 90, 1 lakh. That is sales. 1,000, 2,000, 2,750, 5,750, 9,750, 11,000, 070. 4 calculated. Done. Hope it's clear. Next, sales budget is a functional budget. Sales function. Next. No MCQs.
Only one like that.
Monthly budget for manufacturing overheads of a concern of two levels of the activities are budgeted production are 600 and 1000. Okay. Inspect which of the items are fixed, variable, semi-variable. Prepare a budget at 80% capacity. Compute total cost, both fixed and variable per unit for 1800 and this one. Very simple. You know that fixed cost total will remain same irrespective of level of output. Variable cost total will change and per unit will remain same irrespective of output. Semi-variable, it will be total will also be changing, per unit also will be changing. First one, wages, you can see that for 600 it was 1200, which means per unit it was rupees 2. For 1000 it became 2000. Again per unit it is 2. Moral of the story, wages is variable cost. Consumable stores, for 600 it was 900, which means 1.5 per unit. For 1000 it was 1500, again 1.5 per unit, that is also variable cost. Maintenance 1100 for 600 units. How much? 1.8? 1.83. 1500 for 1000, which is 1.5. Moral of the story, total is also changing, per unit is also changing, it is semi-variable cost. Power and fuel, for 600 it was 1600. So 1600 divided by 600 per unit 2.6. 2000 divided by 1000 is 2, which means that is also per unit is also changing, total is also changing, semi-variable. Depreciation 4000 fixed. Insurance 1000 fixed. Total cost 9800, 12,000. Variable or semi-variable? 9800 for 600. 12,000 for 1000. Fast. Is it fixed? Is it variable? That is total. Hope this is clear. Next, prepare a budget for 80% capacity. Very simple. 80% capacity they are asking. wages, guys, per unit we got to know it is 2 rupees, correct? At 80% capacity we will be producing 800 units, correct? No, so 800 into 2, 1600. Consumable, we know that per unit it's 1.5, so 1200. Maintenance, try to understand semi-variable. Whenever it's a semi-variable, you have to segregate between fixed and variable. How, sir? We know that variable cost per unit, yesterday also I told, if you remember, that is change in cost by change in output. Change in cost is 1500 minus 1100, 400. Change in output are 1000 minus 600, 400. Which means here variable cost is rupees 1 per unit. So you can apply that to either 1100 or 1500. Let's apply to 1000, it will be easy. 1000 into 1 is 1000. So out of 1500, 1000 is the variable cost, means fixed cost is 500. Got it? Now, if the fixed cost is 500, for variable for 800 will be how much? 800 into 1 is 800. 800 plus 500 is 1300. Maintenance, hope it is clear. Clear? Power and fuel. Change in cost, that is 400. Divided by change in output, 400. Rupees 1 per unit. Let's apply it to the 1000 units. So variable cost is how much in 1000? 1000 into 1, 1000. But total cost is 2000. That means fixed cost is 1000. So cost for our power and fuel will be 800 into 1, 800 plus 1000, 1800. Depreciation. Change in cost is how much? Total. Don't take that 800, what I have written above, that is number of units. 1600, 2800, 3100, 4100, 4900, 5900, 10,900. Hope it's clear. These three they only have computed and given, so you have to repeat it. That's it. Third one. Next one. Eleventh MCQ. Flexible budget requires careful study of fixed, semi-variable, variable. Next, 5B. After this, remind me, sir, some ICI material foreman commission question you remind me as. 5. Prepare a sales overhead budget for the month of January, February, March from the estimate given below. Advertisement, salary, expense, this thing and all is fixed. How much it is? $15,000. Salesman commission is 2% on their sale. Traveling salesman commission is 10% on their sale, and expenses at 5% on their sale. Sales during the period. So salesman commission, salesman will be, of course, will be doing sales in counter sale, and traveling person will do in a traveler salesman sale. So for the January month, commission for the salesman will be 2% of their sale. That is 1 lakh into 2000. Sorry, 2%, 2000, 3000, 3500. Correct? At the same time, expense will be 5000, 7500, on their sale. Only traveling it is, right? Traveling salesman commission is how much? 10%. 2000. Expense will be 5% on their sale. 1000, 1500, 2000. Hope it's clear. This will remain same, 15,000. Plus this, plus this, plus this. Hope it's clear. Next up. Sales budget is a functional budget. Huh? Prepare a cash budget for 3 months. They have given credit term, sales or debtors, 10% of the sales are on cash. Okay. 50% of the credit sales are collected in the next month. Remaining 50% will be collected in the following month. Try to understand. For example, they are asking you to 3 months budget ending June, May, April. So April months, try to understand. We are going to collect March month as well as Feb month's credit sales. In Feb month, how much was a credit sale? 14,000 into 90%. 12,600. Correct? In this 12,600, 50%, 6,300 will be collected in the month of March. Remaining 6,000 will be collected in the month of April. And so April collection 6,300 will come relating to Feb month. At the same time, March month, how much is the sales? 15,000. Credit sale is how much? 13,500. Correct? Of this 13,500, 50% will be received in the month of April. How much it is? Remaining 6,750 will be taken in the month of May. Like this it is. You can do that, right? Creditor 2 months. That is, whatever we purchased in the month of February, that will be paid in the month of April. Purchased in the month of March will be paid in the month of May. Purchased in the month of April will be paid in the month of June. Wages 1/4 month. That means 3/4 will be paid in the respective month. 1/4 will be paid in the next month. What do you mean by that, sir? March month 3/4. 2250 will be paid in the month of March only. But 750 will be paid in the month of April. So in April, how much will pay? 750 of March and 3/4 of April. In May month, how much will pay? 1/4 of April, 3/4 of May. In June, how much we will pay? 1/4 of May, 3/4 of June. Hope you understood. Overheads, it is half month. What do you mean by that, sir? March month half will be paid in April. April month half will be paid in April. April month half will be paid in May. May month half will be paid in May. May month half will be paid in June. June month half will be paid in June. Cash balance opening is 6,000. Other relevant. Plant and machinery will be installed in the month of February at 96,000. Monthly installment of 2,000 payable from April onwards. So April, May, June. 2,000, 2,000, 2,000 will be outflow towards installment. Dividend of 5% on preference share capital of 2 lakh, which will come to 10,000 to be paid on 1st June. So June month 10,000 outflow. Advance to be received 9,000. June month inflow 9,000. Dividend from investment amounted to rupees 1,000 are expected to be received in June. So June inflow 1,000. Hope it's clear. Next up. MCQ. Dash budget is prepared out of all budget. Sales budget, assuming it is the key factor. Next up. When the company wants to prepare factory over budget in which estimates are directly derived from the estimates of activity levels. Flexible budget. 5B now. This we have done now. Same question it is. Next up. No MCQ? 5B now. Prepare a master budget they are asking. Sales you will take, guys, 80 lakhs in total. Okay. From sales, of course, they are asking you to present the fixed and variable overhead separately, which means sales minus variable cost, contribution minus fixed cost, profit. That way you should show. Okay. Direct material cost, of course, it's a variable, 60% of sale, 80 lakh into 60%. Wages, 20 workers, 1500 per month. Huh? 30,000 into 12, no? That is per month, 1500 per month. So 30,000 per month into 12, 3,60,000. Variable it is. Correct? Factory overhead and indirect labor. Works manager, 5,000 per month. Fixed it is. Remember. 60,000, but it's fixed. Foreman, 4,000 per month. 48,000. Fixed. Stores and spares, 2.5% of sales. 1,20,000. Sorry, 2 lakh. 2 lakh, it is variable. Depreciation on machinery, 126,000 fixed it is. Light and power, 50,000 fixed it is. Repairs and maintenance, 80,000 fixed it is. Other sundries, 10% of direct wages. Direct wages is 3,60,000. So 10% of that, 36,000 variable it is. Admin, selling and distribution, 1,40,000 into 12. Sorry, 1,40,000 only directly. That is fixed. Just that's it. Presentation it is. B. Sales 80 lakh minus direct material, direct wages, factory overhead. That is the variable are stores and spares, light and power, repairs and maintenance, less your foreman salary, depreciation, sundries, etc. You will find out profit this way. Okay. Just you can do it like sales minus variable cost minus fixed cost. Just to go through once. Generally they won't ask that because they haven't given one single master budget question in your study material. Next. Dash is the first step of budgetary system and all other budget depends on sales budget. Dash is known as a subsidiary budget, functional budget. Subsidiary means segregated into small. So sales budget, production budget, purchase budget, like that. Got it? Next. 7A. A factory engaged in manufacturing of a plastic toys is working at 40% capacity and producing 10,000 toys per month. If at all it works at 100%, then it will be producing how much? $25,000 toys per month. The present cost breakup is as follows. Material, labor, overhead, 5% is there. Of that, 60% is fixed. That means 3 rupees is fixed. So 3 rupees into 10,000. 30,000. Fixed overhead is how much? 30,000 per month. Variable is rupees 2 per unit. Selling price is 20. If it is decide to work at a factory at 50% capacity, selling price will fall by 3%. At 90%, selling price will fall by 5%. Similar price fall in the material cost. You require to prepare. This we have already done. Similar one only. But listen here. Majority of the time, what we have observed in classes, you guys have done mistake in that one. Which one you remember? They don't give material cost like this. They will give 10,000 into 10. Directly they will give 1 lakh. Directly they will give 1 lakh. Now, when you go to produce at 50%, what you will do? You will take 3% less. No. Directly what you will do is 1 lakh minus 3%. Which will become wrong. Why? First material adjustment to be given relating to units. Then you should give for price fall. That is 1 lakh is for 10,000 at 50%. That is 12,500 question mark. You will get it as 1,25,000. Correct? Now 1,25,000 plus 3% you should do. Hope you guys are able to understand. First you should adjust to the units, then you adjust to the prices. Every time whenever we discussed, you have done this mistake, if you remember. Don't do that mistake. Only fixed you can take it directly. Variable always you should adjust to units. Then you come back to this one. Got it? Next. Which is not a limitation of ZBB. It is a very detailed procedure and naturally it is time consuming and lot of paperwork involved in the same. Correct? Cost involved in preparation and implementation of this system is very low. No. Because here many people are required to be hired to do that every time. ZBB. So cost associated is not very low. It is, which is high. Morale of the staff will be low as they feel threatened if a particular activity is discontinued, of course. Ranking of activity and decision making may be subjective at times. Correct. Like priority based, which one to be prioritized? It's subjective in nature. So cost involved in preparation and implementation is not low, it's high. Budgets are shown in terms of qualitative, quantitative, materialistic, both B and C. Both B and C. Materialistic as well as quantitative, not qualitative. Next. The Barker company has two model of adding machine A and B. The following production and sales data. A and B is there. Estimated inventory, opening, closing, expected sales volume. Prepare a sales budget and production budget. This is very simple. Production budget will be nothing but sales units plus closing stock minus opening stock. Sales budget will be nothing but expected sales, selling price, multiply, finish. That's it, right? But listen, this one thing adjustment didn't come, but now only I will tell. Let's say that I will tell. I say foreman, I will tell. Listen. Labor efficiency related stuff. Right now, laborers are working at 100% efficiency, let's say. Next, laborers will be working at 115% efficiency, they will tell. Right now, we are producing 60,000 units. In future, we will be producing, let's say, 120% over and above what we are producing now, that they will tell. And labor cost will be increased by 5%, they will tell. These many things they will tell. Okay. Now listen. And by the way, right now the labor cost, let's say it's around 1 lakh. Now, how much will be for the further 120%? Understanding? These questions we have seen, no? Majority of the places, institute has wrong answers, except last two what we discussed yesterday. Now what you should do, sir, try to understand, guys. Last year when we were working at 100% efficiency, our labor cost became 1 lakh. But this year efficiency will be increased by 15%. That means try to understand. Last year to produce 100 units we took 1 lakh, no? This year, not to produce 100. This year to produce 115 we are going to take 1 lakh. But we are producing 120, for which how much we will take is the question. I hope you understood this efficiency related stuff. How much? 1 lakh? 347. Plus cost will increase by 5%. This will give us labor cost. 1,09,560. Sir, what if efficiency falls, sir? What if efficiency falls? They are telling efficiency will decrease by 15%. Then what you should do? Very simple. Last time we will take 100 only. At 100, we were producing the number of units at 1 lakh. But with the same 1 lakh, this time we won't be producing 100. We'll be producing at 80% of our efficiency. We want to produce 120%. How much it will be? plus 5%. 235. Hope it's clear. Pakka. Now listen. They might also tell this way. Last time we were operating at 95% capacity. This time we'll be operating at full, like efficiency will be full. Then what you should do? Last time try to understand. 1 lakh we incurred for 95 only. This time 1 lakh we will be incurring for not 95 but for 100, for 120 question mark. Like that we will check. Later you should add this. I hope that efficiency in class enough times I have told. Hope you are able to link it to that. Correct now? Fine. And one more ICI material, guys. I expect you guys to, if time permits, go through this question once. Okay. I don't know. I'm getting that feel, strong feel that soon your institute will ask this particular question in examination. Is it, sir? Which question? You know, right, from where to like download ICI material? Go to the study material section. Here, cost and management accounting, module 2, budget and budgetary control. Illustration number 3. Guys, illustration number 3. Go through this, okay? It's a flexible budget actually. You have to compare it with, first see, they have given normal month expense. Planned for January they have given, because January we planned for more number of units. I will just give a idea about this particular question, okay? First they have given for normal month. But in the month of January, we plan for the more number of units because we get the order. But actual in January, that order will get cancelled, because of that will fall less than normal. Now, normal month and January, you are going to compare to find out which is variable, which is semi-variable, which is fixed. Using that, you will find out for the actual number of units in the month of January. Actual cost for the actual output they have given. For that, you are going to find out budgeted. Now you are going to compare budget and actual. You will get savings or you will get extra cost. What our foreman is telling is, as there is a savings, you have to give me commission. But what our manager is telling is, boss, we lost a like big order. Why we should give a commission? So whether conflict of manager and foreman is correct or no, that is the thing. Basically, it's a question of your flexible budget. Okay, that's it. But you go through it, you got the idea, right? 2 budgets they have given. Try to understand. In normal month, we will produce 8,000 units. So that expense for normal month is relating to 8,000 units. In January, we planned for 10,000 units. So that January month is for 10,000. So using that 8,000, 10,000, you will get to know which is variable, which is semi-variable, which is fixed. But what happens in January, actually only 6,000 units will be produced. Now what you should do, you should find out or you should prepare a budget for 6,000 units. Now budget for 6,000 units is there, actual for 6,000 unit is there. Compare budget and actual. Find out adverse favorable. Because we told our works, this guy foreman, that he will get a bonus of 10%. If at all he brings us any savings, means cost less than budgeted cost. That thing, simple question only. When you read it, you will understand it. Okay. But please go through this once. Illustration number 3. If you want to take photo, you take photo only. Ayyo, I can't zoom out. Answer if you want. Take out. 10.27. That is 15th chapter, 27th page. Hope it's clear. With that, we have completed our discussion on budget and budgetary control. Now we are left with how many chapters? Marginal, process, cost bookkeeping. So we'll take a break now. We'll take a break of 25 minutes. Sufficient now? Last break we took it lunch break, no? Fine then. 25 minutes required. 23 minutes you take. 5:35 will start. Now we'll start process costing revision. Yes? Okay. Listen. Guys, process costing is also method. Okay. It's also method of costing, sir. But when we will apply it, sir, we will apply it basically when our final products goes through different process. Final product goes through multiple process. In that scenario, we are going to apply process costing to ascertain the cost. For example, ghee. From milk, it has to get into butter. From butter, it has to be converted to ghee, right? Milk to curd to butter to ghee. Or sometimes they will do directly, right? Ghee. They will take out that malai and whatever it is. Leave. So process will be there, no? There we will apply process costing. Or any furniture and all. If it's a mass production, first one that designs will be prepared for that, then assembling will take place like that. So in case of process, all these are going to be in the process. Okay. Vehicle manufacturing. First chassis will be there, then the engine will be fitted, then all the interiors will be fixed, painting, all these things. It will go through process. There we are going to apply something called as process costing. So output of one process shall be the input for the next process. Keep that thing in mind. For example, if you are producing sugar, first process, sugar cane you are going to crush. You are going to take sugar cane juice. That will be your process 1. Process 2 is filtration of that juice and boiling of that juice. Process number 3 is then converting that into sugar. Now process number 1, we extract sugar cane juice. No, that itself is output of process 1. At the same time, that itself is the input of process 2. Because we have to boil the same sugar cane juice. For process 2, whatever the input is there, that itself is the output of, output of process 2 will be input of process 3. Like that. Got it? Output of process are treated as a WIP till the finished goods are not produced. Guys, losses, remember, 2 type of losses are there. Normal loss, abnormal loss. How to treat the normal loss, sir? Normal loss will be added to the cost of good units. Abnormal loss will be charged to costing P&L. Correct? Scrap recovery, it could be relating to normal loss or it could be relating to abnormal loss. If it is relating to normal loss, what you should do, you should reduce it from the cost of production while arriving at cost per unit. Whereas if it is relating to abnormal loss, then you should charge it to costing P&L. You should credit it to costing P&L. Correct? So, costing P&L. But generally what we will do, we'll credit it in the abnormal loss account. Net amount we will take it to the costing P&L. What do you mean by abnormal gain, sir? Loss when it is less than expected loss. Loss when it is less than expected loss. That loss which is saved, that thing we call it as abnormal gain. Or in fact, if at all your actual output is more than expected output, that thing we call it as abnormal gain. For example, 10,000 is an input, normal loss is 10%. That means output we are expecting is 9,000. Let's say output came 9,400. Now that extra 400 units we call it as abnormal gain. And always remember one thing, guys. Whatever the material we introduce in process 1, no, that is the primary material. That is the primary material. So after that, whatever you are going to introduce, all those are secondary materials. Because of that, our output don't increase. What you introduce in process 1, that itself is primary material. Sir, in process 2, what if we introduce? You can't introduce in process 2. For example, you are a sugar manufacturer. Sugarcane should be introduced in process 1. Sugarcane is a primary material. Now, along with juice, you might add some chemicals in the process 2. That will not increase or decrease your output. But can you add sugarcane directly in process 2? Along with sugarcane juice, can you boil the sugarcanes? No. If that is the case, if you can add it in the process 2, then why the hell you will do process 1? Correct? No. So keep one thing in mind. Your main material won't be introduced in the further process. It will be introduced only in the main process. Got it? And remember, this is very important. How to find out a cost per unit? Guys, cost per unit is nothing but total cost minus scrap recovery from the normal loss. Divide it by units introduced minus normal loss units. What? Total cost minus scrap recovery from normal loss. Divide it by units introduced minus normal loss units. Got it? That will give you few informations like this. So generally, how the process account will be prepared, sir? Very simple. Normal debit credit only will be there. Correct? So two amount column generally will take. One to write units, one to write amount. If you want per unit column, you can take per unit column also. Units, amount. When we introduce material and all, whenever we incur expenditure to material, if opening stock is there, two balance brought down will be there. To material, let's say we introduce 10,000 materials at a cost of 1 lakh rupees. To one more material, but this is not a primary material. So keep one thing in mind, you can't take it in the unit column. Okay, only cost could be taken, let's say 20,000. To wages, 30,000. To manufacturing overhead, 50,000. Okay, now try to understand. By normal loss. By normal loss, if any normal loss is there, let's say 10% is a normal loss. Unit column, it will come as 1000. And amount column of normal loss will be there only and only if you are recovering something from it. If any scrap recovery is there. Let's say in first example, scrap recovery is not there. Nil. Now, try to understand. By next process. By next process, you are transferring, let's say, 9,000 units. At what rate you will transfer, sir? How much is my total cost? 2 lakh, right? Minus scrap recovery from normal loss is 0. Whole divided by introduce 10,000 units. In that normal loss is 1,000. How much it will be? 22.22 na. So here it will be 2 lakh. Hope it is clear. Clear or no? Okay. Now let's say normal loss recovery is there. Scrap recovery is there. Let's say per unit 2 rupees is a scrap recovery. That means 2,000. Or let's say 10,000 or 20,000. 20 rupees per unit you take. So scrap recovery 20,000 per unit, 20,000. So here it is 20,000. How much it will be? 20 na. So 9 lakh into 20. 1,80,000. Now listen, but actual output is 8,500. Actual output is 8,500. But actually you should have got 9,000, but you are getting 8,500 means your loss is more than normal loss. That extra loss we are going to book it as a abnormal loss. How many units? 500 units. Okay. So how much will be the cost per unit? That remains 20 only. That remains 20 only. So abnormal loss will be 500 into 20. 10,000. 8,500 into 20. 1,70,000. Hope it is clear. In the abnormal loss account, how you are going to book it, sir? Very simple. In the abnormal loss account, two process account. To process account. How many units? 500 units. Amount 1,000. 10,000, right? 10,000. For that, don't take scrap recovery. For this, you have to take out the cost from the process and you should charge it to costing P&L. Make sure it's not there in the total cost. That's why we are eliminating it. That's it. So at the same time, buy bank. 500 units we will be selling at the rate of 10. 10 rupees, no scrap recovery. 10 or 20? 20. 500 into 20. This scrap recovery we wrote 20 na. No, normal scrap recovery 20 only. No? So 20,000 we have written. That means here generally it won't be there. If at all, let's say scrap recovery was 5,000, then remaining 5,000 will be charged to costing P&L. Remaining 5,000 will be charged to costing P&L. Hope it is clear. Now let's say scrap recovery is around 10 rupees. Scrap recovery is around 10 rupees. So it will become 10,000. And actual output is 9,200. How much is actual output? But expected output is how much? 9,000. But we are getting 9,200, which means 200 is extra units. Abnormal gain. We are going to book it in the debit side. Abnormal gain. How many units? 200 units. How much will be the value, sir? Total cost 2 lakh, right? Minus 10,000. Whole divided by 10,000 units introduced. In that 1,000 unit is gone as normal loss. 21.1. So 200 into 21.1. 4,222. So 10,200, 2,04,000, 222. As I already told you, it's always better to keep, if at all it's decimals, always better to keep next process in the balancing figure, because per unit it won't affect much. Number of denominators are more. Per unit effect won't be there. But if at all you keep small numbers as a balancing figure, then it will have an impact on per unit things. So here cost is 2,04,222. So it is 1,94,222. Just check, it will come to 21.1 only now. Right? But if at all you have written next process first, then you have taken abnormal gain as a balancing figure, no? Then it would have got impacted. It wouldn't have come 21.1. At least 0.1 or 0.2 would have changed. So it's always better to keep big number as a balancing figure, because denominator will be more number of units, no? So that will evens it out. Got it? So now abnormal gain account, what are the things we are going to do in abnormal gain account, sir? Very simple. Abnormal gain account by process. By process 200 units, 4,222. If you observe carefully, normal loss scrap recovery, we thought 1,000 units. But the thing is 1,000 units scrap only is not there. Where the scrap recovery will come, correct? So normal loss extra we showed, no? That we are going to adjust in the abnormal gain account. That is to normal loss account relating to this 200 units extra scrap recovery, how much ever you showed, 200 into 10, 2,000, that we are going to reverse it. Remaining 2,222 will be transferred to costing P&L. That is your abnormal loss account. Sorry, abnormal gain account. Hope these things are clear. Yes? Now, sir, one doubt, sir. What if opening stock and closing stocks comes? What if opening stock and closing stock will come into picture? What is the problem in that? Nothing. The problem is whatever is there in the closing stock that wouldn't have consumed the same amount of resource, how much our transferred units would have consumed. Whatever the closing stock is there that wouldn't have consumed the same amount of resource, whatever finished and transferred units would have consumed, which means cost per unit for the closing as well as cost per unit for the transferred unit, you can't take same. You can't directly divide by the number of units there. Correct? That's why, guys, we have a concept of equivalent production. That's why you have a concept of equivalent production, because here, although number of units it might talk, but resource consumed by them is not same. So cost per unit for finished goods as well as closing WIP, normal loss, abnormal loss, you can't take the same amount because they might not have consumed so much resource. That restaurant example I gave, remember? Few people went out with half tummy full. That means people who had full 0 to 100% and people who had only 0 to 50%, can you charge the same amount for both of them? No. Why? These people had only half. What? Half of what those people had. Correct? That's why equivalent units will comes into picture. Equivalent units also, guys, two methods we can do. One is FIFO, one more is weighted average. LIFO, very good. One is FIFO, one more is weighted average. One more is weighted average. Guys, actually this difference factor of like FIFO and weighted average will come into picture only if opening stock is there. If the opening stock is not there, then FIFO as well as weighted average, it won't matter. Okay? And listen here. In FIFO or whatever it is, what you are going to do, sir? Very simple. We'll divide segment into 4. How many? 4. Input, particulars, output. These are the 3 divisions. After that, one more division called as equivalent units. In the equivalent units, we'll further divide it into different expenses there. Material, labor, overhead. However, labor and overhead are completed in the same proportion. Then we will take together. Got it? Now listen. Material, percentage of completion and equivalent units. Labor, percentage of completion, equivalent units. Overhead, percentage of completion, equivalent units. Okay. Now let's say input. Opening is there. First I am going to show under FIFO. Opening is there 1000 units. Okay. We introduced, let's say, other 11,000 units. How many units we introduced? 11,000 units. In the output. In the output, let's say, actual output is around 10,000 units. Actual output is how much? 10,000 units. Now, listen, what method we are applying? FIFO. That's why, you know what is the assumption? First, whatever was there in the opening, that will get transferred. Whatever was there in the opening, that will get transferred. So, 1000 units will be out of the opening. Remaining 9,000 is there, no? That will be out of the fresh issue. This is the assumption what we are going to make under FIFO. 9,000 will be from the fresh issue. Got it? Now, try to understand. Opening stock, they will tell material wise 80% complete. What do you mean by that? During the year, whatever the material cost you incurred, no? In that, it is not consuming 100% of the material there. What do you mean by that, sir? Actually, 80% it already material was consumed last period. That means this time it will consume only 20% of what normal unit will consume. So remember, whatever opening already filled is there, no? That you should exclude and remaining portion you should take. 20%. So it will consume equal to 200 units. It will consume equal to, although 1000 units consumes material, that will be just the same as how much normal 200 units will consume. Labor wise, let's say it was 60% complete. That means during the period, it will consume other 40%. Sir, but how you know, sir, it's 100% only? That's why we are transferring to next process now. So it will consume labor equivalent to 400 full units. And overheads, guys, let's say it is 70% complete. That means it will consume 30%. Hope it's clear. Pressure, which means no work was done already. And it is introduced as well as it transferred. Moral of the story, whole 100% is consumed during the period only. 100%, 100%, 100%, which is 9,000, 9,000, 9,000. Got it? And let's say there is a normal loss. How much is the normal loss? Guys, if at all they tell normal loss is 10% of production, then what you should do, sir? Opening stock plus introduced during the period minus closing stock. That will be produced units. Of that 10% you should take. Now let me take it as 10% of the units introduced. 10% of the units introduced including opening stock. That means let me take 10% of 12,000. 1,200. Correct? But always remember, guys, normal loss in denominator, should it be there or no? Here we are trying to find out denominator. Normal loss in denominator, generally what we will do? If it is already included in the total input, we will exclude, no? Now total input is not there. So while computing total input for denominator, should we consider it? No. So normal loss, always remember equivalent unit will be nil. Because normal loss, whatever is there, that should get apportioned to remaining units, not to normal loss. If you take normal loss in denominator, cost will get distributed even to the normal loss units. Got it? Closing stock. Let's say closing stock are 500 units. What does FIFO assumption tells? Whatever opening is there, that transferred first, which means closing whatever is there, that is introduced during the period. Now they are telling, let's say material wise it is 90% complete. That means whole 90% resource is of that particular period. Labor wise 40% complete they will tell. That means whole 40% resource is of this particular period. Overhead 30% complete they will tell, which means whole 30% is of this particular period. Yes or no? So 450, 200, 150. Here don't take difference, here you take directly. You understand? You are understanding, right? Now try to understand. Total introduced was 12,000. Input was 12,000. Output you are getting how much? 10,000, 11,700, right? That means 300 is there, no? That is nothing but abnormal loss. Abnormal loss. If the question is silent regarding how much scrap is already full, how much is the scrap, like progress, then always remember everything we take it as 100%. If the question is silent, 100%. If the question mentions something, then we will take that respective percentage. 300, 300, 300. Got it? If at all it was abnormal gain, what we should have done, sir? Negative, minus. We should have reduced it while computing equivalent units. Got it? Now equivalent units for material cost will be 9,200, 9,500, 9,950. Labor will be 9,900. Overhead will be 9,750. Now listen. Cost for the period they will give. Cost for the period. Okay. They will give material, labor, overhead. Now whatever the cost for the material, labor, overhead, cost for the period, material, labor, overhead will be there, no? That we are going to divide by equivalent units. Equivalent units for material, equivalent units for labor, equivalent units for overhead. Now we will get to know how much is the cost per equivalent units for the period. Cost per equivalent units for the period. Now we are doing this drama just to fill in the process account. If you remember, correct? No. So now our work is to fill the process account. Opening stock. Opening stock. Okay. They were telling 1,000 units. Correct? Now listen. Let's say they tell material cost was X amount, labor was X amount, overhead was X amount. This is relating to opening. Some X amount was there. During the year we introduced and all, that is cost for the period. Correct? When we introduced 11,000 units. Now, by normal loss. How many units we took? 1,200, right? 1,200. What we should take in the credit side? Of course, scrap recovery, if any is there, that we should reduce. Always remember, if at all normal loss scrap recovery is there, then make sure you reduce that scrap from the material cost while computing cost per equivalent units. Always remember, you are going to reduce it from the material cost while computing cost per equivalent units. Got it? Okay. By normal loss, let's say some X amount is recovered. By next process, we are transferring to next process 10,000 units, right? Yes. At what value, sir? We don't know. Wait. By closing stock. How many units are there? 1,300. 500. Except one question for no reason. Correct. In that also you do this only. Reduce it from the material only in examination. 500. In study mat, one question they have reduced it from the overhead, if you remember. I think just to round it off or so. Their head it is. By closing stock, you understood? But what value? We don't know. Wait. By abnormal loss. How many units? 300, right? What value? We don't know. Wait. Now listen. We got to know cost per equivalent units. Correct? Now, we are transferring 10,000 units to the next process. Agreed? In that, 1,000 units out of opening stock, 9,000 units out of during the period. Now what we will do, listen very carefully. Opening stock, although it was 1,000, it consumed material which is equivalent to just 200 of what is freshly introduced. That means 200 into cost per equivalent units of material we will take for this. Okay. Labor wise, it is consuming what normally 400 units would have consumed. So 400 into cost per equivalent units of labor will take this. Overhead 300 into cost per equivalent units of overhead we will take here. Got it? Also remember, as we are applying FIFO for this 1000 units, this is not the only cost. Why, sir? In the beginning already we incurred that X amount of overhead, no? In the opening. So that X will also be added. X will also be added. And for this 9000 which is introduced, equivalent units are 9000 only, because everything it is consuming like a normal product. So 9000 into cost per equivalent unit of labor, 9000 into cost per equivalent unit of overhead. Should we add X here? No. Why? Whatever the cost is incurred, everything shall be relating to this particular period only. No overall extra cost is incurred. Now we will get to know exactly how much is the total cost. This will be the total cost. This will be taken to next process. Got it? For closing stock, for material, will take 450 into cost per equivalent unit of material. Sir, should we add X? No. Why? It is of the particular period only. 200 into equivalent unit of labor, equivalent unit cost of labor. 150 into equivalent unit cost of overhead will give me value for closing stock. Abnormal loss units into, that is 300 into equivalent unit cost for material, 300 into equivalent unit cost for labor, 300 into equivalent unit cost for overhead. If at all they give scrap something else percentage, you should take that. With that, your process account will get completed. Hope it's clear. Clear or no? Pakka. Okay. Now, listen. Next thing is when it is under weighted average. When it is under weighted average. What does weighted average says? Don't assume that whatever opening was there, that will get produced first and will be transferred to next process. Don't do that. Then what we should do, sir? Assume that opening portion will be there in the transferred also, will be there in the closing also, will be there in the abnormal also. What do you mean by that, sir? We are not going to segregate between opening and all. Then what you will do, sir? Very simple. In the same format, here we don't take segregation. Here we don't take segregation. Then what we will do, sir? We'll directly take output. How much we are transferring? 10,000. Correct? If it is transferred, it's completely full. Yes or no? So take 100%, 100%, 100%, which will come to 10,000, 10,000, 10,000. No much other changes will be there. Now equivalent units will become 10,750, 10,500, 10,450. Correct? Sir. But don't you think only we will be taking the cost of the current period now? The answer is no. Why, sir? Now listen what we will do. Now listen, while computing cost per equivalent, what we will do under weighted average? We'll take cost for the period. For that, we will also add a opening stock cost. So we treated opening stock as a normal unit. Then opening cost should also be treated as normal cost. That's why we are going to take it to the normal cost. And of course, from material cost, if at all any scrap recovery from normal loss is there, that we will reduce, and that will be divided by the equivalent units. So this 10,750, I agree, opening stock is also there. At the same time, numerator, whatever the cost relating to opening was there, that is getting distributed to everything, no? How it will get distributed to everything, sir? Just because you did 10,750, 10,750 includes what? Transfer to next process. Closing stock, abnormal loss. For everything given, opening cost will get distributed. So you don't have to segregate there. While computing equivalent cost, cost per equivalent unit, you should add opening cost to the current period cost. Got it? And try to understand opening cost. I will tell to apply FIFO, no. Many things should match. Like what, sir? Factor number 1. Opening stock should exist. Otherwise, it's FIFO or weighted average, doesn't matter. Understanding? Factor number 2. Opening, either they should give overall opening per unit how much is the cost, so that at the end you can add it, or they should give segregation as to opening includes material cost how much, labor how much, overhead how much, then only you can add it at the final, or they should give per unit how much, all the three together. Few questions they have given 8 rupees, 9 rupees and all, if you remember. Only in these scenarios you can apply FIFO. All other time you can go for weighted average. Hope it is clear. In examination, majority of the time they haven't asked this, but still you should be knowing to solve this, because hardly 3 concepts are there in this process account. Process account, equivalent production, interprocess profit. Only these 3 are there. Which one is common? Normal process account is common. Got it? Hope equivalent unit stuff is clear. That equivalent units, I know it will be much more like, it will be kind of confusing. You have to go through and practice it again and again and again, few questions. Then only we'll be able to solve it. Okay. And equivalent units, always remember, normal loss is to be considered as 0% equivalent units, always and always. If the question is silent, abnormal loss and abnormal gain should be considered as 100% of equivalent unit. If the question is silent, for material, it is always considered as 100%. If at all they don't tell, opening unit consumed how much material already, assume 100% is already consumed. Why, sir? Because generally 100% of the material will be introduced. No? Primary material in the beginning only we will introduce. No? That's the reason. Sir, during the period, closing stock is there. For closing stock material, how much they are not telling, then assume 100%. That is introduced during the period only, like that. So for opening stock, you are going to take 0% for material. Closing stock, you will take 100% for material. Hope it's clear. Clear? Now, there is something called as interprocess profit. What? What do you mean by interprocess profit, guys? Any idea? Interprocess profit means generally to evaluate the performance of the each process, we'll treat them as a separate cost centers. We'll treat them as a separate cost centers. So what, sir? So nothing. Let's say process A is there, process B is there, process C is there. Process A will send to process B at cost plus profit. Process B will send to process C at cost plus profit. So now how to account for it is the thing. Always remember, if at all interprocess profit is there, no, you should, process account should have 3 amount column. If you remember, it's called as CPT. Yes, cost, profit, total. Cost, profit, total. Now, this cost and profit column is relating to whole organization, remember, rather than particular department or process, where total column talks about process. Okay. So, cost to the total, cost to the organization, that will be written here, but cost to that particular process will be written in the total column only. Correct? And based on that, we'll ascertain certain things. If you remember, we have done few questions also. Okay. Now I am not going to take up that particular thing again. Okay, because you know that it's going to take a lot of time. Still, sir, but I forgot completely, sir. Then do one thing. Today you go here, search YouTube. Don't put any shorts here. Okay. Here you go. Which login is there? You are. Who you? No one is you. Then whose recommendations are this? Someone's recommendation. Breaking news. Is CA is dying? Oh, CA course is dying. Huh. Go and search here. Rastrith. Rastrith. Not Rastrith. Rastrith. Huh. Interprocess profit. Not Rastrith Interprocess profit. I mean, it's a keywords. Hopefully, this 1 hour 18 minutes video is there. Yesterday only you saw, na? Go and watch again if at all. What's the meaning of your name? The one who does good for the country. Rastrahit, they made it as Rastrith. Why you guys are laughing? I don't know. Why? Internet is slow, but yeah, it has complete thorough discussion for 1 hour 20 minutes. Because see, I can't explain it in 5-10 minutes for sure. With numbers only, I have to explain how it works. So here I have done one sum also. I think 2-3 should be there. 300 Mbps or 313, I don't know. So you can go and watch that, okay? If you want other video, then don't watch any of this. Watch this. One more. 3.1K. Interprocess profit. Arjun sir. Oh, who is that you don't know? Arjun sir. Oh, in the same channel it's there. No. All this channel. Yeah, I had. I mean, now also channel is there, but I am not putting any content. Travel? God's plan. Agree. Completely agree. Okay. Just go and watch it. You can watch it at 1.5x, 2x, depending upon your capability. Whoever is watching in YouTube also, you can go and watch in that. At the same time, anyhow, I assume you have subscribed for our CMA channel. For that channel also, you go and subscribe. Let's make it 100K as soon as possible. It is 83.4 or 84, right? Like, share, comment, subscribe. Correct. Like, share, comment, subscribe. And don't forget to hit that bell icon. Don't take it something different. Bell. But why you want to? No, don't turn off the notification. Why you want to get distracted when you are studying? Don't press bell icon. You kept your not Insta, YouTube notification on? To whom? Why did the budget go to therapy? Because it couldn't handle all the control. No words. Ate illa. Now listen. JPBP, joint product, byproduct, concentrate, last bench. Feel free to go home if at all you are not understanding or so. Don't disturb others. Because someone who is seeing from the upside will be writing your good things, bad things. This will go to bad things. Disturbing friends in classroom. Spoiling their life. In nursery class. So. Now listen. Joint product, byproduct. What do you mean by joint product? Some product. Chapter headings also you forgot, huh? While processing the product, huh? Okay, wait. While processing the product, while processing the product, you will get other product. Like, it's like while processing the product, that is byproduct. I know. That is byproduct. Joint product means basically when you process material, labor, overhead, all these things in a single process, at some point you will get two or more products. When you process material, labor, overhead, you might end up getting two or more process. Now those two or more process, if at all it has, say like good value, then all those product we call it as joint product. All those product we call it as joint product. Basically the output with the good value is coming out of the same process. Those all outputs together we call it as joint product. By the way, that process was there, no, till those got segregated. Till those got segregated, whatever the process is there, no, that process, whatever the cost we incurred, that cost we call it as joint cost. That cost we call it as joint cost. Why, sir? That cost is not related to only one product. It is relating to many product. Okay. The point at which they will get divided, that thing we call it as split of point. That point we call it as split of point, or we call it as separation point. Separation point. Petrol, diesel. You put crude oil, you process it, you will get two output. Petrol, diesel. Now that we call it as joint product. What do you mean by co-product? Guys, it is not coming together or it is not getting divided of the same process. Process is same, but the input will be different, because of that output will be different. For example, making oil. Making oil. Basically, process will be same. You know, crushing that, all those things. The oil will come out, the wastage will be there, all those things will be there. But if you give sunflower seeds, you will get sunflower oil. You give mustard seeds, you will get mustard oil. But the process is same. In that scenario, no, mustard oil as well as sunflower oil are there. No, those are co-products. Those are co-products. Hope it is clear. What do you mean by byproduct, sir? In producing, you will get two or more products. But the thing is, In that, one product is of good value, other product is negligible value. Now that negligible value product, we call it as byproduct. For example, when you introduce crude oil, you get petrol, diesel. Your intention was to get petrol, diesel. So joint product, our intention will be to produce joint product. But when it comes to byproduct, our intention is not to produce byproduct. Our intention is to produce only main product. Byproduct is accidental to it, or it is an addition to that. Okay, that we call it as what? Byproduct. That we call it as byproduct. Hope it is clear. So byproduct, for example, you want to extract sugarcane juice. Your main intention is to get sugarcane juice, wastage of sugarcane, molasses, juice. But can you avoid that? After crushing sugarcane, that wastage, that is byproduct. Oil. When you crush it, you are crushing to get oil cake or oil? Oil. But because of that, you will get that wastage oil cake also, no? That we call it as byproduct. That we call it as byproduct. Hope it is clear. Akka? Sir, how to treat byproduct? One, you can just treat it like a main product only. One more, credit it to the sales net amount. That is how much cost I am incurring, extra cost, but byproduct directly I am unable to sell, let's say. Extra cost I have to incur, no? That extra cost and that sales value. Net off I will take and I will show it in the credit side. Or instead of that, generally the best way of doing it is, or how we handle it is, we'll take the net realizable value. That's what? Sales price of the byproduct minus extra cost what we are incurring after separation point. Further processing cost after separation point. Whatever we incur the extra cost, that will reduce from the sales. That thing only we call it as NRV. Net realizable value. That NRV of byproduct, we are going to reduce it from the joint cost. NRV of that byproduct will reduce it from the joint cost. Then the joint cost will be apportioned to joint products. Then the joint cost will be apportioned to joint products. Hope it's clear. Okay. There are different methods for apportionment of joint cost. To see the performance of each and every individual output, you can divide that joint cost on different basis. Unit based, unit cost based, contribution and all is very important there. Or reverse cost method. Reverse cost method, what we will do, sir? Very simple. They will give 2-3 output, let's say. In the 2 output information, full they will give. Sales they will give. Profit they will give. Sales minus profit is what? Total cost. Further processing cost they will give. Out of total cost, if you reduce further processing cost, balance should be what? Joint cost. Now you know for this unit how much joint cost is there. Out of total joint cost, let's say 10 lakh, relating to this unit 4 lakh is there. Remaining 6 lakh should be relating to other unit. Like that also you can segregate. That is very important. Like majorly asked one. That is sales they will give, profit they will give. You will get the total cost. Total cost they will also give further processing cost. Out of total cost, if you reduce further processing cost, you will arrive at a joint cost. Joint cost in that particular thing. If you reduce that joint cost from the main joint cost, then you will get remaining joint cost to the remaining output. Like that. When we see the question, we will understand. Don't worry. Like that, many methods are there. In contribution method, remember one thing. If at all variable cost will be there, no? Variable cost, variable joint cost, that will be apportioned in the unit ratio. Variable joint cost will be apportioned on unit ratio. Fixed joint cost will be apportioned on contribution ratio. Fixed joint cost will be apportioned on contribution ratio. And one more thing you have to remember, after apportioning the variable joint cost, if at all any product contribution becomes negative or 0, then fixed joint cost should not be apportioned to that. Fixed joint cost should be apportioned only to remaining with the positive contribution. Hope it's clear. If at all you get negative contribution or zero contribution, fixed joint cost should be apportioned to the product with the positive contribution. And remember, variable joint cost should be apportioned on unit basis. Fixed joint cost should be apportioned on the basis of contribution. Got it? Sometimes what the question they will ask is, boss, joint cost to joint product we agree. Should you further process it or no? When will you further process? When your profit increases, that time we will further process. If our profit won't increase, why will we further process? For example, we got 300 kgs of butter. We can sell it in the market at rupees 500. At rupees 500. However, this 300 kgs butter, we can convert it into 200 kgs of ghee and we can sell it at 800 rupees. However, to convert this, we have to incur, let's say, around 15,000 of further processing cost or cost after separation. Now the question is, should you sell it as butter or should you further process it to ghee? Very simple, guys. What you should do is, see, joint cost you can't avoid. That is like a sunk cost now. However, the cost what you can avoid is a further processing cost. All you have to do is find out a incremental revenue. That is because of further processing. How much extra revenue you will be able to make. Right now, how you will make if you sell at a split off? How much you will make? 300 into 500. 1,50,000 you are getting. Okay. Then make this as 75,000 further processing cost. Now, if you sell ghee, then 200 kgs only you can sell because 100 kgs will go wastage. Into rupees 800. How much? 1,60,000. That means our incremental revenue is 10,000. That is extra revenue what we can make by further processing is 10,000. But to further process extra we are going to incur is 75,000. Just by incurring this 75,000 extra just to make 10,000 extra, we'll be losing 65,000. Don't further process. Don't further process. So basically all you have to do is your further processing cost is nothing but your incremental cost. Your further revenue, extra revenue what you can make is a incremental revenue. If at all your incremental revenue is more than incremental cost, further process. If at all your incremental revenue is less than incremental cost, don't further process. Simple. If the incremental revenue is more than incremental cost, further process. If incremental cost is more than incremental revenue, don't further process. Don't further process. Hope it is clear. Any doubts? Pakka. And one more thing, how to arrive at NRV, sir? Very simple, guys. Sales after split off. Sales after split off minus further processing cost, including selling expense and all. You will arrive at a net realizable value, NRV. Remember, sales after split off minus further processing cost will give you NRV. Sir, if sales after split off is not there at all, you have to sell it at split off only. Sales after further processing, actually it is sale after further processing minus further processing cost will give NRV. Sir, you have to sell at split off, sir. You have to sell at split off. In that scenario, selling price at split off will be there. No, that itself is NRV. Selling price at split off will be itself your NRV. If at all you can further process, then sales after further processing minus further processing cost will give you NRV. Hope it is clear. Pakka no? So majorly in JPBP, question will be relating to whether to further process or no. How to take a call? If at all your incremental revenue is more than incremental cost, go for it. If incremental cost is more than incremental revenue, don't further process. Hope it is clear. Now it's time to see few questions. June 23 MCQ. Naina. Which of the following is an example of byproduct, guys? Curd and butter. They are not. Mustard seed and mustard oil. Raw material, finished goods. Edible oil and oil cake. That is JP, that is BP. First time she is talking properly. Nothing. You are explaining that I told no for this answer, not for that answer. 6. JPBP also tell now only. And why you were talking about JPBP when it is process costing itself? No idea. Sikta? Listen. Measures Golden Oil Refinery Limited produces golden brand oil which passes through 3 different processes before getting finished oil. The following details are extracted from the cost records of the company for the month of March. 3 processes are there: crushing, refining, finishing. Cost of labor is there, sundry material is there, electric power is there, steam is there, repairs of machine is there. Cost of cask and drums are there. That is only at the finish last. Measures GORL purchased 1000 tons of copra for 50,000. Factory overheads for the period were 5,000 to be apportioned on the basis of wages. So total wages are 10 lakh, no? Sorry, 10,000, no? So 5,000 should be apportioned on this basis. 2,500, 1,500, 1,000. 2,500, 1,500, 1,000. 850 tons of crude oil was produced. Guys. 850 tons of crude oil was produced. 770 tons of oil was refined. That is second. In refining, we got output of 770. In crushing, we got output of 850. And 750 tons of oil was finished for delivery. In finishing, we got output of 750. Realized 1,000 from the sale of sacks. 2,500 by sale of 125 tons of copra residue, and 2,250 by sale of 60 tons of byproduct in the refining process. Okay. Required. Prepare process account for the month of March 2023. I will just show it here only. Fine now. 6A no. Huh? First we'll do crushing. We did leave. First listen. we are going to introduce 1000 units of material at the rate of 50,000. Correct? And by the way, the loss we are treating it as normal loss because they haven't given any information about normal or abnormal there. So we are treating it as normal. And we introduced other expenses like labor 5,000, overhead 2,500, sundry material 2,000, electric power 1,500, steam 1,000, repairs of machine 1,000, 7,500, 9,500, 11,000, 13,000. Correct? So I will take it as a single line here, but you can't do that. You have to write full. 13,000. Correct? Credit side, I will take normal loss first. Try to understand. 850 tons of crude oil was produced, which means 150 is wastage. Agreed? And what they are telling, we are also recovering some amount. When we treated that loss as normal loss, whatever scrap we recover, everything is recovery from normal loss. How much it is? 1,000 rupees plus 2,500. 3,500. Hope it is clear. So we are transferring to next process. That is which process? Refining, right? By refining 850. How much will be transferring to? 63,000 is total. 59,000. 59,500 transfer to refining. Got it? Now, in the refining process, we'll introduce 850 units at 59,500. Also, we incur few expenses, right? Which are those expenses, sir? 3,000, 4,500, 6,000, 7,000, 8,000, 8,500. Correct? 8,500. Remember, you should not put it in unit column because that is not a primary. Got it? Total 68,000. 850. And output of this they are telling 770 tons. Output how much they are telling? 770 tons. That means where did 80 go? Normal loss. From this are we able to recover anything? 2550. 2550. How much it is? Got it? Next, we are going to do finishing. We are receiving 770 units from 65 at 65,450. Correct? And we are also incurring a extra cost of 2,000, 3,000, 4,000, 4,800, 5,550, 5,800, 8,800, 9,550 na. Eight thousand 550 na. This 1,000 you are adding, right? 9,550. 9,550 extra cost we incur. Total will come to 66,000, 75,000. Correct? 770, and we are transferring 750 units to finished goods. By finished goods control account, 750 units at the rate of 75,000 because the 20 units is not recovering us or not realized, like no scrap recovery is there. That's it. Hope it's clear. Clear, no? No doubt? Akka? Shall we go to the next one? May I know the question number, please? MCQ. The method of apportioning the joint cost on the basis of output of each joint product at the split off is called as physical unit method. Average cost method is nothing but same only, but we'll find out cost per unit first, then we will distribute on the basis of units. Here we don't calculate cost per unit, directly we'll distribute in the units ratio. Next up. In the process, 12,000 units are introduced during the period. 5% of the input is a normal loss. So normal loss is how much? Closing WIP 60% complete is 1500. 9,900 complete and transfer to next process. Equivalent production will be, try to understand. Input was 12,000. Correct? Okay. Coming to output side. Normal loss was 600. Transfer to next process 9,900. Output, closing 1,500. Just check 12,000 is matching or no? So there is no abnormal loss as such. You know that equivalent units for the normal loss, it will be nil. Transfer to next process, it will be 100%. Closing, they are telling it is 60% complete. Total will come to option D. Hope it is clear. Next. 5. This thing. Superbite is a leading product in the confectionery market, which is obtained after it has gone through the 3 distinct process X, Y, and Z. The following information is obtained from the cost records of Super Limited for the month of July. 1 month information they have given. Input, of course, you can see that only in the process X it is getting introduced. Correct? 1,000 units we are introducing at the rate of 30, which will come to 30,000. Amount unit column, you should write 1,000. Other material only in the amount column. Direct wages only in the amount column. Normal loss of input is 5%. 5% of input is 50. Correct? Output is 950. It was supposed to be 950. We are getting 950 only, which means in first place there is no abnormal loss as such. Total overheads are 90,000, which are recovered at 100% of wages. This is like total wages is also 90 only, right? Correct. Otherwise, they will just tell on the basis of wages. Then you should divide it in the wages ratio. This is one of the easiest question. This will be above a lottery only if at all it comes in the examination. Nothing is there in this. X, Y, Z. Correct? X, Y, Z. I will just show it without writing our this thing and all. Narration, not narration, particulars and all. Without that, I will just show what debit, what credit. Shall I? First, product X, 1,000 we have introduced in the process. Correct? At the rate of 30, which will become 30,000. And other material, we introduced 26,000. I will just take the total. Is that fine? 26,000 plus 20,000, 46,000. Correct? Sorry? Overhead, basically you are going to apportion 100% of material. That again I have to take screenshot and all. 20,000. Hope it is clear. And one more thing, when you are studying, please write and practice. Just don't check answer question, answer question, answer question. Here at least I will be discussing if I show that way. When you do that, once or twice you will see everything. First question with calculator. Second question, okay, calculations are correct. All I have to do is each and every line. Third question, final answer. In between, if at all any adjustment is there, I'm telling you, it is bad thing. So practice, write and practice. Okay. Fourth question will be like, hey, this is same question. No. Gone. That depends on you. Overhead is done now. Now listen. Normal loss is there. How much is the normal loss? 5% of the input. So that is 500. Sorry, 50. Right? 50 units. So, and recovery of the scrap is there 20, 50 into 20 will come to 1000. So try to understand total cost is coming to 30,000 plus 46,000 plus 20,000, 96,000. So first one, 96,000 is my total cost. Scrap recovery from normal loss is 1000 divided by, we introduced 1000 units, in that 50 is normal loss, 100 per unit. We are transferring to next process 950, 100 which will come to 95,000. There is no abnormal loss, there is no abnormal gain as such. Correct? With that we have completed our process X. Going to process Y. We introduced 950 units from the process X at the rate of 95,000 and we incurred extra how much, sir? 19,800 plus 30,000 plus 30,000. 30,000 is overhead. So 60,000, 79,800. 79,800. And they are telling there is a normal loss of 10%. We introduced 950, in that normal loss of 10% means 95 units. And scrap recovery is there 40 rupees. 40 into 95 is 3,800. And how much we are transferring to next process? 840. We are transferring to next process 840. Correct? Now guys, try to understand. Out of 950, if 95 goes out, how much is the balance? 855. But actually we are getting output of 840. That means extra 15 loss is there. That is nothing but abnormal loss 15. Normal loss is 95, 10%. And how much will be the valuation, sir? Very simple. Total cost is how much? 95,000 plus 79,800. 1,74,800 minus scrap recovery from normal loss 3,800 divided by 950 minus 95, 855, 200 per unit. So 840 into 200, 1,68,000. 15 into 200. I think it's matching now. Just check. Matching. Now, input for this is 840 units at the rate of 1,68,000. Correct? Okay. Then what is happening? 15% is going as a normal loss. 840 into 15%. 126 is going as a normal loss. And we are recovering 50 rupees from that. 6,300. And also we incurred some cost here. Which are those, sir? 29,620 plus 40,000 plus 40,000. 1,09,620. Correct? Next process, how much we are transferring? We are transferring 750 units. We are transferring 750 units. Now listen. Our total cost is 1,68,000 plus 1,09,620. 2,77,620 minus scrap recovery 6,300. 300, right? Divided by 840 minus 126. Per unit how much? 380. Now listen. And also if at all in any process only we sell, no, don't take the selling price there. Cost of that sold units transferred to costing P&L. In costing P&L, revenue side revenue, debit side cost from the different process. And sometimes also they will give some common cost which is not apportioned to different process. That you should address in the P&L. Here, from this year, all the cost relating to sold units you will transfer to costing P&L. Now in costing P&L, credit side you will take all the sales. Debit side you will take process 1, process 2, process 3 relating to sold units in the respective process. Along with that you take those cost which is not addressed. Then only we will get the net profit. Got it? Now this one. Listen. Total 840 was there. In that 126 is normal loss. How much should be the balance? 714. But actually how much it is? 750, which means 36 extra units are there, no? Abnormal gain. So 36 into 380. 13,680. 750 into 380. 2 lakh? 85,000. Just check whether it's matching or not. Matching? Hope it's clear. Next. Hello. What, sleeping? Hey, you are solving, no, sir. What we should do. In examination also, we'll come and do on board, no? MCQ? In process, 800 units were introduced. Okay. 5% are a normal loss. Okay. Closing WIP is 60% complete, which is 100 units. Okay. 660 units are transferred to next process. Just check total is coming to 800 or no. It is, which means there is no abnormal loss as such. So this 40 normal loss equivalent units are nil. This 100 units closing, they are telling it is 60% complete, so it will be 60. This 660 is 100% complete, it is 660. Total will come to 720. Option D. For this MCQ, don't keep opening that input particulars. MCQ. Which of the following method is used for evaluation of equivalent production when the prices are fluctuating in the market? Fluctuating, weighted average is better. Okay. Next. 5A now. Apportionment of joint cost are made on the basis of sales value based by the company. Okay. Prepare a statement showing a monthly profitability based on both the existing manufacturing operation and on further processing. Will you recommend further processing? Basically, they are asking JPBP related stuff here. XYZ Limited processes 1,50,000 kg of raw material in a month to produce two products, that is P and Q. The cost of raw material is rupees 8 per kg. Cost of raw material is how much? Rupees 8 per kg. The process cost per month are direct material, direct wages, variable overhead, fixed overhead. The loss in process is 5% of the input, and the output of P and Q which emerge simultaneously is 1:2. So whatever the input you give, in that 5% will go as a loss. Remaining 95%, in that P and Q will come in the ratio of 1:2. Selling price of two products at the point of split off are 12 and 20. A proposal is available to further process the product P by mixing it with the other purchased material. The entire current output of P can be further processed to obtain a new product S. So the further processed product S can be sold at 15 rupees. Now this one we are selling at 12 rupees. This could be sold at 15 rupees. And output of S will require 1 kg of input of P, which means number of units won't get reduced. How many units of P was there? So many units of S only will come. The cost of processing P into S, including other material, is 185,000. Okay. Now, you are introducing 150,000 first. Correct? However, in that 5% is J as a loss, which means 95% is remaining. How much? Give me a second. 1 lakh? this is divided into two products, P and Q. P and Q only, no? 1:2 ratio. 47,500, 95,000 units. Hope it's clear. Now, how much will be the sales at split off point? This could be sold at 12 rupees and this could be sold at 20 rupees. 5,70,000 and 90 19 lakh. X sale is 5,70,000, not X. P sale is 5,70,000, Q sale is 19 lakh. And how much will be the joint cost? Try to understand joint cost. Raw material cost is 8 rupees per kg. 1,50,000 into 8. 12 lakhs. Plus these many other joint cost. Total this one alone 22 lakh. So 22 lakh 10,000 is your joint cost. This we are going to apportion on the basis of total sales there. So what is the ratio here? Total is how much? 26,70,000. Now how much is 22,10,000 divided by 26,70,000 into 5,70,000? 4 lakh 70. 798. Let's take it as 800. I mean, rounding of errors it could be. Next one, balancing figure. Out of 22,10,000 minus 4,71,800. 17,38,200. How much is the profit in this case? These are the profits. Got it? Without further processing. Now, if at all you further process, guys, same 47,500 units only will be there in this because there is no wastage as such. However, that could be sold at 15 rupees, which means how much will be the sales? 47,500 into 15. 7 lakh 12,500. This anyhow you can't further process, so it will be 19 lakh only. Minus first joint cost 4,71,800, 17,38,200 minus further processing cost only to P, because to further process it we are incurring 1,85,000. And always remember, in JPBP you are not going to compare joint cost with the sales of the different units. Always remember, you should compare with the sales of the produced number of units, because joint cost will be relating to produced number of units. Then sales also should be equal to produced number of units, not to the sold number of units. So if at all they give opening, closing and all, but still for computation of this decision and all, always remember how many units you produced, that into selling price only you should take, not the actual selling price, actual sales. Got it? Because you should compare with the equal products, no? Output. So first one, how much it is? 50? 1,61,800. See there, 98,200 it was. Now it became 55,700. Because our incremental revenue is coming to around 1,42,500. correct? That is nothing but our 47,500 into 3. 1,42,500, but incremental cost is 1,85,000. So automatically incremental cost is more than incremental revenue, because of which it is reducing our profit by almost 32,000, 42,500. Got it? That is the thing. 5A. So we recommend not to. Correct. Hey, without further processing. Sales value we got 570 and 19 only, no? Hey guys, how much is this 22 lakh 10,000 divided by 140 to 500 into 47,500? 22 lakh 10,000 divided by 140 to 500 into 47,500. 7 lakh. What they have told in the question? 7A, right? 5A, na? Apportion the joint cost on the basis of sales value. Sales, what we have taken is how much? 570 and 19 only, no? Five lakh 70 and 19 only. So it became 24 lakh 70,000. So joint cost we took it as somewhere I have written now. I think I erased. 26 I told. Based on 24 you take. I mean for decision making anyhow it's not going to affect. 471 800 plus 1738 200. 22 lakh 10,000 is joint cost. 5 lakh 70,000 plus 19 lakh. 24 lakh 70,000. So 22 lakh 10,000 divided by 24 lakh 70,000 into 5 lakh 70,000. 5 lakh 10,000 is. I think there instead of 24 I told 26. My bad. So basically that joint cost will apportion on that base. You understood now? That is just numbers we took wrong. That's it. Next. Byproduct, edible oil and oil cake. Next. Five. Montech Limited is engaged in the process engineering industry. Its product ZP passed through to process A and B during the month of September. The input of process A basic raw material is 8,000 into 9. Okay, that will come in the unit column 8,000, amount column 8,000 into 9, 72,000. Output is coming to 7,500. Normal loss is 5% of the input. 8,000 into 5% will come to 400. I'm going to send you guys out now. There is no use also sitting like this. So 8,000 into 8,000 minus 7,500. 500 is the actual loss. but normal loss was only 400. That means other 100 is abnormal loss in the process one. Remember, scrap value 2 rupees is there, direct wages is there, direct expense is there, selling price is 15. That is, process A you can sell it at 15 rupees, but remember, don't book 15 rupees and profit in the particular process account. Take it at a cost to the costing P&L. In costing P&L credit side, you should take 15 rupees per unit. Got it? Same for the process B. Total overhead is coming to 17,400 recovered as a percentage of direct wages. So how much is the direct wages, guys? 36,000, right? Correct? So how much is 17,400 divided by 36,000 into 100? 48 point? Continuing. Then basically remember 48.33 percentage is the overhead recovery rate on the direct wages. Selling expense for 5,000. Try to understand selling expense 5,000. It won't be booked in the process account because process account talks about only manufacturing expenses. Selling expense, then where we will book, sir? Costing P&L. They are not allocated to the processes. They are only telling. Good. 2/3 of the output of process A has been passed to the next process. Awesome. Then remaining 1/3 is sold. So out of 7,500, 5,000 is transferred to process B. 2,500 is sold. Transferred to costing P&L. Entire output of process B is sold. Awesome. Process A and process B is not responsible center, which means you don't have to book the profit in the respective account. Prepare process A account, process B account. Calculate the profit of process A and process B for the month of September 2024. Calculate the profit of process A and B for the month of September 2024. Simple. Shall I show it in the answer key only? They have given luckily. Input 8,000 into 9 rupees, which will come to 72,000. Direct wages 12,000. Direct expense 6,000. Overhead 12,000 into 48.33333333 percentage, which will come to 5,800. So 12,000, 6,000, 5,800. Total expense is coming to 95,800. We know that normal loss 400. I told you 5% of 8,400 and abnormal loss 100. And transfer to next process is 5,000. To the P&L 2,500 because 2/3 is transferred to next process. 1,500. 5,000 transferred to next process. 1/3 2,500 transferred to P&L. Now listen. At what value, sir? Take the cost. Don't book the profit in the process accounts. That is, debit side total is 95,800 minus scrap recovery from normal loss is 800 because 2 rupees is a scrap recovery. 95,000 divided by 8,000 minus 400, 7,600 units, 12.5. So we are going to transfer 100 into 12.5 to abnormal loss, 5,000 into 12.5 to next process, 2,500 into 12.5 only, not 15 to the costing P&L. Hope it's clear. Process B account. From process A, we received 5,000 units at the rate of 62,500 and we incurred direct wages of 24,000, direct expense of 5,000 and 24,000 into 48.33333333 percentage. There is 11,600 of other expense. So process B, no? 24,000, 5,000, 11,600. Got it? Try to understand. We introduced 5,000 units in this process. However, there is a normal loss of 10%. So 500 is a normal loss. Correct? And we are transferring, or basically finished goods is 4,800. Of course, completely sold. So by costing P&L. But the thing is not that. But the thing is, you introduced 5,000. Normal loss was 500. Which means output must have been 4,500. Best part is it is 4,800. That means 300 is an abnormal gain. So that 300 you have to book it as abnormal gain. Now listen, 300 we are booking it as abnormal gain. How much is the value, sir, for everything? Debit side, just check. Process 1 62,500 plus direct wages 24,000 plus direct expense 5,000 plus overheads 11,600 minus scrap recovery from normal loss per unit 10 rupees is a scrap recovery. So 500 into 5,000. So that is coming to 98,100 divided by 4,500 per unit 21.8. So abnormal loss is 300. 21.8 into 300 is 6540 and 4,800 into 21.8 is 1,04,640. Got it? And listen here, as they are asking profit also, remember balance of abnormal gain and abnormal loss also should be taken. Try to understand. Abnormal loss account they didn't ask, so in account I won't show, directly I will show. Loss we booked 1,250, correct? At the same time, by selling the same 100 units at the rate of 2 rupees, we are recovering 200 rupees, which means loss I am transferring is 1,050 to P&L. Abnormal gain, we are booking 6540 as a profit, but the thing is, whatever the normal loss we showed more, that should be recovered now relating to this 300 items. So 300 units, I showed 10 rupees per unit there. So 300 into 10, 3,000. So around 3,540 I am going to show it as a profit. Got it? So now you go to P&L account. See there. Sales, process A. We are selling 2,500 units at the rate of 15, which will come to 37,500. Process B, we are selling 4,800 units completely at the rate of 25, which will come to 1,20,000. Total sales 1,57,500. Cost from each and every process I transfer to costing P&L if you remember. 31,250, 1,04,640. At the same time, abnormal loss I told you 1,050 we should book as a loss. Abnormal gain 3,540. Why I showed you there? Yes, you remember? And also selling expense I told you book it in the P&L account. So we got to know net profit is 19,100. Anyone any doubt in this? Pakka? Hello? What is this 5 S&T? I think similar question. That's why we didn't see it. I feel right. This one? This one, standard costing. Leave, who cares? Next one. Oh, last question paper we arrived, huh? Crazy. Very fast. Under NRV, apportionment of JC to JP, selling and distribution cost is added to joint cost, deducted from sales value, added to sales value, deducted from further processing cost. Under NRV method, apportionment of JC to JP, selling and distribution cost is, what we will do? Deduct it from, so it won't be treated as a joint cost. You will deduct it from the sales value so that you will arrive at a final joint cost. If you know the profit and all, that's how you are going to arrive. Okay. So next. This one. Moon Limited is a market leader in the manufacture and sale of a specialized product GPT. Awesome. In manufacturing main product GPT, they are resulting in the two byproduct X and Y. From the records of the company, you have received the following information. Total cost up to the point of separation. That is nothing but joint cost. GPT 3,28,000 is the sales. Product X 32,000. Product Y 48,000. Cost incurred after separation, nothing is there because you are not further processing. For X and Y you are doing because it's a byproduct. Okay. Estimated profit on sales value is 20%, 30%. Awesome. Selling expense estimated is 20, 20, 20. Prepare comparative P&L statement using the reverse cost method for byproduct. Reverse cost method. I told you, if you remember, from sales we'll reduce profit. We'll get a total cost. From total cost we'll reduce further processing cost. We'll arrive at a joint cost. Once we arrive at joint cost for X and Y, remaining joint cost will be for GPT. Correct? So listen. X, Y. How much is the sales? 32,000? 48,000 minus profit. How much is the profit they are telling? Luckily they are telling on sales value only, not cost. Cost means you should do ulta. 100 means this much, 120 means so much, like that. Here it is 20 and 30%. 3,200 into 20%, 6,400. 4,800 into 30%. 1,400, very good. How much it is? $33,600. Also, we are incurring selling expense. Now, this is our total cost. Correct? From the total cost, we'll reduce further processing cost first. How much is further processing cost? 9,600, 14,400. Correct? Also, selling expense is there, which is 20% of the sales. 6,400, 9,600. 9,600, 9,600. So, can I tell this is nothing but share of joint cost? Can I tell share of joint cost? Now, this is share of joint cost, where the total joint cost is how much? 1,36,000. Out of 1,36,000, if 19,200 is this one, then how much for the GPT? 1,16,800. 1,16,800. Next, they have asked comparative statement. We'll take GPT, we'll take X, we'll take Y. Sales, tell me quickly. GPT 328,000. X 32,000. Y 48,000 minus joint cost. For GPT it is 1,16,800. For X it is 9,600. For Y it is 9,600. And further processing cost for GPT it's not there, but for X and Y they are incurring around 9,600, 14,400. Correct? Correct, no? Also, selling expense. Selling expense is 20% of sales. 3,28,000 into 20%. 65,600. 32,000 into 20%. 6,400. 9,600. How much is the profit of all the three? 3,28,000 minus 1,16,800 minus 65,600. 1,45,600. 30. This profit we know, right? 6,400, 14,400. Hope it's clear. Five, no? 1,16,800 we got. 1,45,600. 6,400. 14,400. Hope it's clear. Next one, please. MTP, right? December 23, set 1, 9th MCQ. In the process, 800 units are introduced, of which 5% is a loss. And closing is 100 units. Transfer to next process 660. If I'm not wrong, answer was 720. We did the same thing, right? So 40, nothing. For 100, it is 60%, which is 60. For 660, 100%, which is 660, 720 equivalent units. Next one, 5A now. A product passes through two processes. The output of process 1 becomes the input of process 2 and process 2 is transferred to warehouse. That means finished goods. The quantity of raw material introduced in the process 1 is 20,000 kgs at the rate of 10 rupees. So debit side we will write unit column 20,000, amount column 2 lakh. Cost and output data for the month under review is as under. Again extra material is there 60,000. Here output column you don't write anything. Unit column. Direct labor 40,000, production overhead 39,000, total 1,39,000. Correct? Normal loss is 8%. As you introduce 20,000, 8% of that will come to 1,600, which means the expected output is 18,400. But the thing is, expected input is coming to 18,000, which means 400 is abnormal loss. Scrap recovery is there, 2 rupees. Going to next process. Whatever amount is transferred from the process 1, that will come in the as a 2 process 1, and also we are incurring extra cost of around 1,10,250. Correct? And whatever the input is there, 18,000, of that 5% is a normal loss. 18,000 into 5%, which will come to 900. So out of 18,000, if 900 is gone, 17,100 should be the output. But the output is 17,400. That means 300 is a abnormal gain. Company's policy to fix the selling price of the end product in such a way that to yield 20% profit on selling price. So you'll find out a total cost in second process. That will be 80, 100 question mark. Why? 20% of selling price. Then selling price take it as 100. Profit will be 20. Then cost will be 80. 80 means that one. 100 means question mark. Prepare a process account. Determine the selling price. Very simple. I will show it here only. Process 1. And then we added this. Here normal loss 1,600. Scrap recovery 3,200. So 3,39,000 minus 3,200 came to 3,35,800, and actually our output was supposed to be 18,400. So 18,400 if you divide 18.25 per unit into 400, 7,300, and 400 into 18.25, 7,300. Okay, that's not 73,000 actually, 7,300. And 18,000 into 18.25, 32 lakh, 3,28,500. Okay. Now that will be taken to this one. For that again we will add direct material, direct labor, production overhead, and you know that abnormal gain we got. Correct. So debit side try to understand 328,500 plus 40,000 plus 30,000 plus 40,250 minus 2,700 normal loss recovery. Divide it by 17,100, right? Actual units minus normal loss. 17,100. 25.5 is the per unit. That's what we are going to charge to abnormal gain. So we got to know 25.5 is the cost per unit. Selling price should be 80 means 25.5, 100 means question mark. $31.875. That should be the selling price to make the profit of so much. Hope it is clear. Can you solve it on your own? Next one. Ninth MCQ. 1,200 units were introduced in the process in which 120 unit is a normal loss. If the actual output is 900, try to understand. 1,200 we introduced. In that 120 is going as normal loss means output was supposed to be 1,080. but the output is just 900. That means 180 is a abnormal loss. Option B. Sorry. The main purpose of accounting JPBP is to determine the replacement cost, determine the opportunity cost, determine profit or loss of each product line. None of the above. C. Next up. 4. 4B now. A company produces product M by 3 distinct process before it's ready for the sale. From the information given below, work out the selling price of the product if the management wants to earn profit of 20% on works cost. On cost, 20% they want. Prepare a process account. Input in process A, we are giving 10,000 input at the rate of 40, which will come to 4 lakh. Normal loss in the input is 5%, whereas input was 10,000, 5% means supposed to be 500. That means output was supposed to be 9,500, but the actual output is just 9,000. Moral of the story, 500 is normal loss. Labor cost 15,000 is there, variable overhead is 150% of that, which will come to 27,500. Fixed overhead will come to 250% of that will come to around 37,500 if I am not wrong. So finished goods held back, which means held in the stock is 400, which means try to understand. Delivered to next process is 9,000, held in stock is 400. That means only 100 is abnormal loss. Total produced is 9,400. That will be kept as a closing stock with us only. Next process we transferred 9,000. Okay. When we transferred 9,000 guys, 5% is again a loss. 9,000 into 5%, 450. So out of 9,000, if you reduce 450, 8,550. But transfer to next process is just 8,000 because 400 is held back, which means 150 is abnormal loss. 150 is abnormal loss. This thing I told you already. Next process you see there. 8,000 is transferred. After 5% means 400 is a normal loss. That means output was supposed to be 7,600. They are not telling anything. Then we will assume that much only it is. No abnormal loss, no normal loss. Okay. Sorry. Sorry, normal loss is there. Abnormal loss is not there. Whatever is there, everything will be transferred. See there, input 10,000, 4,000, 15, 22, 37,500. Here, normal loss 500. No scrap recovery is there. Abnormal loss, we computed 100. I told you this will be held as closing stock. Process B, 9,000 we transferred at the cost of 4,50,000, and these things we incurred, and normal loss 450, abnormal loss 150. I told you if you remember, and remaining things was held as a closing stock. In process C, there is no abnormal loss as such. Whatever is there, everything is transferred to finished goods. Simple one, right? Nothing special is there in that. CBA manufactures certain grade of product M, B1, B2 in the course of manufacturing product M, main product, byproduct B1 and B2. The joint expense is 2,37,600. This just now we have done if you remember. All three products are processed further after separation and sold as per the detail below. Sales will be 2,120,000, 80,000. Cost after separation is so and so. This is product M, okay? Not this. Percentage on sales is 25, 20, 15. So they are helping you out in finding out the profit. So profit here it will be 50,000. Here it will be 24,000. Here it will be 12,000. Correct? Total fixed selling expense are 10% of the total cost of sales, which are apportioned to three products in the ratio of 20, 40, 40. So of the total cost of sales, so when you reduce the profit from the total sales, that will give you total cost of sales. Of that, 10% is what? Selling expense. Prepare a statement showing apportionment of the joint cost. If the product B1 is not subject to further processing and is sold at a point of separation, for which there is a market for 1,440,000 instead of 120,000, it will be 1,440,000 without incurring any selling expense. Would you advise Guys, how much you will lose? Sales around 19,560 will lose. Correct? But to make that sale, you are incurring 15,000 here plus some selling expense. So if at all that cost is more than the amount what we are losing, that incremental revenue is less than incremental cost, then better sell it at split off. That's what it is. Okay. I will just show it in the answer key only here. 5A. See. We got to know the cost of sales by reducing the profit. Got it? Which will come to 3,14,000. Of the 10% is the selling expense. So we took it in the ratio of 20, 40, 40 as they have only given. That will give us cost of production. From that, if you reduce after separation cost, that means what you will get is a joint cost only. Now try to understand by product, your selling expense is coming to 12,560. After separation is coming to 15,000, which means net around 27,560 is the extra cost. However, extra revenue is coming to around 19,540. So it's better to sell at a point of separation. Got it? That's how you are going to do it. Hope it's clear. Not much special there. Next up, June 24. In which of the following situation an abnormal gain is up in a process occurs? When it will occur abnormal gain? When normal loss is equal to actual loss? No. That time no loss, no abnormal gain. When actual output is greater than the planned output, that's when the abnormal gain arises. No. Planned output means input minus normal loss. Expected. Got it? In fact, fourth one also, when actual loss is less than the expected loss, that is also correct only. Either B or D. What they are doing? Sixth one, B or D? They are taking it as D. Basically, they are treating it as, but the thing is, both will be same only. Either output is more from the output point of view or loss point of view, loss is less. How much? Which one? Ninth one. MCQ 9. 14 it is. Equivalent production 1000 units, 60% complete, 600. Next up. This we have done just now, if you remember. Reverse calculation. Next up. December 24, 5A na. Same. Next. 7, 8, 14 MCQs are so much. In 15, from one separate this thing. If the actual loss in process is less than the normal loss, the difference is abnormal gain. Correct? So in the question, if they ask, then tick that abnormal gain as loss comparison rather than output comparison. Okay, both are correct only, but they are giving everywhere this way means tick that. Next up. A company makes a profit which passes through single process. Details of the process for the last period is as follows. Material 10,000 kg at 50 paise per kg, which means 5,000. Labor 1,000. Production overhead 200% of labor, that is 2,000. Normal loss are 10% of the input. So input was 10,000. So normal loss is 10% of the input, which is 1,000. And without any further process, any loss can be sold at a scrap of 20 paise, which means this could be sold at 200 rupees. Output of the period is 8,400. That means 600 is an abnormal loss. Correct? There was no WIP at the beginning and end. Value of the abnormal loss will be very simple. 5,000, 6,000, 8,000, 8,000 minus 200, 7,800. divided by 9,000 into 600. 520. Correct? None of the above, na? 8,000 they have given now. 200. 2,000, 8,000. Total cost was 8,000 only, no? And normal loss are 10% of the input of the process. Okay. Any loss of the scrap could be sold at 20 paise. Done. So that we took 200. So 8,000 minus 200, 7,800 divided by 9,000 units only into 600 is a abnormal loss, correct? 520 only it is. Minus 120, still 400 it is. If you reduce, like final figure you want to take also, if you reduce 20 paise per unit also, you are getting 400, not 200. I don't know how they are getting that. Leave. You understood this method, no? Next up. 14, 600. Next up. Three process, 10,000 units at the cost of 1.1 is introduced. Process A, we are incurring extra expenses like this. How much it is? 7,000. Process B, we are incurring extra expense of. Process C, we are incurring extra expense of. Wastage in the process A, 5%, process B, 4%. So A, 10,000 when we introduce, 5% is a normal loss, which means 9,500 should be the output. But the thing is, nothing about the output they have given, which means we assume 9,500 only is transferred. And from the 9,500, when we transferred from the process B, again 4% was the loss. 9,400 into 4%? To 380, na? Okay. So input for the process C will be 9,500 minus 380, which is 9,120. 9,120. And what they are telling, listen here. This is a nice question. I will just show it, okay? Computation. I think in class we have done this, right? No, no. Listen here. First process A I will do quickly. We are introducing 10,000 units, right? Introducing 10,000 units at the rate of 1.1, which will come to 11,000. And also extra cost incurred were 7,000. Extra costs were 7,000. Correct? 5,000, 6,000, 7,000. And normal loss is 5%, 500. So scrap recovery from the normal loss is 500 into 0.25. 125. We are transferring 9,500 units to next process. Total cost was 18,000. So we are transferring 17,875. So you didn't calculate per unit and also because abnormal loss is not there. Got it? We'll go to the process B. 9,500 at the cost of 17,875. And we incurred extra cost of 10,500. Correct? And normal loss was 4% of this. 95, 190, 190, 380. 380 and scrap recovery is 380 into 0.5, 190. So total cost was coming is how much? 28,000. 28,375. We are transferring around 9,120 units to C at the cost of to 185. 28,185. Now it is important. 9,120 units we are receiving at 28,185 and we are incurring 75. And we are incurring extra cost of 8,000, 9,503. Correct? And we don't know how many units we are transferring to next process. But one thing we know, whatever the wastage it is, from that 1 rupee we are recovering. Whatever the wastage it is, from that 1 rupee we are recovering. And we have to do that again. Why you guys don't tell anything? You will not see the question only, no? Some random person will be doing why we should tell that? Correct. Simply he shared question something. Who will download it and all? Our internet will go. Instead of that, we'll scroll one more post in this one, Instagram. Why to waste the internet? Isn't it? Process A. Remember, 10,000 units we introduced. 11,000. Material was, that is done. And extra cost we incurred was 7,000, right? 5,000, 6,000. 7,000. Normal loss was 500. Recovered was 125. And also overheads is 160% of direct labor. 4,500 into 160%. 7,000. That much is coming out. 7,200. So total cost is that will come to 25,75 for the 9,500 units. In the process B, 9,500 units, 25,75. Expense incurred are 10,500. Correct? And also overhead is 160% of 8,000. 12,800. And normal loss is 4%. 380. Right? And recovered is 0.5 per unit. 190. Sorry? Total? 48,375. 48,375. And 9120. How much is this? 185. Got it? Now going to process C. Process C, try to understand. We gave 9120 units at 48,185. Extra cost incurred are 7,000, 8,000, 9,503. Correct? And overheads are 6,500 into 160%. 10,000. Total please. 68? 88. 68, 88. Correct? Now, we don't know how many units are actually output. But one thing we know. Selling price is 10 rupees. That too after charging profit of 20% on sale. That means total cost per unit is rupees 8. Agreed? Total cost per unit is rupees 8. How did we arrive at it, sir? Very simple. We got cost of 68,088. Correct? From that, we reduce normal loss recovery from X number of units. How much was a normal loss recovery? Per unit 1 rupee. Correct? So, we reduced X number of units divided by Input was 9120. From that, X number of units we reduced to arrive at a good number of units. That is 8,008 into 9120. Huh? 72,960 minus 8x is equal to 68,088 minus x. That is 72,960 minus 68,088. 4872 is equal to 7x. X is equal to 696. So units transferred is 696, but they are asking is units lost is 696. All they are asking is how much is a loss percentage. 696 where the input was 9120 into 100. 7.63 percentage. Hope it is clear. 7.63 percentage. Next 5A na. This is same like what we have already discussed. Remember? But here sales they haven't given directly. You have to compute by multiplying this. On that you have to find out that percentage and all. Next. No MCQ. Question number 5A. This I feel we have done this, right? Done this, no? When? Is it? Next. 8th. MCQ number? No MCQ. Question number? Recon Limited is engaged in the process engineering industry. During the month, 4,000 units of input were introduced in process B at a cost of 20,000. The normal loss was estimated at 10% of the input, which means we are expecting around 400 units as a loss. Process cost, direct material 10,425, other than this 20,000. Direct wages 20,400. Factory overhead 50% of the direct wages, which is basically 10,200. At the end of the month, 3,200 units were produced. Actually, you are supposed to produce 3,600, but you are producing 3,200, which means 400 is a abnormal loss. And transferred to process C. 500 units were scrapped and realized rupees 5 per unit. At the end of the month, 3,200 units were produced and transferred to process C. 500 units were scrapped and realized rupees 5 per unit. Scrapped units were 50% complete, which means they are giving information about abnormal. They are giving information about abnormal. 300 units were incomplete, it seems. So try to understand. So actually we thought no, around 400 is abnormal. No, 400 is not abnormal. Only 100 is abnormal because other 300 is the closing there. And closing is complete in terms of material 75%, wages and overhead 50%. So here opening balance they haven't given. Moral of the story, doesn't matter whether it is weighted average or FIFO. Okay. Now listen. I will just show it here only. 5A, right? First, input of 4,000 we are giving. We are transferring to next process 3200. Of course, equivalent units will be 100, 100, 100. Normal wastage 400 we computed. For that, there won't be any equivalent units. Abnormal wastage is 100, and they have told that it is 50% processed. Try to understand. These 500 units are there, no? That is 50% processed. So, actually it is not 100 here material. Abnormal wastage, it is 50. %50 only they are telling, no? 50% processed. Okay. So, what they are assuming is, as nothing is told about material 100% we introduce. So, only processing wise labor and overhead it is. So, we'll take 100% only, no worries. So, it will come to 100. This will be 50-50. Okay. WIP at the closing they are telling. Material wise it is 300 units were incomplete. Material 75%. Wages and overhead 50%. So, they are taking main material as 100% only. Secondary material they are taking it as 75 and 50. Okay. So, total you will get. Now, you know the total cost there. Normal scrap recovery from the normal loss should be reduced from the total cost. Correct? So, you will divide it by the equivalent units. You will get the cost per unit. Then you are going to multiply respectively. Okay. All these questions see once. Next. No MCQ. 5. Which paper? December 25. Now, just now we have done this set June only, no? Set 2 only it was. That's what I am telling. 8th MCQ. The type of process loss that should not be allowed to affect the cost of good unit is called as should not be allowed to affect the cost of good units. Abnormal loss, because normal loss should be apportioned to good units. 5. Following is relating to process 2. We introduced 4,000 units at 9,000 and incurred extra 5,000 rupees. Transfer to finished stock, we are transferring 3,240. Factory overhead in process are absorbed at 400% of direct material, which is basically 3,000 into 400%, 12,000. Allowance for the normal loss is 20% of the unit worked, that is 800. 4,000 into 800, 20%, 800. That means 40 is abnormal gain. Correct? Scrap value is 5 rupees. Demonstrate the cost transfer to finished goods. Using the information, show the amount of gain or loss. Simple. Next. But yeah, remember, abnormal gain will be there. Everything won't be transferred to costing P&L. After adjusting the normal loss related stuff relating to that abnormal gain, then only remaining things only will be transferred to costing P&L. Next. 8th MCQ. That's it. Class guys fast forwarding. Oh.
The same 8th MCQ is left in both sets.
Shut up. Set A. Set 1 5A na. This is that question what is there in material, if you remember. One question we have done. Process account and stock account together. Process A and process A stock account, process B and process B stock account. That question, go through that once. Nothing special in that. Next up. In the process, 5,000 units were introduced. 5% is a normal loss, 250. Closing WIP is 625 units, which is 60% complete. 4125 is completed and transferred. Okay. Just check when total is coming to 5,000 or what? Coming, no? So this normal loss nothing. 625 into 60%. Huh? 375 plus 4125. Option B. That's it. Yes. All these questions you go through once. Tomorrow we'll start with marginal costing and cost bookkeeping, and we'll finish off the revision session. Most probably it will get over by 1 or 2. Okay, by afternoon we'll complete it. 1 or 2. Cost bookkeeping is there, no? I mean, that won't take much time because I'm not going to explain you the entries, why it is and all. I mean, I will explain the entry, but not in that depth. So let's see. No worries. We'll meet you guys tomorrow. Bye bye. Same time. Okay. Now we'll be revising cost bookkeeping. Okay. So basically, bookkeeping is nothing but maintaining the records of cost accounts. Okay. So that could be done in 2 ways. Integrated cost booking or cost accounting system and non-integrated cost booking or cost accounting system. Integrated cost accounting system means system of cost accounting where financial as well as cost records are maintained in the same set of books. Okay. Integrated means financial as well as costing books are integrated. They are maintained in the same set of books, that we call it as what? Integrated cost accounting system, where those are maintained in the 2 separate books. Those are maintained in 2 separate books. That thing we call it as non-integrated cost accounting system. That is financial as well as costing. Both are maintained in 2 different books. Okay. And first we will discuss about non-integrated cost accounting system. Pure financial items are not recorded in the non-integrated cost accounting system. Pure financial items won't be recorded. Dividend, interest, your bad debt, all these, whatever the pure financial items are there, goodwill written off, all these things won't be taken in the cost books. Also, we are not going to maintain few financial ledgers like cash, bank, debtor, creditor, purchase, sales, reserves, capital, like that. Whatever that not related to production, whatever the accounts are there, no, those all accounts we are going to ignore. Okay, sir, we will ignore all those non-production related accounts, but how will you book the entry then? You have to make the double entry, no? Yes. So debit you do one thing, let's say credit what you will do, or credit you will do, debit what you will do. If you didn't maintain this, guys, for that purpose, we have opened one special account called GLC account or CLC account or GLA account. General ledger control account, or we call it as cost ledger control account, or we call it as general ledger adjustment account. Okay. So GLC or CLC shall be open to complete the entry as per the double entry system. What are the different important ledgers will be maintained under cost accounting system, sir? One is general ledger adjustment account. That is nothing but to replace a few financial ledgers which we are not going to record in our cost books, and just to make sure that double entry is taken care. Stores ledger account, or we also call it as material control account. That is nothing but material related stuff. When we receive the material, when we issue the material, all those things. And wages control is nothing but related to labor cost. That is when we incur a labor expenses and all, that time we are going to record that. Factory overhead is nothing but related to indirect cost of production. Sometimes we also address it as a production overhead account. Sometimes we also address it as a manufacturing overhead account, works overhead account, depending upon what they have mentioned in the question. Administration overhead related to cost of administration. Again, that could be divided into related to production, not related to production. Let it be. Selling and distribution overhead control account, that is related to indirect cost of selling and distribution. WIP control, WIP control, that is nothing but your production account itself, or you can call it as factory or production related account. Basically where the production takes place, all the production related information will be recorded where WIP control account. Finished goods control account, in that we will be recording the finished goods account, and if at all you want, you can prepare COGS account also relating to cost of goods sold, or directly you can transfer it to cost of sales, that is COS account, and costing P&L is finally everything to ascertain the profit or loss. Before understanding the entries, the first main thing you should understand is how generally the process works, whole factory process works. Try to understand. First we'll buy the material from the supplier. We will pay to our laborers. I'm not telling only direct material, indirect labor, or direct labor, only those stuff, total, overall. And we might incur few direct expenses. Okay. And whatever the direct will be there, no, material, labor, expense, that will be charged to production directly. Factory, yes, that production, I told you one thing. What is it? WIP, work in process. That production is nothing but WIP, work in process. And indirect labor, indirect material, indirect expenses will be charged to respective overhead. What do you mean by respective overhead, sir? If it is relating to factory, it will be charged to factory overhead. It will be sales, selling and distribution. It will be relating to, if it's relating to admin, it will be charged to admin overhead. Got it? Then we know that whatever the production overhead will be there, factory overhead will be there. Of course, that will be charged to factory. That will be charged to factory. In fact, we call it as absorbed to factory, because we know that overhead we don't charge actual numbers, we take the absorbed numbers. Hope it is clear. Yes. And sir, what if it is admin overhead? Listen here guys, don't get confused here. Admin overhead, once we add direct material, direct labor, direct expense, factory overhead absorbed, that WIP, from WIP it will be transferred to finished goods. It will be transferred to finished goods. After transferring to finished goods, if at all we incurred any admin overhead related to production, that shall be absorbed, or that shall be charged to finished goods. So always remember, admin overhead related to production is always charged to finished goods, not to WIP. Next, sir, next is nothing but your selling and distribution overhead. Selling and distribution overhead. Guys, you know that selling and distribution overhead is not relating to units produced, but it is relating to units sold. That's why we are going to charge it in the cost of sales. So from finished goods, what you will do, sir, whatever the sold units are there, that shall be transferred to either COGS or to the COS. So COS consists of what and all, sir? Very simple. Cost of goods sold, yes. Selling and distribution overhead, also admin overhead, which is general in nature. We have seen that in cost sheet only, if you remember, right? For COGS, we used to add these two. We'll arrive at COS. And one major thing you have to remember, guys, selling and distribution, if they don't tell anything in the question, whether it is absorbed, not absorbed, then always remember one thing. It is treated as completely absorbed. Whatever is incurred, everything shall be charged to selling and distribution. Everything shall be charged where? Cost of sales. Hope it is clear. Now, from the cost of sales, all these three together shall be taken to costing P&L. In the costing P&L, we are going to compare the incomes like sales. But sales account is not opened, so no sir, I will tell that. Don't worry. Sales, that shall be compared with the cost of sales. At the same time, we know that few abnormal things will be there, like under absorption, over absorption, all these things. So if it's over absorption means we have shown a more expense. So now we will take it as a income. Under absorption means we have showed less expense. Now we will show it in the costing P&L as a debit expense. We'll compare all these things and we'll get a profit. And always remember, profit now you can't transfer to reserves here. Why? Reserves account or capital account is not open. So instead of that, we will be transferring it to general ledger control account. Hope it is clear. Yes. So first we'll purchase material, we'll pay for labor, we'll incur direct expense. Direct expense means, of course, we know that it's related to factory. Now, direct material, direct labor will be transferred to factory or production. Indirect material, indirect labor, indirect expense shall be charged to overheads, respective overheads. Now, once the overheads are done, then whatever the factory overhead is there, that we are going to charge it to production. Whatever the admin overhead related to production is there, that we will be charging it to finished goods once that is transferred from the WIP. Whatever the admin overhead related to general is there, that shall be charged to cost of sales along with the selling and distribution. From the finished goods, of course, cost of goods sold we will transfer. And from the cost of sales, after adding all the expenses and all, we will be charging it where? We will be charging it to costing P&L. So along with that, we will be matching our income with that. That is nothing but our sales. And under absorption, over absorption treatment we will give, and we will transfer that profit to the general ledger adjustment account. Hope it is clear. Clear or no? Yes. Clear. What are the few journal entries, sir? First up, when we purchase material, guys, very simple. And one more thing you have to remember here. In these accounts, try to understand. Your general ledger adjustment is like a nominal account which is open to match the double entries. Of course, the balance will be there. Okay. So this balance will be there. Stores ledger is nothing but your material account, inventory account. Of course, the balance will be there. Correct? But wages control, it is our expense account. We don't keep the balance. Factory overhead, these are also expense account. Generally, we don't keep the balance. However, if the question tells keep the balance, then you keep the balance. Under absorption, over absorption. Generally, under absorption, over absorption, we'll charge it to P&L and we'll write it off. However, if the question particularly tells keep the balance, then we are going to maintain the balance. Even admin overhead, same thing. Selling and distribution, same thing. WIP, you know that. Of course, the balance of WIP will be there. Units in production and all. Finished goods is finished goods, inventory. Can you sell everything, whatever you produce? No. This also balance will be there. Cost of sales, balance won't be there. Cost of P&L also, balance won't be. Hope it's clear. Admin overhead balance is charged to finished goods or WIP. If at all it is related to production, it will be charged to finished goods. If at all it is general in nature, it will be charged to cost of sales. Purchase of material, when we purchase the material, normal entry, guys. Purchase account debited to vendor. Here, purchase account we are not maintaining. For material, we are maintaining a separate account called as stores ledger or material control. So it is SLC to supplier. We don't maintain supplier account or cash account. Instead of that, that is replaced by special account called general ledger control account. When we make a payment, sir, when we make a payment, what will be the entry? Of course, it is the expense. Wages control account we will debit and GLC will credit because no cash or bank can be taken. Direct expense incurred, sir, name itself says it's a direct expense. We know that it's related to production. So straight away production account only we will debit. That is WIP control account debited to GLC account. WIP control account debited to GLC account. Sir, now whatever the material you had, that you are going to issue it to the production, which means direct material, right? So production account will be debited, and of course the material is going out, stores ledger will be credited. That is WIP control account debited to SLC account. Indirect material issued, that is nothing but when you issue indirect material, I told you that particular overhead will increase. So you have to debit it. So respective overhead control account will get debited, whereas SLC will get credited. Direct labor introduced. Direct labor will be introduced, of course, to the production. So we are going to debit WIP and credit wages control account. Indirect labor, sir, indirect labor, of course, we are going to debit respective overhead account because that will be increasing, and our whatever we have booked it in the wages control account, beginning, direct, indirect together, that will get reduced. So we are going to credit it. Eighth one is the charging of direct expense, leave that. Incurrence of overhead, when we incur the overhead directly, then we are going to debit the respective overhead account as it's an expense, we are going to credit instead of bank or cash, GLC. Now, absorption of overhead, when we incur a overhead, we debited it, now we have to transfer it, which means overhead will be credited. And factory overhead will be absorbed to WIP, we know that. So, the entry will be WIP control account debited to factory overhead control account. Now we know that from the finished goods, that is, from the WIP, it should be transferred to finished goods, whatever the produced number of units. So what we are going to do, sir, we are going to debit finished goods control account, that is increase in the finished goods and decrease in the WIP. So credit the WIP control account. And admin overhead related to production will be absorbed. We know that it will be absorbed to the finished goods. That is, when we incurred overhead, we debited it. Now we are absorbing it, so we should credit it. So we are going to credit overhead account, that is admin overhead account, and we are going to debit finished goods control account. Selling and distribution, selling of finished goods, from the finished goods account, we are going to take out at a cost only. Always remember, always remember, always remember. Not sales. Only cost of goods sold we will be taking it out. Got it? So we are going to debit the either COS account or cost of goods sold account. As the finished goods is going out, finished goods account will be credited in the book. Admin overhead, which is general in nature, will be absorbed. We know that it will be absorbed to the cost of sales. So cost of sales, that expense will be increased, whereas admin overhead, whatever debit was there, that was transferred to the cost of sales. So admin overhead will be credited. Selling and distribution absorbed, of course, we are going to book it to COS by taking it out from the S&D overhead. Sales amount credited to costing P&L. Listen, generally what will be the entry? Bank to sales. Sales to P&L. Correct? Basically, can I write it as bank to P&L? Do we write bank here? No. Bank is replaced by GLC control to costing P&L. Got it? If at all you are maintaining integrated account, it is P&L account. If at all you are maintaining non-integrated account, it is costing P&L account. Then we should book the expense also, no? From cost of sales, we should transfer to costing P&L, no? Whenever we booked in the cost of sales, we debited it. Now we are transferring it to costing P&L. So cost of sales will be credited. P&L will be debited. That is costing P&L account debited to cost of sales account. Now under absorption, over absorption, very simple guys. If you take this as a overhead account, when we incur expenses, you debited, let's say now incurred 1 lakh. So you debited 1 lakh. When we absorb, we will credit it. Let's say we absorbed 80,000, we credited. So what balance is there? Debit balance is there. How much? 20,000. Always remember, balance means which side is more, that balance it is. Credit side balancing figure, it is debit balance. Got it? So 20,000 debit balance is there. Agreed? Now my question is it under absorption or over absorption? It is under absorption. Why, sir? You incurred 1 lakh. You absorbed. That means 20,000 is what? Under absorption. So always remember, whenever it's under absorption, overhead will have a debit balance. So now to transfer that to costing P&L, you have to credit the overhead account and debit costing P&L account. Basically, if you are able to understand this whole segment, then majority of the things are sorted. Based on this only, all the journal entries we have formulated that day, if you remember. Yes, each and everything, how it moves, that thing we have seen. But now, as it's a revision, I'm not going to explain in depth, but I hope now you are able to recall it. So, if it is under absorption, over absorption means what, sir? Try to understand. Overhead account, debit side, let's say we incurred 1 lakh. So when we absorb it, of course, we are going to credit it. Let's say we credited 1,30,000. Now 30,000 credit balance is there. Correct? Now my question is it under absorption or over absorption? Over absorption. You incurred 1 lakh, you absorbed 1,30,000. So that will have credit balance. Now to take it out, you have to debit it. You have to debit it. That is respective overhead control account debited to the costing P&L. Got it? And if at all you return material from the stores to your supplier, then of course supplier account will be debited to stores ledger control. However, supplier account we don't maintain. That will be maintained by our accounting department. Being a production department, we care what happens inside the factory. So we are going to debit general ledger control account. We don't care what is happening outside. We are concerned what is happening inside the factory. That thing we will account for. Outside, everything we will treat as GLC. Finish. And sir, from the production we are returning it back to stores. That is, stores will get added. Material will be received by stores. So that will be debited. And from the manufacturing, it is going out. From production, it's going out. So if production cost is decreasing, so we have to credit WIP control account. SLC to WIP control account. Hope these entries are clear. And balance in costing P&L account shall be transferred to GLC account. Sir, when you should adjust the under absorption or absorption, one, when they are particularly asking the question to adjust it, take it to costing P&L and all. Otherwise, when the accounting is done for the year end, and in the opening balance what they give, in that also, opening TB what they give, in that also if the overhead account is not maintained, then you can write it off. However, in the opening balance what they have given, if they have maintained it, then we have to maintain it. Don't write it off to costing P&L. Generally, they will only clearly tell what you should do. However, selling and distribution, it's always better to transfer it to cost of sales once we incur. Although if the question is silent. Integrated cost accounting system. Now, that is very simple. That is nothing but just like your non-integrated cost accounting system only. But here, both outside as well as inside the factory will be maintained. What do you mean by that, sir? Inside factory, whatever we are maintaining, stores ledger control, WIP control, factory overhead account, finished goods control, all this control account what we are maintaining. Along with that, cash, bank, share capital, reserves, building, all those things also will be considered. Which means both financials as well as costing information will be there in your integrated cost accounting system. Which means there is no necessity of general ledger adjustment account. So in the question, if at all you are confused regarding whether they are asking integrated or non-integrated, just check the trial balance. In trial balance, whether general ledger adjustment account is there, that is non-integrated. It's not there, then it is integrated. Got it? This is your integrated, non-integrated. Hope it's clear. Sir, but still, sir, this is bit of confusing, sir. Is there any code word for that? I generally don't recommend that. Generally don't recommend, but yeah, still, something is better than nothing. So remember one thing, whatever the thing receives it, whatever the thing receives, that you have to debit. That you have to debit. Whatever the things outflow, that you have to credit, or whichever gives, that should be credited. For example, material issued to production, receiving department will be WIP, correct? Issuing department or giving department will be SLC. When you purchase material, receiving department will be stores, so that we will debit, and giving department will be your cash or bank. So instead of cash or bank, we are going to credit GLC, like that. Okay. Production overhead when we incurred. So now increasing in the overhead, so will be of course debited. Okay. So bank or cash will go out. So GLC. Now production overhead will be charged to production, let's say. Then which is receiving department? WIP will be receiving the effect on that. That is receiving the WIP will be added with the cost of production overhead absorbed, whereas giving department is overhead account, like that. Okay. You can remember this way. If at all you don't know anything, hope it's clear. Also listen, generally if you take SLC account here, if you take SLC account here, whenever we buy, we pass it as to CLC or GLC, correct? When we return to our vendor, we write it as by CLC. When we issue it to production, we write it as by WIP. When we issue it to overhead, we write it as by overhead. When there is a loss and all, by costing P&L. However, if they tell loss is normal in business, then we should charge it to production overhead. So we are going to charge it to by production overhead. Production overhead, from production overhead it will go to WIP. And if at all they return as a goods to WIP. And after this we'll compare balance. Simple. Like that, you should check each and every account will have what impact, or it is getting impacted by what and all. Okay. Generally stores will be getting impacted with we purchasing it, we issuing it to production, we returning it to supplier, our production department returning it to us, and we issuing it to production, we issuing it to overheads, and if any shortage and all is there. Normal, abnormal. Abnormal means costing P&L, normal means treat it as a production overhead. Got it up? Going to wages account. Wages account, generally debit side, whatever we paid, that will be there. Credit side, how much we charge to the WIP, that is production, and how much we charge to the respective overhead account. Now if at all anything left over, that we are going to treat it as some not yet allocated wages. We can't keep the balance of wages, because wages balance cannot be kept. Just because you paid wages today, tomorrow if you ask them to come and work, they can't, they won't. So what you are going to do, you are going to treat it as a production overhead and charge it there. In particularly if they tell it is abnormal, then only you charge it to costing P&L. Okay. In WIP account, what will be there, sir? Debit side, opening balance will be there, of course. In stores also opening balance might be there. And WIP, whatever the expenses we incurred relating to production, that is material issued to production, wages relating to production, and overhead absorbed, which overhead? Production overhead absorbed, all these things will be debited. Credited if at all we returned anything from the production, like by stores ledger, all those things will be there, and what we transferred to finished goods will be there, and what balance will be there, that is there. And if you go to finished goods account now, that will be having debit side, opening balance will be there. Of course, along with opening balance, what we received from the WIP, that will be there in the debit side only, and also admin overhead related to production, if at all we incurred it, that will increase the value or cost of the finished goods, so that will be there. Credit side, generally how much is the cost of goods sold, that will be there by COS or by COGS, and finished goods closing stock will be there. Now going to closing stock, or sorry, cost of sales. Cost of sales, of course, debit side, finished goods will be there relating to cost of goods sold, admin overhead generally will be there, and selling and distribution will be there. Credit side, of course, we will be transferring it to finished goods. Sorry, not finished goods, P&L. Now in the costing P&L, debit side, cost of sales will be there, under absorption will be there, Any other expense which is not at book, that will be there, or abnormal items. Credit side, GLC will be there relating to sales, over absorption will be there, or any other income which is not at book, abnormal income, that will be there. Correct? Huh? And whatever the profit is there, that shall be transferred to GLC. That is, if at all it's a credit balance, that means profit it is. We'll write it as to GLC. If at all it's a credit balance, sorry, debit balance, that means loss, we'll write it as by GLC. Debit balance, credit balancing figure. Got it? Huh? So GLC account, what will be there, sir? Debit side generally, guys, generally credit side opening balance will be there, because your WIP, finished goods, stores, all these are assets. So debit, to match the debit, GLC will be there in the credit. So generally that will be there in the credit, and whatever the cost we incurred, whatever, all those things will be credited there. You remember? All those will be credited by stores ledger, by wages, by overheads, by selling and distribution, like that. And when we receive anything, inflow, then we will be debiting it, debiting the GLC account, that is to P&L, costing P&L account relating to sales, like that. And profit or loss, whatever we transfer, that will get adjusted. Hope it is clear. See, basically, if you close your eyes and sit, for you, first thing should be, that thing should come in mind. Chart. Then all these journal entries should come. After that, that ledger should come in front of you. Now, if you know the ledgers, then journal entry will be easy only. When the particular account is getting debited, when it's getting credited, if you know that, then journal entry is that only. No? Hope it is clear. Now the major one and examiner's favorite, reconciliation. What is it? Reconciliation. We'll be starting that now. Okay. All the questions we'll see together on. What do you mean by reconciliation, sir? Reconciliation is nothing but, guys, identifying why the difference is arising. That is, identify the causes for difference between two amounts, that we call it as reconciliation. The statement which shows why the difference is coming, that thing we call it as reconciliation statement. Here we will be doing reconciliation to reconcile. That is, to find out the difference between, causes for difference between costing profit and financial profit. Costing profit and financial profit. So basically here two profits are there means, is it integrated, non-integrated? Of course the non-integrated. Integrated means why two profit will come? Because financial and cost books will be maintained together, no? One profit will be there. Here it is two different books, two different profit. Got it? So this is done only in case of non-integrated cost accounting system. So guys, costing profit, where we can find out? Costing profit we can find out using cost sheet. Financial profit, where we can find out, sir? Financial profit we can find out using P&L account. P&L account, trading P&L account. Sir, but why costing profit and financial profit in first place it won't match, sir? Few reasons are there. One, pure financial items. Pure financial items like goodwill written off, bad debt, interest, dividend, premium, all these things will be taken only in the financial accounts. Whereas in cost accounting, we don't account for it, as this is not a cost related stuff. Okay. Next is your income tax and all. Again, income tax and all, that is relating to profit income. In costing, we are least concerned about it. But in financial accounting, we would have recorded it. And notional items, in costing, we take the notional items. But in financial item accounting, always remember, we will take the actual expenses only. We don't take any opportunity or expenses which is not incurred. Only out of pocket expenses will be considered. Got it? So notional items won't be there in the financial accounts as well as overheads. In costing, generally we'll book the overheads on the basis of absorption, whereas in financial accounting we will book it on the basis of incurrence. In costing we book the overhead as absorbed. If you remember, when we were preparing cost sheet and all, factory overhead, 60% of direct wages, 80% of direct wages. Remember? So basically it will be on the absorb basis. Whereas in your financial accounting, have you heard something called absorption and all? Nothing. What we incurred, whether paid or didn't pay, doesn't matter. Accrual basis. Whether you incurred it, you are going to book it as a expense. Got it? And one more thing you have to remember, guys, how the stock and profit will be affected. Opening stock is inversely proportional to profit. What do you mean by that, sir? Opening stock is nothing but increase in your expense. Yes, the more and more the opening stock, more and more the expense, which means it will decrease the profit. Less and less the opening stock, less and less the expense. That is going to increase the profit. So decrease in opening stock leads to increase in profit. Increase in opening stock leads to decrease in profit. Hope it is clear. Closing stock, you know that is nothing but reduction from the expense. Reduction from the expense, because expense you would have booked in the debit side. Credit side you are booking closing stock, means that is nothing but we are excluding the expenses, telling that boss, this is not our current period expense. As this goods is going to be sold next year, we are going to match it next year. We are going to match this cost with the next year's sales. That's why we are crediting now, which means that is reduction from the expense. So less and less the expense, more and more the profit. So try to understand. More the closing stock, more the profit. Less the closing stock, less the profit. Hope it is clear. So always remember, opening stock and profit are inversely proportional. Closing stock and profit are directly proportional. Hope it is clear. Now, sir, how the reconciliation will be done, sir? How the reconciliation will be done? Guys, listen very carefully. Reconciliation, there is nothing called right, wrong and all. There is nothing called right, wrong and all. Very simple. Reconciliation is all about what is your starting point, boss. What is your starting point? What is your ending point? Now, we are going to match our starting point with our ending point. Now, of course, the amounts won't be same. That means there are few items which need adjustment. I mean, we don't adjust it, just we will show it for a decision making kind of stuff. That's it. For a better control. It is not rectification, it's just a reconciliation, not a rectification. So what we will do is, now, for example, let's say starting point is financial accounts. Financial account profit 1 lakh is there. Cost accounting profit 80,000 is there. Financial accounting profit 1 lakh. Costing profit 80,000. Now, why this 20,000 is coming? That we should show to the management. That's why we prepare this reconciliation. Now, how we are going to show this 20,000, sir? Very simple, guys. Very simple. Let's say how this is coming 1 lakh, this is coming 80,000. Example I will tell. Both incurred, let's say some expense as 50,000, 50,000. Both incurred expense of or some profit, net profit of 50,000, 50,000. Okay. Because of one more item, here 20,000 profit is coming. That item is not considered in cost accounting. This financial accounting, this is cost accounting. In financial accounting, we showed one profit, 20,000. We showed one more profit as 60,000. Here we showed that particular profit as 70,000. Okay, 50, 70, 130. And we showed one expense as 30,000. Here we showed that expense as 40,000. Now, to match this with this, what we should do? Simple. First we will start with our financial profit, 1 lakh. Correct? Whatever costing as well as financial accounting is already done, that we will ignore. However, difference is causing because of, let's say, first item. What is that, sir? We have done that. In costing, they haven't done that. Now to match it with the costing, what they have done, we should do now. So what they have done, they haven't done this, but we have taken it as a plus. Now minus 20,000. Minus 20,000. Got it? And because of one more line item, our costing is getting profit of 70, but we are making it as 60. That means what they have done, we haven't done, that we should do now. Otherwise it won't match. So what we will do? Plus 10,000. And here we have reduced 30,000, but in costing they have reduced 40,000. We have reduced 30,000. In costing they have reduced 40,000. That means we should reduce extra 10,000 to match with the costing. How much it will come? 80,000. Got it? So this is what the reconciliation is all about. So basically, remember, and always remember, we are going to see what happens to the profit. What happens to profit, not to that particular line item. So in simple, I can tell, for example, if my starting point is financial accounts, whatever is there in the financial accounts, whatever is not there in the cost accounts, there in financial account, not there in cost accounts, exclude it, take it out. Take it out, take out the effect of that. If you want to match with cost accounting, let's say in financial accounting it's not there, in cost accounting it's there, then of course to match with cost accounting we should include it in your financial. I mean, just to statement, not rectification. You don't have to write it in your financial books or cost books, just showing the reasons. Now this thing is clear. Now what happens? Your financial profit will match with costing profit. Got it? What we have done, they haven't done. Reverse it to match with them. What they have done, we haven't done. Do it to match with their profit. Got it? If at all starting point is cost account, that will give something else only. We'll see one by one. Now listen. Let my starting point be financial account. Let's say as per financial account, profit is 1 lakh. Financial account profit is 1 lakh. And this financial account. Now listen. First one. Expenses recorded in cost accounts but not in financial account. Expenses recorded in cost account but not in financial account. That means try to understand. In cost accounts, we might have recorded some expense. When we recorded some expense, what happened to our profit? Decrease, no? Now let's say cost accounting, 70,000 is the profit. Because we recorded 130,000 expense here. That means to match the financial accounts with the cost accounting, what I should do to that 30,000? Reduce it. That is, they have showed it as expense. Now to match with their profit, you also should reduce it. Reduce your profit. Sir, but if they showed it as expense, I should increase my profit expense. No, sir. Yes, increase your expense. What happens to your profit is the thing here. Because these are the profits, not these are expenses or incomes. These are profit. So what happens to your profit? Because of that adjustment, you should consider. Hope it's clear. Sir, income recorded in costing. income recorded in costing but not in financial account. So can I tell in costing profit is more because you recorded income. Let's say in costing it is 120,000, in financial accounting it is 1 lakh. Why sir? Because 20,000 income is not recorded in financial account. So to match with the costing profit, of course we have to record that income. When you record that income, automatically profit of your financial account will increase. Got it? Next, expenses recorded in financial account but not in cost accounts. So in financial account, profit is lesser than cost accounts because we booked some extra expense. To match cost accounting profit, what we should do? We should add back because you showed it as expense. In costing, did they show it as expense? In costing, did they show it as expense? No. Because of which you should reverse your effect. Reverse your effect. So you reduce the profit earlier by showing it as expense. Now increase your profit. Incomes recorded in financial account. So in financial account, let's say profit is 150,000. In cost account, profit is 120,000. Why sir? What is the reason? Reason is very simple. We booked 30,000 income, which is not booked by cost accounting. Now to match with cost accounting, you should exclude this income. So when you want to exclude the income, that will lead to decrease in profit. So reduce it. Hope it is clear. Overvaluation of closing stock in financial accounts. So try to understand overvaluation of closing stock in financial account means closing stock more. More closing stock means more profit. So in financial account, profit was 150,000. In cost accounting, profit was 1 lakh. What was the reason, sir? Reason was that 50,000 overvaluation of closing stock in financial account. Now to match our financial profit with the costing profit, what we should do? We should reduce our profit. Hope you are able to understand. Undervaluation of closing stock in financial accounts. Undervaluation of closing stock in our financial accounts. So when we undervalue the closing stock, automatically the profit will be less. Here 20,000 profit is less because of undervaluing our closing stock. Now just to match with the cost accounting, what we should do to this 20,000? Add. Increase your profit. You undervalued your closing stock. Overvaluation of closing stock in cost accounts. Overvaluation of closing stock in cost accounts means in cost accounting profit is more. So to match your profit with the cost accounting profit, you should increase. Undervaluation of closing stock in cost accounting, that means in cost accounting profit is less. To match your profit with the cost accounting profit, you should reduce. Got it? Overvaluation of opening stock in financial accounting. If you overvalue your in financial accounting, if you overvalue your opening stock, that means you booked more expense. That means in financial accounting, you booked less expense. Less profit. But in cost accounting, no change as such. Now what you should do to match this? Add it. Whatever the less you showed profit, you should increase it. Correct? In financial accounting, opening stock is undervalued. Undervalued means you showed less expense, which means in financial accounting, you are showing more profit. In cost accounting, it's same only. To bring this back, you should reduce it. Got it? Next. Overvaluation of opening stock in the cost accounts. Because of overvaluing the opening stock in cost accounts, costing profit has been decreased. But in financial, profit is same only. Now, to match the financial accounting profit with cost accounting profit, you should reduce it. Reduce it. Undervaluation of opening stock, because of which in costing we are showing more profit. To match the more profit of the cost accounting, financial accounting books, we have to increase our profit. Increase our profit. Hope it is clear. Next important thing, under absorption, over absorption. Sir, in cost book or financial books, sir, always remember absorption will be there only in the cost books. What do you mean by under absorption, guys? Under absorption means we booked expense less than what we incurred. For example, actual expense is 1 lakh. If we absorb 80,000, this is called as under absorption. Correct? Now try to understand. When there is under absorption, in financial accounts, expense was more because of which profit is less. Correct? In cost accounting, expense is less because of which, of course, the profit is more compared to financial account. Now you can't tell, sir, wrong no sir, right no sir, doesn't matter. Here, your work is to match your financial accounting profit with cost accounting profit. So what you should do? Add. Because you booked more expense in financial account, now you should reverse it. Reverse it. Under absorption is done. Over absorption means what, sir? You are booking expense more than what you actually incurred. You are booking expense more than what you actually incurred. So in costing, expense is more, which means profit is less. In financial, expense was less, profit was more. To match the financial profit with the costing profit, what you should do? Reduce it now. Got it? And now listen, if at all you get a positive number only, then that will be profit as per cost accounts. That will be profit as per cost accounts. Hope it is clear. If at all you get negative amount, then that will be loss as per cost accounts. And sometimes they might ask you to prepare, instead of the reconciliation statement, memorandum reconciliation account also. Memorandum reconciliation account means what, sir? We'll start with profit as per financial accounts here. That means profit, credit side. Profit as per financial account. So whatever the add is there, no, to the profit, all those things we are going to take it in the credit side. Whatever the minus are there, no, all those things we are going to take it in the debit side, because we have to reduce it from the profit. And whatever the balance will be there, that is profit as per cost account. Sir, what if it is debit balance? That is, your negatives are more, then that will be loss as per cost accounts. This is how you are going to do the memorandum reconciliation. Hope it is clear. Sir, what if our starting point is cost accounting? Then here we should try to match our costing profit with the financial accounting profit. Correct? So quickly I will tell. Expenses recorded in cost accounting but not in financial accounting. So we recorded few expenses in the cost accounting, because of which the costing profit will be of course less. But we have to match it with the financial accounting profit. So we should increase the profit now. Increase the profit. Incomes recorded in cost accounting but not in financial accounting. Because of recording few expenses only in the cost accounting, our profit will be more in cost accounting. But to match with the financial accounting, we should reduce it. Expenses recorded in the financial accounting. So because of expenses recording only in the financial accounting, profit in financial accounting will be less. To match costing profit with the financial accounting profit, costing profit also we should reduce. What they have done, we have to do it. What we have done, they haven't done, we should reverse it. Simple. Income recorded in financial account, because of which in financial accounting profit is more. Now to match it with the cost accounting profit, we should increase it. Got it? Overvaluation of closing stock in financial accounting. So in financial accounting, profit is more. Profit is more. To match our costing profit with that, we should increase it. Undervaluation of closing stock in financial accounting. In financial accounting, profit is less. So to match the costing profit with that, we should reduce it. Overvaluation of closing stock in cost account. So in cost accounting, profit is more, but financial accounting, it's less. So to match it with financial accounting, we should reduce it. Undervaluation of closing stock in cost accounts. In cost accounts, the profit is less. So to match it with the financial profit, we should add it. Overvaluation of opening stock in financial accounting. In financial accounting, profit is more or less, less. So to match it with the cost accounting, we should reduce it. Undervaluation of opening stock in the financial accounting. Because of that, profit under financial accounting will be more. To match the costing profit with the financial profit, we should add. Overvaluation of the opening stock in the cost accounting. In cost accounting, profit is less. Now to match it with financial profit, we have to add it. Undervaluation of the opening stock in the cost accounting. That means in cost accounting, our profit is more. We should reduce it to match it with the financial accounting. Over absorption of overhead. That means in costing, expense is more, because of which the profit is less. To match it with financial profit, we should add it. Under absorption of the opening stock, basically profit is more. Why? We booked less expense. Now to match it with financial accounting, we should reduce it. Simple. Got it? So in the same case, if at all they ask you to prepare memorandum reconciliation, what you should do? You will start with profit as per cost accounts. And we will, whatever to be added to profit, we will add it, minus, here you will get profit as per financial account. However, if the debit side is more, you will get loss as per financial account. Hope it is clear. Now, we are starting with, what if it's a loss, sir? Then we should try to match our costing loss with financial loss. First, starting point is costing. So what if it's a loss as per cost accounting? We should try to match it with the loss as per financial accounting. So you should now be careful, because we should try to give an effect of loss. Think from the loss point of view. Expenses recorded in cost accounting. That means loss in cost accounting is more. To match it with the financial accounting loss, you should reduce your loss. Income recorded in cost accounting, because of which loss in cost accounting will be less. To match it with financial accounting, we should add it. Expenses recorded in financial accounting. So in financial accounting, loss is more. To match costing with financial accounting, we should add. Incomes recorded in financial accounting only. That means in financial accounting, loss is less. To match it with the financial accounting loss, to cost accounting loss, we should reduce. Got it? Overvaluation of closing stock in financial accounting, because of which in financial accounting, loss is less. Overvaluation of closing stock increases the profit or decreases the loss, you can keep it as. So loss is less, so you should reduce it. Undervaluation of the closing stock in financial accounting, because of which loss in financial accounting is more. So in costing, you should add it. Overvaluation of closing stock in cost accounting, because of which in cost accounting loss is less, in financial accounting it's same only. So we should add it back, increase your loss. Undervaluation of closing stock in cost accounting, because of which your loss is more. So you should reduce that loss to match it with financial accounting. Got it? Overvaluation of opening stock in financial accounting, because of which in financial accounting loss is more. So you should add it. Undervaluation of opening stock in financial accounting, because of which loss is less in your financial accounting, you should reduce. Overvaluation of opening stock in the cost accounting, in cost accounting loss is more, now you should reduce. Undervaluation of the opening stock in cost accounts, that means in the cost accounts loss is, undervaluation of opening stock, loss is less, so you should add it back. Got it? Next, over absorption of overhead, that means in costing loss is more expense, more loss, so you should reduce. Under absorption of overhead, then you showed less expense, which means less loss, add it back. Got it? So if you want me to do the memorandum reconciliation, that will be very simple. We will be starting with loss. So loss means, of course, it's a debit side, correct? So we'll start with the loss as per cost accounts. Whatever to be added to the loss, that we will take it here. Not that plus should be credit side and all. No, what should be added to the loss, we'll take it here. What should be reduced from the loss, we will take it in the credit side. So here it is loss as per financial accounts. No sir, this only is more than it is profit as per financial account. Always remember, now if the answer you get is in negative, don't think negative, no, so it is loss. No, no, no. If your starting point is positive, loss as per cost accounts, now you get positive, then it is loss as per financial account. If you get answer in negative, then it is profit as per financial accounts. Hope it's clear. Next up, loss as per financial accounting is a starting point. That means here financial accounting loss, we are trying to match it with the cost accounting loss. Expenses recorded in cost accounting, which means in cost accounting loss is more, so you should increase. Incomes recorded in cost accounting, because of which loss is less in cost accounting, so you should reduce. Expense recorded in financial accounting, in financial accounting loss is more, but in cost accounting it is less only, so you should less. Incomes recorded in financial accounting losses are less, so you should add back. Got it? Overvaluation of closing stock in financial accounting loss is less, add it. Undervaluation of closing stock in financial accounting loss is more, reduce it. Overvaluation of closing stock in cost accounting loss is less, so reduce it. Undervaluation of closing stock in cost accounting loss is more in cost accounting, so add to financial accounting profit also. Overvaluation of opening stock in financial accounting, because of which loss is more in financial accounting, we should reduce it. Undervaluation of opening stock in financial accounting, that means loss is less in financial accounting, we should add it. Overvaluation of opening stock in the cost accounting, that means loss is more in cost accounting, we should add it. Undervaluation of opening stock in cost accounting, that means loss is less in cost accounting, so you should reduce it. Overabsorption of overhead, that means in costing loss is more, you should add it to match it with the financial. Under absorption of the overhead, cost is in costing loss is less, so you should reduce because expense is less. That if you get a positive number, that will be loss as per cost accounting. If you get a negative number, that is profit as per cost accounting. And in our study material, majority of the times they are starting with financial accounting profit only, financial accounting profit and financial accounting loss. So these first two statements are important. Okay, I mean, sir, what if we start from cost accounting? Will there be any problem? The answer is no. It won't be any problem. Got it? These are the certain things. I hope it's clear. Yes. Oh, by the way, if at all anyone is watching in YouTube, and before you put a comment telling that, sir, where we can find this, where we can find this, where we can find this, notes, I don't share it. Okay, if you want, you take a screenshot or whatever it is, you write down, but these notes won't be shared. File which I will be sharing with you guys will be just a compiler of PYP as well as MTP. That file, nothing else, nothing extra. Got it? Hope it's clear. Done. We'll do one thing, we'll take a break of 2 minutes and we'll start with the questions. Fine now? Okay. Hey. June 23 MCQ 7. Which of the following items should be added to costing profit to arrive at a financial accounting profit? Income tax paid, guys, because of which financial accounting profit will be less only. So you don't have to add, you have to reduce. Over absorption of works overhead. So over absorption of works overhead means in costing you have showed a less profit. You have to add this. Correct. Interest paid on bonds, that also in financial accounting we would have showed it as an expense. Expense means there we showed less profit. So you should reduce it. Those two are minus, only this is plus. Hope it's clear. Next. 4. The following information is available from the financial books of Messrs. Jyoti Limited, having a normal production capacity of 60,000 units. Normal production capacity is 60,000. And one more thing, remember about capacity. Your fixed overhead will be absorbed on the basis of normal capacity. Okay. Absorption rate will be computed on normal capacity. Budgeted overhead divided by budgeted normal capacity. However, variable overhead, it will be on the basis of actual capacity. It will be based off actual capacity. So, normal capacity is 60,000. During the period, sales is 50,000 units, rupees 10 lakh. Okay. There was no opening and closing stock of finished goods. Awesome. Direct material and direct wages cost rupees 5 lakh and 2 lakh 50,000 respectively. Actual factory overhead expense is 1 lakh 50,000. Of that, 60% is fixed. Try to understand, 1 lakh 50,000 we will be taking it to the financial accounting, not to the cost accounting. Cost accounting we should take it on the absorption basis. Actual admin expenses were 45,000, which is completely fixed. In financial accounting, we will take 45,000 on the basis of incurrence, but not in cost accounting. Actual selling and distribution expenses were 30,000, of which 40% are fixed. Same again. 30,000 we will take it in financial accounting, but not in cost accounting, because in cost accounting we don't take it on actual basis, we'll take it on the absorption basis. Interest and dividend received 15,000. Find out the profit as per the financial books for the year ended 31st March 2023. Prepare a cost sheet and ascertain the profit as per the cost accounts for the year, assuming that indirect expenses are absorbed on the basis of normal production capacity. Prepare a statement reconciling profit shown by financial and cost books. Listen here. Financial accounting profit will be very simple. Sales will be there. That will be there in the credit side. Correct? Sales, credit side, how much? 5 lakh, no? 10 lakh. Sales credit side, it is rupees 10 lakh, right? And sales credit side, it is 10 lakh. And there was no opening and closing. Direct material and direct wages, they have given it as 5 lakh, 2 lakh 50,000. So 2 DM, 5 lakh. 2 DW, 2 lakh. Got it, huh? Next, factory expenses, I will take 1,50,000 directly. But in costing, I can't take that way because it should be absorbed. To admin overhead, 45,000. To S&D, 30,000. Next, by interest and dividend, how much? 15,000. Keep one thing in mind. This won't come in the cost accounting, but in reconciliation you should do it. So, how much is the credit side? 10 lakh 15,000. Debit side total 5 lakh, 7 lakh 50, 9 lakh, 9 lakh, 9 lakh 75. 9 lakh 75 means around 40,000 is a profit, right? To profit, net profit 40,000. Now, if you want me to do the cost sheet, listen here, very important. We know that direct material, direct labor, if any other information is not there, that we are going to take as it is. Direct material, direct labor will come to 5 lakh and 2 lakh 50,000. Correct? That will give us prime cost. Prime cost will come to 7 lakh 50,000. To that, of course, we are going to add the factory overhead. We are going to add factory overhead. Listen here. Factory overhead, I am not going to take it directly, guys. I am going to divide it into fixed and variable because I have to absorb it. Correct? And if you remember, I told you fixed overhead you should absorb it on the normal capacity basis. Variable you should absorb it on the actual capacity basis. Okay? Fixed overhead, try to understand total how much they have given. 1,50,000, of that 60% is fixed. 90,000. Listen. 90,000 was fixed. Absorption rate means based on our plans. As per our plan, we were planning to produce 60,000 units. Agreed or no? Which means we thought we are going to recover rupees 1.5 per unit. We plan to recover 1.5 per unit, but actual production is coming only to the extent of 50,000. We are going to recover only 75,000. Hope it is clear. 90,000 we plan to recover it from 60,000 units, which means per unit we thought of recovering 1.5. So 50,000 units is actual production. So you are going to recover that, which means around 15,000 is your under absorption. Coming to your variable cost, 60,000, right? 1,50,000 minus 90, 60,000. And we know that variable overhead, it will be absorbed on the actual basis only. 60,000 divided by 50,000 into 50,000. That will come to 60,000 only. So try to understand relating to variable overhead, when budgeted overhead and actual overhead are same, just like this. Because here budgeted overhead is not given, we are going to assume it as actual overhead itself is budgeted overhead. When it is same, fixed cost won't give any under absorption, over absorption. Sorry, variable overhead won't give any under absorption, over absorption. It remains same. Okay. If budgeted comes different, then recovery rate on the actual capacity will be calculated for budgeted output, budgeted things. So based on that, we will be absorbing here. That will be different scenario. So factory overhead is done. That will give you factory cost. How much it is? Huh? 1,35,000. Factory cost is 8,85,000. Any other expenses are there as such? Admin expense is there, 45,000, which is completely fixed, it seems. So listen here. Again, 45,000, no? 45,000, we plan to recover it from the 60,000 units, which is basically 0.75. But actually, we are able to recover it only from the 50,000 units. 37,500. That will give me COP, or in fact COGS. 9 lakh 22,500. To that we are going to add selling and distribution overhead. Of course, that is also further divided into fixed and variable. Fixed and variable. How much it is, sir? 30,000, of which 40% is fixed. That is 12,000 is fixed. Correct? 12,000 divided by 60,000 is what we plan to recover, but we are able to recover from 50,000 units. 10,000. Variable will be 30,000 into 60%, 18,000. We plan to recover 18,000 from 50,000 units only, and we are recovering from 50,000 units only. 18,000. Hope it is clear. That will give you COS.
9,50,500.
Add profit, which is balancing figure. That will give you sales. Sales, 10 lakh. So profit is 49,500. Profit is 49,500. Now reconciliation, of course, as I already told you, generally we start with profit as per financial accounts. How much is profit as per financial account? 40,000. Correct? See, all the add you should write together, then take it, then minus all the minus. All those things, don't mix it and do. Now I am doing it because presentation wise I am not concentrating much now. In revision what? Presentation wise concentration and all. First, see, direct material, direct wages, no difference is coming. Sales, no difference is there. Interest and dividend, of course, try to understand. In financial accounting, 15,000 we booked it as a interest, as a income, because of which in financial profit has increased by 15,000, but in costing it's not there, so you should reduce interest and dividend. 15,000 now. Factory overhead, as per financial accounting it is 150,000, but as per costing it is 135,000. Correct? No, which means in costing it is under absorption of factory overhead by 35,000, because of which in costing we showed more profit. So financial accounting profit we should add under absorption of factory overhead. How much? 15,000. Hope it is clear. Admin overhead as per financial accounting it is 45,000, but as per cost accounting it is 37,500. Again under absorption. Under absorption, which means we showed more profit in costing, so financial accounting also we should add 7,500. Selling and distribution, in financial accounting it is 30,000, but in cost accounting it is around 28,000. 30,000, 28,000, which means 2,000 is under absorption again. So add under absorption 2,000. Total will come to
49,500.
Any doubt? Come. So this is how you are going to do it. Next,
The MCQ.
here they started with cost accounting. Whole study mat they have started with financial accounting. I mean that doesn't matter. Next, MCQ 2, right? Under integral account, integral. Issue of direct material is debited to which of the following? Issue of direct material, not purchase of direct material. Issue. So that doesn't matter at all whether it's integral or non-integral. Receiving department will be WIP. Providing department will be stores, SLC. So it will be debited to WIP account, credited to SLC. They're asking debited, no? To WIP. Got it? Next up.
3B.
3B now. SB Limited maintains a integrated accounts of cost and financial account. Journalize the following transactions in the books. Raw material purchased on credit. SLC account we will debit. To supplier account or to creditor account you can write. Why, sir? Because it is integrated. Direct material issued to production. WIP to SLC. Wages paid 4,80,000. Wages control account debited to cash. And they are telling in that 30% is indirect. 30% is indirect. Indirect means respective overhead, generally factory overhead, if the question is silent about what overhead it is, factory overhead account debited to wages control account. Wages charged to production, WIP to wages control account. Manufacturing expenses incurred, that is direct expense, WIP to bank or cash. Manufacturing overhead charged to production, manufacturing overhead charged to production, now that is charged to production, WIP is a receiving to manufacturing overhead control account. So this one don't charge it to WIP, they are, I think they are talking about factory overhead only here. So here it is manufacturing overhead to bank. Got it? I mean, generally it should be direct, but if the question is like this, based on question, you should change a bit answers. Selling and distribution cost 80,000. That is S&D to cash. At the same time, if you remember, I told you, S&D always immediately transfer it to cost of sales. Cost of sales to S&D. Finished product at cost, that is transferring from WIP, getting transferred to finished goods. So receiving department is finished goods to WIP. Got it? Sales they have given, that will be sales to customer or cash. Receipt from debtors, bank to debtors. Hope it's clear. Yes? Simple one. Next up. See, material control to creditors, WIP to material, wages to cash, factory overhead to control, factory overhead to wages, WIP to wages, factory overhead to cash. I told you, no. Here they are taking it as indirect. So WIP to factory overhead, S&D to cash, cost of sales to S&D, finished goods to WIP, debtors to P&L, cash to debtors. Next up. No MCQs. Paper number. Three. Pass the journal entries for the following transaction in the double entry cost accounting system. Narration is not required. Okay. Issue of material, direct, indirect. Whatever we issued to the direct, we are going to debit the WIP account. Indirect, of course, we are going to debit the factory overhead account. What credits are to SLC? 7,50,000, 5 lakh, 2 lakh. Allocation of wages and salary, direct will be allocated to WIP account. Indirect will be allocated to factory overhead account, to wages control account. 3.5, 3.5. Overhead absorbed in the job. Factory overhead will be absorbed to WIP account. So WIP to factory overhead. Correct? Admin will be absorbed to the finished goods. Right? So if at all it's related to production. Finished goods to admin overhead. Selling will be absorbed to cost of sales. Cost of sales to selling and distribution. Under or over recovery of absorbed overhead. Factory. Factory. Over absorption. Over absorption means overhead has credit balance. Now debit it. That is factory overhead to costing P&L. Correct? And administration under absorption, that is costing P&L to admin overhead. Simple 7 marks. Hardly 2-3 minutes. Hope it's clear. Best part, narration is not required. Wow. Two B now. WIP factory material, WIP factory wages, WIP finished goods, cost of sales. You do separate entries for all the three. Don't merge it like this. Praying for this question also. You keep praying. Good only, no? Yeah. Like this only you will get. Don't worry. Costing P&L to admin overhead. Basically here they are this is over absorption, no? This was over absorption or under absorption? Factory overhead is over absorption. So that is factory overhead to costing P&L. Admin it is under absorption. Okay. Next, December 24 MCQ number. What will be the profit as per financial recording they are asking, which means try to understand. Made a loss of 2 lakh during the year as per the cost records. As per cost records, 2 lakh is the loss. Okay. If the interest on investment and director's fees were 10,000 and 40,000, that means try to understand. Interest on investment, that is our income, 10,000. So we booked it as an income in our financial accounting, 10,000. And director's fees was 40,000. That we booked it as an expense. That means in financial account net extra 30,000 expense we have booked up, which means our finance if the interest on investment is 10,000, okay, and director's fees is 40,000, that means 30,000 extra we have booked, correct? Because of which already loss of 2 lakh as per costing. In as per financial accounting, 30,000 more than costing, that is 2 lakh 30,000. Got it? If it was 2 lakh profit as per cost accounting, then it would be 1 lakh 70,000 as per financial. Hope it's clear. Next one, please. B. Following information is available from the financial books of Sant Limited, newly established company for the year. They are asking you to prepare P&L as per both costing as well as financial accounts and reconcile the profit as per two books. Very simple. Direct material consumption is there, direct wages is there, factory overhead, admin overhead, selling and distribution overhead, bad debt, preliminary expense, legal charges, dividend received, interest received on deposit, sales is there, closing stock they have given. Cost accounts for the same record reveal that direct material consumption was 56 lakhs. So try to understand. These all information will be taken for the financial accounts as it is. But for cost accounting, even direct material consumed is just 56 lakh, not 50 lakhs. Factory overhead recovered 20% of the prime cost. Admin overhead recovered at rupees 6 per unit of production. Selling and distribution is recovered as rupees 8 per unit sold. Simple. In the P&L account, basically debit 50 lakh, direct wages 30 lakh, factory overhead 16 lakh, admin overhead 7 lakh, selling and distribution 9 lakh 60,000, bad debt pure financial item 80,000, keep that thing in mind, preliminary expense pure financial item 40,000, legal charges pure financial item 10,000, dividend received pure financial item 1 lakh, credit side, keep that thing in mind, interest received on deposit pure financial item, credit side 20,000, sales 1 crore 20 lakhs, right? Sir, opening stock is not there. Okay, closing stock of raw material not required. Why? Because they have given consumed only directly. That means that includes opening plus purchase minus closing. If you have taken purchase, then you would have credited the closing stock of raw material. Here purchase is not taken, directly consumption is taken. So only closing stock of WIP and finished goods will be taken, 320 and 240, which will come to 560,000. Correct? And just check whether profit is coming to 1290 or no. They only have given. Generally, they don't give how much is the profit as per financial books. Matching. How much is the profit? 12 lakh 90,000. This is the profit as per financial account, right? We'll find out profit as per cost accounts. Direct material, they are telling direct material consumption is 56 lakh. They are not talking anything about the wages, so I'm going to assume wages is 30 lakhs only. Total will come to 86 lakhs. Wait, I will show it here only. Why to why so much? B, right? 2B now. Three B now. So direct material 56 lakh, direct wages 30 lakh, because of which prime cost will come to 86 lakh. Okay. And factory overhead, just don't take 16 lakh. Why, sir? Factory overhead clearly they are telling it is 20% of the prime cost. So 86 lakh into 20% will come to 17 lakh 20,000. So your gross works cost will come to 1 crore 3 lakh 20,000. Correct? However, add opening stock minus closing stock of WIP. Opening stock of WIP is not there, but closing stock of WIP is there, 2,40,000. That will give you works cost 1 crore 80,000. 1 crore 80,000. That is your works cost. Got it? Why that is important, sir? Because try to understand, closing stock as per the costing is valued on the basis of cost of production. Don't take whatever the closing stock in the financial accounting is there, that itself as closing stock. Don't. So to that we added admin overhead. Admin overhead, what they are telling? Admin overhead they are telling rupees 6 per unit. So 6 into how many units produced? Try to understand, we sold 1 lakh 20, closing 4,000 is there, opening nothing is there, which means we produced total 1 lakh 24,000 units. So 1 lakh 24,000 into 6. 7 lakh 44,000. That gives us cost of production for 1 lakh 24,000 units. It came to 1 crore 8 lakh 24,000. So per unit how much? One crore 8 lakh 24,000 divided by 124,000. 87.29. Now multiply that with 4,000 units. Closing stock of finished goods. 3,49,160. So I hope now you understood how to arrive at a closing stock of finished goods. Always remember, closing stock of finished goods under costing should be taken on the basis of cost sheet. Don't take what they have given in the question, because that they have given as per financial accounts. Sir, what is the difference, sir? In financial account, to value that finished goods, we considered only what is actually incurred. But in cost accounting, that will be valued on the basis of absorbed. Got it? So cost of goods sold is there. We got to know. For that, we are going to add selling and distribution. How much is selling and distribution, sir? 8 per unit sold. Unit sold is 120,000. How much is 8 into 120,000? Which will come to 9,60,000. That will give us cost of sales. Sales won't matter just because of you doing it under costing or financial. So profit will come to 5,65,160. So profit as per cost accounting is 5,65,160. So you know that difference. First, material. As per costing, material is 560,000, but as per the financial, it's just 50 lakhs. That means 6 lakh material we showed more in costing, which means profit was less by 6 lakh. You should add 6 lakh. Add 6 lakh excess material. Hope it is clear. Next, factory overhead. As per the financials, it is 16 lakhs, but as per costing, it is 17 lakh 20,000. Over absorption. That means in costing, we showed more expense. More expense means less profit. We should add it. Add 1,20,000. Factory overhead over absorbed. Next, credit side, finished goods. As per the financials, finished goods is valued at 3,20,000. But as per the costing, finished goods is valued at 3,49,160. So it is nothing but overvaluation of closing stock in the cost accounting by 29,160. Overvaluation of closing stock led to more profit. So you should reduce your profit. 29,160. Reduce 29,160. Done. Next, admin overhead. As per financial, it is 7 lakh. As per costing, it is 7,44,000. Again, the over absorption 44,000. Profit was less. You should add it back 44,000. Over absorption of admin overhead. Then selling and distribution 9,60,000. Here it is 9,60,000. Selling and distribution is same. Bad debt 80,000. That will be only there in the financial accounts. So in costing we didn't consider that. But to match our costing profit with financial profit, we should reduce our profit by 80,000. Bad debt 80,000. Preliminary expenses written off 40,000. In financial accounting we showed 40,000 expense. Here we didn't show 40,000 expense. So reduce it from the profit. 40,000. Legal charges again 10,000. Same. 10,000. Dividend interest 1,20,000. We are showing it in the financial account, which means because of which financial accounting profit is more. Now we should increase our profit here also. Add 1,20,000. Simple. You will arrive at a financial profit. See there in examination, study material, everywhere it is. Starting point is financial profit. In cost, answer key cost. Hope it is clear. Next up. MCQ 7 June 25. In a non-integrated cost accounting system, what is the primary objective of overhead ledger? Managing ledger entries, recording direct cost, controlling indirect cost, maintaining financial transaction. Overheads, controlling indirect cost. All the ledgers in cost accounting is relating for the control purpose only. That's why we use the term control for every ledger. After it reaches COS, we stop using that. Got it? Next up. One more MCQ is there. Nice. In an integrated accounting system, the accounting entry for indirect wages incurred. Incurred is very simple, no? Whether direct or whether indirect. Wages control will be debited to integrated, right? To cash. Then it is factory overhead control account to wages control account. So net factory overhead to cash. Or you can tell it as wages only. I think option B. That is most appropriate answer. First one doesn't make any sense. Third one, WIP to wages, that is direct wages. Fourth one, wages control to overhead, that also doesn't make any sense. Got it? Next up. GLC. Where is GLC? No, option they had given. Option, who cares? That is not a correct answer. No? In correct answer, cash or bank should come. A summary of the P&L they have given for the March 2025. Material consumed 5,48,000. Direct wages 3,02,000. Factory overhead 1,66,000. Admin overhead 76,480. Selling and distribution preliminary expense. Sales they have given 24,000. Finished goods is 8,000. Moral of the story, units produced are total 24,800. WIP they have given here. That consists of material, wages, factory overhead, dividend received. The company manufactures a standard unit. The cost accounting record for the company shows factory overhead have been charged 20% of the prime cost. Admin overhead recovered at 3% of finished goods. Selling and distribution recovered at ₹4 per unit. WIP is valued at prime cost. WIP is valued at prime cost, they are telling. Prepare costing P&L indicating net profit, a statement reconciling the profit. Just I will show it. Nothing special is there in this. Which one it is? 3B, right? I will just show it here. Closing stock of material is there in the question, no? We didn't take the question. No, give me a second. See there any of financial profit they only have given. All we have to do is find out costing profit. Correct? First. See there, material consumed 5,48,000 they have given. Yes or no? However, in that still in WIP we have a closing of 12,800. Yes or no? That means material consumed is net 5,48,000 minus 12,800. Direct wages we incurred 302. Of course, in the closing WIP we have 7,200. See, if you no sir, we don't want to do this, then you can show here by WIP. Take whatever is there in the debit, credit side you write it as by WIP. No problem. You do that only better. Okay. Instead of reducing, you take it as by WIP and show it. Direct wages is there. Prime cost we got. Now, but while valuing prime cost, you should be very careful. Why, sir? This direct material includes WIP portion. But to value works overhead, we need only prime cost. So that time you should exclude it while valuing that. So we get 20%, right? 20% of prime cost. We'll get works cost. To that add admin overhead, whatever they have given, COP minus closing stock. Closing stock house, sir. How many units we are producing? We are selling 24,000. Finished till we have 800. Which means 24,800 is the units available in total. What if we make the cost sheet only? Do it better. Do the cost sheet. So finished goods 24,80,000. Sorry, 24,800 is the number of units produced. Correct? Divide it by and multiply with 800. Now costing P&L you can write it as cost sheet itself. Costing P&L is not something else. Costing P&L is cost sheet only. Same, no? P&L is nothing but costing P&L. Cost sheet is also one more format for costing P&L. For example, financial account. P&L, how we will prepare generally? Horizontal. But when it comes to companies, we'll do it vertically. That doesn't change the fact that it's P&L. So we get COGS, add selling and distribution, we get cost of sales, we got 68,129 as a profit. Correct? Now, profit as per cost accounts, 68,129. Dividend we didn't take it now. Over absorption of factory overhead, over absorption of selling and distribution, under absorption of admin overhead, over valuation of finished goods, preliminary expenses included. All these things. Okay. Nothing much special in this particular question. Hope it's clear. Go through that question once again. Huh? Next. 9. MTP1. December 23, set 1. MCQ 11, sorry, not 9. Integral accounts eliminate the necessity of operating a CLC account. Next. Measures Mysore Petrol Limited showed a net loss of 2,08,000 as per their financial accounts for the year ended 31st March 2023. Awesome. Cost accounting, however, disclosed a net loss of 1,64,000 for the same period. Awesome. The following information reviewed. Prepare a reconciliation. So starting point shall be taken as financial accounts. So that means you are trying to match financial accounting profit with cost accounting profit. Trying to match financial accounting profit with cost accounting profit 2,08,000. Now, factory overhead under recovered. So in costing, it is under recovered. That means in costing, loss is less. Loss is less. So this also you should reduce. Correct? Admin overhead over recovered. That means more expense in the costing. That means more loss in costing. So financial accounting loss also you should increase. Depreciation charged in financial accounting is 60. Costing is 65. That means 5,000 more in costing. 5,000 more in costing. So expense 5,000 more in costing means loss is 5,000 more in costing. In costing you showed more expense. We are talking from loss point of view. Don't do that. Same format we will take it, sir, but loss we will write it in negative. Don't do that. Do it in a technical manner and conceptually. Don't just by heart and go the format. Interest on investment not included in cost. Interest on investment, which means that is income in your financial accounting. So loss in financial accounting is lesser, but you have to add it back. Correct? Income tax provided. In financial accounting, it's an expense because of which loss is more, but in cost accounting, it's not. So minus. Transfer fee. That is income actually. When you transfer one share from one person to other person, that is transfer fee. So basically, that is income. In financial book, it's an income. So in financial book, loss is lesser. Correct? So we have to add it back. Stores ledger adjustment created in financial accounting. In financial accounting, loss is less. Add it back. So how much it will be? 2,08,000 minus 3,000 plus 2,000 plus 5,000 plus 10,000 minus 60,000 plus 1,000 plus 1,000. 1,64,000. Hope it's clear. Clear or no? One second now. Wow. Institute itself is not using logic and all. Same format they have taken now. Instead of positive amount, they have written negative amount. You don't do that way at all. Next. Set to MCQ 12. When the costing loss is 5,600, admin overhead is under absorbed by 600. That means we showed less expense. In financial, it is much more loss. So 6,200. In financial, more transfer fee, it's an income. Correct. It will reduce our loss. Correct. So in financial accounting, it reduced our loss. So we added it back. Next up. Net profit of a manufacturing company appeared to be 6450 as per the financial and 86,460 as per the costing. You have to prepare reconciliation. Now, shall we take costing as the starting point? So 86,460, I will take it as a starting point. Income tax provided in the financial books, which means in financial books we showed it as an expense, but in costing, in costing we didn't show it as a expense. Now you should reduce your profit because we want to reach financial accounting profit. Bank interest credited in financial books, so it will increase our cost. We should increase our costing profit. Work overhead under recovered, so we showed less expense, which means we showed more profit. Now you should reduce that profit. Depreciation charge in financial is 5,600. Costing is 6,000. That means 400. 400 expense we showed more in costing, so we should add it back to our profit. Admin overhead over recovered, we showed 850 more, add it back. Loss due to obsolescence charged in financial accounting, this loss is not there in costing, so reduce it. Interest on investment not included in cost accounting, this particular income is not there, add it. Stores adjustment credited in financial accounting, so this is there, add it. Loss due to depreciation in stock value, so loss due to depreciation in stock value, that is only there in the financial accounting, so because of which reduce it. So tell me whether it's matching or not. 86,460 minus 20,000 plus 250 minus 1,550 plus 400 plus 850 minus 2,800 plus 4,000 plus 240 minus 3,350. 64,500. Hope it is clear. Next up. June 24 MCQ 10. When costing loss is 5,600, admin overhead under absorb being 600, loss as per financial accounting will be 6,200. Just now we have done, if I am not wrong. Next up. 3B now. Prepare and pass the journal entry. This is examination question we have seen already. Next up. December 24, set 1 now. MCQ. What characterizes a non-integrated cost accounting system? Unified ledger system, separate cost and financial account, sole reliance on cost principles, complex reconciliation process. Separate cost and financial accounting system. Next up. This also we have seen, same, that preliminary, prime cost based it was there, but here factory overhead is on the basis of 60% of direct labor cost. That's the only thing. Okay. Not much change. So don't take 562 into 60%. Take it as 562 minus 11,000 into 60%. B, I will just show it here. And also goodwill written off is there. All these are only in the financial accounts. B, right? Opening, purchase minus closing will give you material consumed. Wages paid plus accrued 596,000. 60% of wages. Where they should have given. So yeah, total wages is how much? 5,96,000. Of that 60% is how much? 3,57,600 less closing WIP. Admin overhead is there, COGS, normal question only, nothing special in this. Next up. Set 2, right? MCQ 10. In reconciliation statement, overhead under recovered in cost accounting are deducted from the financial profit or added to the costing profit. Under recovered, let's say you are going from cost accounting to financial accounting, then whatever the under recovered are there, that you are going to under absorption you are going to reduce it. Why? In costing you would have showed more profit. If you are going from financial accounting to costing, then you will add it. So deducted from financial profit, no. Added to financial profit, deducted from costing profit, yeah, B. Got it? Next, 11th, right? A firm operates an integrated cost accounting. The accounting entry for indirect wages incurred. Debit WIP account, no. Debit overhead account, credit wages control account. Option C. Next up. 3B. Apply the following particulars to pass the journal entries in an integrated cost accounting system. Issued material 3 lakh, of which 2,80,000 is a direct material. So issued materials are 3 lakh, 2,80,000 is direct, it seems. So WIP 2,80,000, overhead 20,000 to stores ledger control account 3 lakh. Net wages 70,000, deductions being 12,000. So standard is 75,000. I will just show it here. See. Basically, they are treating that under absorption, over absorption now only. Listen. Out of 3 lakh, 2,40,000 will go to WIP. Correct? 2,40,000 will go to WIP. Remaining 40, where it will go, sir? Remaining 40 will go to usage variance. You used more. Okay. And remaining 20 will be production overhead. Wages. Total you incurred how much? Paid is 17,000. Deduction being 12,000. That means only 58,000 will go for the wages. This thing, see here. 70,000 is what you paid. 12,000 is what you haven't paid it. Total 82,000. In that 75,000 will go to wages control. Remaining 7,000 will be going to variance. Because standard is 75,000. Actually we incurred total 82 kind of stuff. Got it? Gross salaries payable for the period is 26,000. Deductions 2,000. So salary is 25,000. Deduction 2,000. Payable 24. Total 26. That means 1,000 is what? Variance. Next up. Sales 8 lakh. Normal. Debtors to sales. Discount allowed 5,000. Correct. As that over or under absorption will come only to material, overheads. No. Here, the main prime cost only extra what we are consuming, that we are going to transferring it to variance account. Don't worry, this question most probably won't come in the examination because nowhere they spoke about this variance account and all. Still, general knowledge, prime cost will be transferred to variance. This overhead will be going to under or over absorption. Discount to debtors, that is discount expense. So we are debiting it. Next up. June 25 set 1 MCQ. What defines integrated accounting system? Separation of cost and financial records, streamlining reconciliation, sole reliance on the financial principles, consolidation of cost and financial information. Next up. 3 B. This is the same question what we discussed there. You remember? Material consumption 56 lakh, factory 20% of prime cost. Remember? That thing only it is. Nothing special is there in this. Same question what we discussed. Next one. MCQ 10. In reconciliation system, expenses shown only in the financial accounts are, see, let's say financial profit to costing profit we are reaching. Expenses shown only in financial accounting means in financial accounting profit is less. We have to add back. Let's say costing profit to financial profit you are trying to go, then you should reduce. Add it to financial profit, correct, option A. Next up. 3B now. Prepare a statement showing a reconciliation statement and find out the profit as per cost accounts. Works overhead under recovered, admin overhead over recovered, depreciation charge in financial, depreciation recovered in costing, interest on investment not included, loss due to obsolescence charged, income tax reserves made, bank interest, etc. they have given. So we'll start with the financial profit. How much? 41,800. Using plus minus, we'll arrive at a costing profit. See there. Works overhead under recovered in costing. That means in costing we showed less expense, more profit. So we should add it. Correct? Admin overhead over recovered in costing. That means in costing we showed more expense, which means less profit. So now also we should also reduce it. Depreciation charge in financial accounting 5,600, in costing 6,250. That means around 650 rupees we showed more expense in the costing. So in financial profit reduce 650. Interest on investment not included in the cost. So there is one income we showed in the financial accounting but not in cost accounting. So in financial accounting profit is more, we should reduce it now. Loss due to obsolescence charge in financial accounting but not in cost accounting. Good thing, add it. We showed one expense because of which showed more loss, but that is not a loss. Income tax reserves made in financial accounting, again add back. Bank interest and transfer fee credited, minus. We showed it as income, reduce it. Adjustment, minus. Value of opening stock in costing 24,800, in financial 26,300. How much is the difference? 1,500. Yes. Overvaluation of the opening stock in financial account led to the decrease in the profit. We should add back. Because in costing profit is more. Closing stock 2,000 more in the costing, so we have to add. Because in costing profit is more. Interest charged in cost accounts 2,000. This we should reduce. Imputed rent charge in cost, minus. Goodwill written off. We have showed it in the financial accounting but not in cost accounting. So in cost accounting profit is more only. Loss on sale of furniture. This is not shown in the cost accounting as it's a pure financial item. So add back. Selling and distribution expense not charged in cost accounting. So you should add back. Okay. Donation to Prime Minister Relief Fund. This we have shown only in the financial accounting. So you should add back. This also add back. This also add back. So now may I know the costing profit, please? 41,800 plus 1,500 minus 850 minus 650 minus 3000 plus 2850 plus 2150 minus 370 70 minus 230 plus 1500 plus 2000 minus 2000 minus 1000 5000 add 600 add 10,000 add 5100 add 9,000 add 2500 1 lakh 12,900 deduction available PMRF, but nowadays no one will claim that 80 no 80C, sorry 80G no donation 80G. So 111,900 where we have taken something else. Leave, I think might be the calculation thing only, or we'll check once. Why to take risk? Take the photo of this once. I will just tell you, tell whether they have done the same thing or not. This is there in page number 190. Got it, 190. Just check overhead under recovery they have added. Admin overhead minus. Depreciation minus 650. Net only they have taken, or they have taken one side plus one side minus? Minus 3000. Plus 2800. Sorry, 2850. Plus 20,150. Minus 370. Minus 230. Plus 1500. Plus 2000. Minus 2000. Minus 1000. Plus 5000. Plus 600. Plus 10,000. Plus 5,100. Plus 9,000. Plus 20,500. Everything is same. Then I think calculation is the difference. Fine. Next one. No MCQ? Set 2, right? Set 1 December. Under the non-integrated system, same ledger is maintained for cost and financial account. Separate ledgers are maintained for cost and financial. All transactions relating to income, expenditure, asset, liability are completely recorded. Product-wise or department-wise information is not available. Same ledger is maintained. In reconciliation, closing stock undervalued in financial accounting is. So if you are going from financial accounting to cost accounting, then undervaluation of closing stock in financial accounting means you showed less profit. Because of you showing less profit, now we will add it back. If you are going from the cost accounting to financial accounting, then in financial accounting you showed less profit, so in cost accounting will reduce. Add it to financial account. Option A. Hope it is clear. Next up. Financial profit is 168,000. Costing is 2,40,000. You are required to prepare the reconciliation statement showing the reason for the gap. Okay. This I think study mat question what we have done already once. If you remember. See, P&L is already there. What non-integrated?
So we said MCQ. Non-integrated.
Oh, under the non-integrated. Oh, sorry. I thought integrated. It is separate ledgers are maintained. Now, fine. We'll see this cost sheet. First, direct material consumed. Opening stock 8,20,000 plus 24,72,000 minus 7,50,000. How much is material consumed? First, 820,000 plus 24,72,000 minus 7,50,000. $25,42,000. That is your direct material. Direct wages, they are telling 2,46,000 for costing purpose. That will give you prime cost, which is basically 27,88,000. That will be your prime cost. To the prime cost, we are going to add the factory overhead. Factory overhead, they are telling absorbed to the extent of 1,89,800. Opening WIP, closing WIP is not there. So this itself will give you the factory cost. 29,77,800. Okay. Done. I think admin overhead is there. 95,000, right? Admin overhead is 95,000. That will give you cost of product. Okay. Admin overhead is covered as 3% of the selling price. Sorry. So admin overhead will be basically 3% of sales. 34,65,000 into 3%. 1,03,950. So cost of production will be 29,77,800 plus 1,03,950. 30,81,750. And they are telling closing stock as per cost records is 7,80,000. Done. So that will give you COGS 30,81,750 minus 7,80,000. 23,01,750. Sundry income is not considered. Okay, this is done. Selling expense includes 5% for selling expense. So selling expense will be 5% of this 3465 into 5%, which is 1,73,250. That will give you total cost. 24,75,000. Now when you compare it with the cost minus 34,65,000, 9,90,000. What did we miss? Any major other expense we have missed? Direct material we have taken, no? We have taken closing stock We have taken it as a closing stock of raw material. We have taken it as closing stock of raw material. They are treating it as that are finished goods only. So direct material consumed will be straight away 24,72,000. Direct material consumed is there, no? 24,72,000. Whatever the purchase is there, that only you take. That they should clearly give closing stock of what? In examination they will give, don't worry. Opening stock also will assume it as fixed only. Sorry, finished only. 27,18,000. Prime cost is 27,18,000. Factory overhead is 189,200. So factory cost will come to 27,18,000 plus 189,800. 29,07,800. So 1,03,950 was your admin cost, right? So COP will be 29,7,800 plus 103,950, which will come to 30,11,750. For this, we have to add opening also. Opening was how much? 820, right? 8,20,000. That is plus 8,20,000 minus 7,80,000, which is 30,51,750. For that, we will add 173,200. Total cost will come to 32 lakh. 173,250. Is it? Correct. 30,51,750 plus 173,250. 25,000. 32 lakh 25,000 minus sales 34,65,000, which will come to 2,40,000. It is coming 2,40,000. Correct? Now, if at all we start from the cost accounting profit, we start from the costing profit, 2,40,000, no? 40,000. Direct material, no change is there. But direct wages, see there. As per costing, 246,000. But as per accounts, just 230,000. That means in costing, we have taken 16,000 more expense. Which means we showed profit 16,000 less. We have to add 16,000 relating to that wages. Okay. Next, factory overhead. As per costing, it is 189,800. But as per financial, it is 2,10,000. 2,10,000 minus 189,800. That means 20,200 we showed less expense, more profit. So we should reduce it. Minus 20,200. Next, admin expense. We have taken admin expenses 103,950. But in financial accounting, it is just 95,000. That means we showed our profit less by 8,950. We have to add it back because we showed more expense. Selling expense, we have taken it as 173,250. But in financial, it is 225,000. Which means we are showing profit more by 51,750. We are reducing it because we showed less expense. Correct? Closing stock. We are showing closing stock as 780. They are showing 750. That means we are showing more closing stock, which means we are showing more profit. Reduce 30,000. Reduce 30,000. Next, sundry income in financial they have showed. In costing we are not showing. So add 5,000. Add 5,000. So 2,40,000 plus 16,000 minus 20,200 plus 8,950 minus 51,750 minus 30,000 plus 5,000. 1,68,000. 1,68,000. Hope it is clear. Next one. MCQ 6. What will be the journal entry for under absorption of selling and distribution as per the integrated? Under absorption means we are going to charge it to costing P&L. So under integrated it is integrated. Please keep in mind. So it is not costing P&L. It is P&L. P&L to selling and distribution. Got it? Next. What is the objective of reconciliation? To assure the mathematical accuracy and reliability of the cost accounts, to have proper control and ascertainment, to ensure correct profit or loss in financial accounts, all of the above, all of the above. Next. 3 now. 3. This overhead, under recovery, over recovery, we have already seen it, if you remember. B. Correct? Anything else? With that, we have completed our revision of cost bookkeeping, one of the important chapter, examination point of view as well as practical point of view, life point of view, everywhere. So study it well. So we are left with one last chapter, marginal costing. Okay, fine. We'll take a break and we'll continue. We'll continue at 11. Okay. Now we'll be discussing one of the important chapter as well as last chapter of our revision, that is marginal costing. Marginal costing. Just like a standard costing, even marginal costing is also technique, not a method. Okay. Marginal costing is also technique, not a method of costing. Okay. So it's a technique which helps management in decision making by considering only marginal cost rather than by taking the total cost. Here we are not going to take the total cost into consideration. We will consider only marginal cost for a decision making purpose. Now the question comes, sir, what do you mean by marginal cost? Sir, marginal cost is nothing but, guys, additional cost incurred to produce one more additional unit. That extra cost what we incur to produce that one extra units, that's it, that itself we call it as what? Marginal cost. Basically, it is nothing but your variable cost. On the basis of variability or a behavior, you can call cost could be divided into two: fixed cost, variable cost. Variable cost, always remember, it will change with the level of activity. So always and always and always remember, it's going to affect your decision making. Variable cost will affect your decision making. But coming to the fixed cost, that could be divided into two: sunk cost, relevant cost. Sunk cost, guys, it has no impact on the decision making. Why, sir? It's already sunk. We have already committed it. We have already incurred it. Whether we take any call, for example, whether to continue the business, not to continue the business, if at all any cost we have already incurred, which has no impact here. Whether you continue also, you are not going to incur again. Whether you don't consider continue also, you are not going to incur it again. That means it's already committed cost. So it has no impact on the decision making. That cost we call it as a sunk cost. So while making a decision, we are going to ignore sunk cost. Got it? Whereas relevant cost means it has an impact on the decision making. It has the impact on decision making. That is, if at all you take, let's say, decision A, then this cost will be there. If you take decision B, it won't be there. Like that kind of fixed cost will be there, called as relevant cost. Got it? And remember, in marginal costing, only variable costs are considered for computation of cost of production, not total fixed cost or total cost. Always remember, while computing a cost per unit, cost of production, in marginal we will consider only variable costs related to production, like direct material, direct labor, direct expense, variable production overhead, not full production overhead, only variable production overhead. Only these many things are considered for computation of cost of production under marginal costing. So when cost of production includes so much only, then can I tell our closing inventory or any inventory includes only variable production cost? Okay. So the difference between marginal cost, absorption costing is there, that we will see later. Now, marginal costing generally for decision making, when the inventory, opening stock, closing stock and all is not there, how the statement will be there, sir? Simple 4-step it is. We'll take the sales. From the sales, we'll reduce the variable cost. That what answer we get is called as contribution. What we get is called as contribution. That is nothing but portion of the sale which is going to contribute towards recovery of fixed cost and generation of profit. What is contribution? Portion of total sales which will contribute towards recovery of profit as well as generation of, recovery of fixed cost and generation of profit. From the contribution, if you reduce fixed cost, what we arrive at is a profit or loss. Okay, profit or loss. By the way, this contribution in the relative terms, that is in terms of percentage, you can write it as PV ratio, or sometimes we call it as contribution ratio. That is nothing but, guys, contribution by sales into 100. Contribution by sales into 100 will give us PV ratio. Also remember, out of 100%, if at all PV ratio was 40%, that means remaining 60% is what, sir? That is nothing but your variable cost percentage. Remaining 60% is your variable cost percentage. And there is one more way of calculating PV ratio. How, sir? Listen here. Let's say sales is there 1,50,000. Two sales are there 1,50,000 minus variable cost. Variable cost, let's say 60% of the sales, that is 60,000 and 90,000. That will give you contribution of 40,000 and 60,000. Using this, you can find out, using this, you can tell that, boss, my profit is, or my PV ratio is 40%. Correct? PV ratio is 40% because variable is 60%, then PV ratio will be 40 or 40,000 divided by 1 lakh into 100. Okay? Minus fixed cost. Let's say fixed cost is around 30,000. So irrespective of the level of output, fixed cost will remain same. Correct? Here the profit was 10,000. Here the profit was 30,000. Now listen. Listen. How much is the change in profit? 20,000. How much is the change in contribution? 20,000 and 20,000. What do you mean by this, sir? Try to understand. Change in profit and change in contribution will be same. Change in profit and change in contribution will be same. Why, sir? Because fixed cost here already recovered. So whatever extra contribution is there here, 20,000, that everything will be contributing towards profit only. Why? Fixed cost is already recovered. Fixed cost is already recovered at this stage. So whatever the change in profit is there, that will be equal to change in contribution. How much was the change in sales? 50,000. So now tell me, change in profit is how much? 20,000. Change in sales is how much? 50,000 into 100. PV ratio. So PV ratio could be found out this way also. One more formula for finding out a PV ratio. That is change in profit by change in sales into 100. Change in profit by change in sales into 100. Alright, sir, what is the big deal in this, sir? Why you have to do that much and all? When you know the contribution, when you know the sales, why the hell you are doing this much? Because if at all they are expecting you to apply this formula, they don't give like this full information. They give only so much. They will give sales, they will give profit. Using that, you have to find out a PV ratio. How, sir? Very simple. Change in profit by change in sales into 100. 20 by 50 into 100. You will get PV ratio 40%. Using that, you can find out remaining things. How, sir? I know my sales is 1 lakh. Yes. Then my contribution will be 40% of it, which will come to 40,000. Something was there in my fixed cost. I don't know how much it is. We reduced it. We arrived at 10,000 profit. That means fixed cost was how much? 30,000. So I found out fixed cost also. I found out contribution also. I found out variable cost also. Variable cost is nothing but 1 lakh into 60%. Understanding? So PV ratio is going to act as a base for all these things. If at all they give two different sales and two different profit, then always remember change in profit divided by change in sales into 100 will give you PV ratio. And listen here, sometimes they might give like this: sales 1 lakh, loss of 20,000, sales 2 lakhs, profit of 20,000. Now you have to find out PV ratio. Change in profit is how much? 40,000. Very good. Change in profit is 40,000, guys. How, sir? 20,000 minus 20,000. 20,000 minus 20,000 divided by change in sales 1 lakh. Divided by change in sales 1 lakh, which will come to 40%. Hope it is clear. So if at all they give one loss and one profit, be careful. Change in profit, just don't take 0 and all. Garam kar diya.
Let's have a lecture.
So change in cost, a change in profit divided by change in sales, you will get. Hope it's clear. No doubts. Okay. That is one more formula. And always remember one more thing. What is it, sir? Variable cost will always vary with the units sold, not with the selling price. Variable cost will always vary with the units sold, not with the selling price. Selling price has nothing to do with the cost, variable cost. Got it? So if the selling price was 100, now PV ratio was 40%. That means variable cost was 60%, 60 rupees, correct? Now selling price will fall by 10%. Now selling price will come to 90. That doesn't mean that variable cost will go to 54. Variable cost will remain at 60 only. Variable cost won't change with the change in selling price. Variable cost will change with the change in sale units. If at all they give sales and if at all they give PV ratio, then of course it will change. Because we assume units are changing, not selling price. Okay. So always remember, variable cost per unit will not change with the selling price change. It will change only with the units change. That too per unit won't change. Okay. Next we have one more concept called as break-even point. Or we sometimes also call it as break-even sales. Break-even point, or we also call it as break-even sales. What do you mean by break-even point or break-even sales, sir? Break-even point or break-even sales means, guys, in terms of amount means amount of sales if you do, which will end up in giving you no profit, no loss. Amount of sales which will give no profit, no loss. That means revenue is equal to cost. Break-even sales in terms of unit means number of units to be sold to make sure no profit, no loss exist. That is, our revenue will be equal to cost again. That is your break-even point and break-even sales. For example, if my selling price is 20, selling price is how much? 20 per unit. Variable cost is, let's say, rupees 12 per unit. Variable cost is 12 per unit. Fixed cost is, let's say, around 80,000. Fixed cost is 80,000. Now my question is, how much sales units, how many units you should sell to make sure no profit, no loss arises? Shall I take units to be sold as B? Break-even units as B? So if I sell B number of units, my sales will be 20B. Correct? My variable cost will be 12B. 12 rupees into B number of units. That will give me contribution of 8B. From that fixed cost, if I reduce 80,000, that should give me no profit, no loss, which is nil, 0. So 8B minus 80,000, that is equal to 0. 8B is equal to 80,000. B is equal to 80,000 divided by 8. B is equal to 10,000 units because I'm trying to calculate in terms of units. That is, if we sell 10,000 units, we end up making no profit, no loss. If you want, you can check 20 into 10,000, 2 lakh. Amount of sales is 2 lakh. Variable cost will be, contribution will be, fixed cost will be. Got it? So when you sell 10,000 units, you end up making no profit, no loss. By the way, can I call it as computation of break-even point units? Break-even point units. What was 80,000 there? Fixed cost. What was 8? Contribution per unit. So if at all in units you want, then you can write the formula as break-even point in units is nothing but fixed cost divided by contribution per unit. However, no sir, I want it in terms of amount. Okay. Sales. How much is the question? Break-even sales. Okay. We know that PV ratio is 70%. PV ratio, let's say 70%. Fixed cost amounts to, let's say, around 1,40,000. They're asking how much should be the sales to make sure no profit, no loss. Shall I take that sales as S? My variable cost will be 0.3S. Correct? Contribution 70 means variable cost percentage is 30%. So sales into 30% will give me variable cost. That will give me contribution as 0.7S. That is sales into 70% will give me contribution amount minus fixed cost 1,40,000. That should give me 0. Correct? That means 0.7S minus 1,40,000 is equal to 0. 0.7S is equal to 1,40,000. S is equal to rupees 2 lakh. That is, if the sales are 2 lakh, then contribution variable cost will be 60%. Contribution will be 1,40,000. Fixed cost is 1,40,000. Profit is 0. By the way, how did you arrive at this? S is equal to 1,40,000 divided by 0.7. So can I call it as break-even point or break-even sales in terms of amount? What was 1,40,000? Fixed cost. What was 0.7? PV ratio. So if at all you want it in terms of amount, you are going to divide fixed cost by PV ratio. If you want in terms of unit, you are going to divide it by contribution per unit. Sir, can't we do it like this table by taking it as some variable number? Yes, you can. You can. One mantra you have to remember. What is it, sir? See there. At a break-even point, contribution will be equal to fixed cost. At break-even point, contribution will be equal to fixed cost. At break-even point, contribution is equal to fixed cost. How do you arrive at contribution? Let's say units into PV ratio or contribution per unit. Amount. Contribution per unit. Unit into percentage if you do, you will get some number in units only, not in amount. You want it in amount means units into amount you should do. Amount means contribution or PV ratio? Contribution per unit. That will give you fixed cost. Can I call it as units is equal to fixed cost by contribution per unit? Okay. Sir, let's say they have given sales. Contribution you want it in amount now. Sales into units, contribution per unit you are going to do or PV ratio you are going to do? PV ratio. Because amount into amount will give you something else only. PV ratio is equal to fixed cost. So break-even sales will be nothing but fixed cost divided by PV ratio. Hope it's clear. Level of sales at which there will be no profit, no loss. That is level at which revenue is equal to cost. Break-even point, at break-even point, contribution is equal to fixed cost. Break-even sales in units means number of units to be sold to achieve the break-even sales. Hope it is clear. Clear or no? Break-even sales formula I have showed you. Next, there is something called as margin of safety. What do you mean by margin of safety, sir? Margin of safety is nothing but sales over and above the break-even sales. Sales over and above the break-even sales, we call it as what? Margin of safety. Oh, sir, sales over and above the break-even sales, it's equal to profit only. No, sir, the answer is no. Why? Along with your sales, your variable cost will increase. Along with your sales, your variable cost also will increase. That means fixed cost will remain same, but variable cost will change. No, that's why always remember contribution at margin of safety will be equal to profit, not sales of margin of safety will be equal to profit. Got it? Margin of safety is nothing but sales over and above the break-even sales. Sales over and above the break-even sales will be called as margin of safety. See here. Let's say total sales is 1 lakh, or let's say 10 lakh. How much is total sales? 10 lakh. PV ratio, let's say 40%. PV ratio. Fixed cost, let's say 2 lakhs. Fixed cost 2 lakh. Let's find out break-even point first. See here. Break-even point will be nothing but fixed cost divided by PV ratio. That is nothing but 2 lakh divided by 0.4. Five lakh you are getting, then make it as 2 lakh 50. Six lakh. Try to understand. Break-even point is 6,25,000. That is when the sale is 6,25,000. Variable cost will be 60% of this. How much? 3,75,000. Contribution will be 250,000. Fixed cost will be 250,000. Profit will be 0. But you know that your total sales was how much? 10 lakh. Variable cost was how much? 60% of sales. 6 lakh. Correct? That gave you contribution of how much? 4 lakh. Fixed cost 2 lakh 50. 1 lakh 50,000 is profit. Now listen. So out of 10 lakh, if 625,000 is break even, then 3,75,000 itself extra will be there. No, that itself is your margin of safety. That itself is margin of safety. For this 375 also variable cost will be there. No, how much it is? 60% of 375,000. 2,25,000. How much it is? Fixed cost, will it be there? No. Our total fixed was 250,000. That was already recovered in the break-even sales only. No. That means extra fixed cost to be recovered is nothing. Which means straight away it is profit. Straight away it is profit. So can I tell one thing? At margin of safety. At margin of safety, contribution is equal to profit. At break-even point. At break-even point, contribution is equal to fixed cost. So can I tell at margin of safety, contribution is equal to profit? Contribution is what, guys? Margin of safety into PV ratio. Yes or no? Is equal to profit. Margin of safety is equal to profit by PV ratio. Margin of safety is nothing but profit by PV ratio. Total sales is nothing but break-even sales plus margin of safety. Our margin of safety is nothing but total sales minus break-even sales. Our break-even sales is nothing but total sales minus margin of safety. Got it? These are the few things. Any doubts in this? Paka? Paka? No doubts? Okay. Then, sir, how is margin of safety, or sorry, not margin of safety, Marginal, by the way, there is something called as cash break-even point. Okay, cash break-even point is nothing but we don't consider full expense there. To match our revenue with the cost, to match our revenue with the cost, we don't take full expense. Then we will take only cash expenses, like fixed cost only paid in cash. For example, total fixed cost is 10 lakh. Depreciation in it is 2 lakh. That means fixed cost we are going to consider is only 8 lakh. Fixed cost we are going to consider is only 8 lakh. Got it up? Now, sir, so far we discussed about absorption costing method, correct? How is your marginal costing different from the absorption costing? Try to understand. In the absorption costing, cost of production includes prime cost plus factory overhead. Factory overhead means variable as well as fixed. Variable as well as fixed. But in marginal, remember, marginal cost of production includes only prime cost plus variable manufacturing overhead, not total manufacturing overhead. Not total manufacturing overhead. Okay. Sir, how does it look? Like absorption costing, first I will tell. Keep that thing in mind. Keep that thing in mind. Sales, you will write, let it be, park it there. First, you have to find out cost of production. Cost of production will be nothing but, guys, direct material, direct labor, direct expense, variable manufacturing overhead, fixed manufacturing overhead. Both variable manufacturing overhead as well as fixed manufacturing overhead. But remember, fixed manufacturing overhead on the basis of absorption. On the basis of absorption, not actual, take absorption. Okay. That will give you cost of production. That will give you cost of production. For that, add the opening stock of finished goods, that they will only give how many units, how much it is. If they don't give directly how much is the cost of that, they might end up giving you standard cost. Standard cost. Now, what is standard cost, sir? Standard cost is nothing but cost what we are planning during the period. Okay. How we determine that standard cost? Majorly by considering previous year figures. Correct? So what we assume is that standard cost itself is our previous year figures. So if they tell direct material 2 rupees, direct labor 3 rupees, variable factory overhead or manufacturing overhead together 5 rupees, then you are going to value your opening inventory at 10 rupees. Standard cost. Okay. So that will give you cost of production. To the cost of production, if you add the opening stock of finished goods, reduce the closing stock of finished goods. Closing stock of finished goods, of course, it should be valued under COP, just like any other cost sheet. Will give you cost of goods sold. Will give you cost of goods sold. Got it? Now, to the cost of goods sold, we are going to add the admin overhead, both variable as well as fixed. Selling and distribution overhead, both variable as well as fixed. And beginning while computing COP, you have taken absorbed overhead, correct? Absorbed factory overhead. You might have under absorbed it. That means you showed less expense, but actually you paid more. End of the day, while computing profit, you should take actual only. So we'll end up adding under absorption, because earlier you showed less expense. Whatever less you showed, that you should add to cost now. Over absorption means earlier you showed more expense. Now you are going to reduce it. So minus over absorption. Add under absorption minus over absorption will give you total cost or cost of sales. Sales and cost you compare, you will arrive at a profit. Sales and cost if you compare, you will arrive at where? Profit. So listen here, direct material, direct labor, direct expense, variable manufacturing overhead, fixed manufacturing overhead, but on the basis of absorption will give us cost of production. Add opening stock minus closing stock. Closing stock should be valued on the basis of COP. COP. That will give you COGS. Cost of goods sold. To the cost of goods sold, if you add admin overhead, both variable as well as fixed, selling and distribution, both variable as well as fixed. And if at all you under absorbed manufacturing overhead, which means you showed less overhead, no, add to the cost extra. Minus over absorption, if at all you already showed extra overheads, reduce it. You will arrive at a actual total cost. Actual total cost. From the sales, if you reduce the actual total cost, you will get the profit as per absorption costing. Okay, sir, then profit as per marginal costing will be what? That is very simple, guys. Sales minus variable cost minus fixed cost. That is profit. That we know, right? Now, first, sales will write and park it in the one side. Variable cost. Try to understand. How to arrive at variable cost? Direct material, direct labor, direct expense. Variable manufacturing overhead. Variable manufacturing overhead. That will give you cost of production. That will give you cost of production. For that, we will add the opening stock of finished goods. If they give directly, direct. Otherwise, you have to take the standard cost. In standard cost also, remember, you are going to take only direct material, direct labor, variable manufacturing overhead. They will give direct material 2 rupees, direct labor 3 rupees, variable manufacturing overhead 3 rupees, fixed manufacturing overhead 2 rupees. Then for the absorption method, you take full 10. But for marginal, you take only 8. Okay. That will give you opening stock of finished goods minus closing stock. Closing stock, of course, we are going to value it on the basis of COP. We will get cost of goods sold. We'll get what? Cost of goods sold. Now. That doesn't mean that all the variable cost is addressed. Remaining whatever the variable cost is there, no? That also you have to address here. What do you mean by that, sir? To the COGS, we are going to add variable admin overhead, variable selling and distribution overhead. Variable admin overhead, variable selling and distribution overhead. Variable admin overhead, variable selling and distribution overhead. That will give you total variable cost. From the sales, if we reduce total variable cost, you will arrive at a contribution. You will arrive at where? Contribution. From the contribution, we are going to reduce all the fixed cost, including production fixed cost. Because production fixed cost is not yet addressed now. That is production overhead, fixed cost, admin overhead, fixed cost, selling and distribution overhead, fixed cost. We'll arrive at a profit as per marginal costing. Come again, guys. Direct material, direct labor, direct expense, variable manufacturing overhead will give us cost of production. To the cost of production, we'll add the opening stock of finished goods minus closing stock of finished goods. We'll arrive at cost of goods sold. For that, now we will add all other variable expenses like variable admin overhead, variable selling and distribution overhead. That will give us total variable cost. That will give us total variable cost. Once you get the total variable cost, you are going to reduce that from the sales. You will arrive at a contribution. From the contribution, you are going to reduce the fixed cost. Fixed cost includes all the three fixed costs: production, admin, selling and distribution. Hope it is clear. And remember, here fixed cost manufacturing is not on absorption basis but on actual basis. Okay, sir, whether net profit computed as per marginal costing and net profit computed as per absorption costing, will it match? Yes, it will match only if stock is not there. Otherwise, it won't match. Why, sir? All the expenses we have taken, no? Yes, but try to understand. While valuing inventory under absorption, costing, you took prime cost plus production overhead, both variable as well as fixed. But while valuing inventory under marginal, you took only prime cost plus variable manufacturing overhead. That means it is so obvious that cost per unit under absorption will be more than cost per unit under marginal. Okay. So, because of which our value of inventory will be different. If the value of inventory will be different, profit will be different. Correct? Okay. Now listen. Opening stock. One thing remember, always value of inventory under marginal will be lesser than value of inventory under absorption. Why? This contains only material, labor, expense, variable overhead. That contains material, labor, expense, variable overhead as well as fixed overhead. So of course their cost will be more, no doubt in that. However, first we'll talk about closing stock. Closing stock wise, absorption will give more profit. Why, sir? I agree, same number of units, but there if it is get multiplied by 10, here it will get multiplied by 8, which means closing stock under absorption is more than closing stock under marginal. That means obviously absorption will give more profit. Coming to opening, again, opening stock under absorption will be more compared to opening stock under marginal. That means marginal give more profit because of opening. I hope you are able to understand. You should compare both and you should take the net effect. If at all opening stock is more than closing stock, then marginal will give more profit. If at all opening stock is less than closing stock, then absorption will give more profit. Because more the opening stock, more the expense. In absorption, expense will be more. More the closing stock, less the expense. In absorption, expense will be less. That's the reason. Hope it's clear. Yes? Now, okay sir, break even what we discussed is for single product. Sometimes what happens, break even they might give like this. We are producing not one unit, we are producing let's say 3 units, A, B and C. We are producing 3 units, A, B, C. Okay sir, so what? But fixed cost is one single fixed cost. Fixed cost is one single fixed cost. Okay, so what sir? So nothing, remember this, one fixed cost, 3 different products, which means contribution, overall contribution from 3 different products should be recovered, used to recover the fixed cost, single fixed cost to arrive at the overall profit. Correct? Now the question is, sir, to arrive at the break even, how many units of A, how many units of B, how many units of C should be produced, sir? How many units of A, how many units of B, how many units of C should be produced, sir? That's why we call it as combined break even point. That we call it as combined break even point. You should check, guys, whether they want it in terms of units or whether they want it in terms of rupees. Whether they want it in terms of units or whether they want it in terms of rupees. Let's say break even point, they want it in terms of units. Normal break even, what is the formula? Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. Whereas amount wise it is fixed cost divided by PV ratio. Here guys, as the multiple products are there, instead of contribution, we take combined contribution. Instead of contribution, we take combined contribution. Instead of PV ratio, we take combined PV ratio. Instead of PV ratio, we take combined PV ratio. Sir, why sir? Formula and all, I have explained it to you in a regular class. Hope you remember it. Yes, I am not going to explain it again and again and again. Okay sir, how do you arrive at a combined contribution? How do we arrive at a combined contribution? Very simple guys, weighted average of the different contribution. For example, product A giving you 10 rupees contribution. Product B will be giving you 8 rupees contribution. Product C will be giving you A, B, C. Contribution, A is giving 10, B is giving 8, C is giving 6. Now listen, sales ratio. Sales ratio. They are telling, if at all you are selling, let's say 40 units. If at all you are selling 40 units, in the 20 will be A, 10 will be B, 10 will be C. That means sales ratio among these 3 will be 2:1:1. 2:1:1. Now try to understand, combined contribution will be nothing but contribution in the weighted average based on their sales ratio. That is 10 into 2 plus 8 into 1 plus 6 into 1 whole divided by 2 plus 1 plus 1, 4. Hope it's clear. How much it will be? 20, 28, 34, 34 divided by 4. 8.5. 8.5 per unit. Got it? Huh? Now let's say our fixed cost is 8,50,000. Our combined fixed cost is how much? 8,50,000 divided by 8.5. So my break even is 1 lakh units. My break even is 1 lakh units. In this, A, B and C should be produced in the ratio of 2:1:1. That is 1 lakh into 2. Sorry, 50,000. 25,000. 25,000. 1 lakh into 2 by 4. 1 lakh into 1 by 4. 1 lakh into 1 by 4. This will be your break even point where you will end up achieving no profit, no loss. Hope it's clear. Sir, if they give 2:1:1, how we will get to know? That is in terms of units only, sir. Always remember, guys, if at all they give it in ratio, then always remember they are talking about sales mix. Sales mix in terms of units. Sales mix in terms of units. If at all they give it in percentages, then always remember they are talking about sales mix in terms of amount. Sales mix in terms of amount. Okay. So, sir, if at all they talk in percentages, can we apply the same thing? The answer is no. Why? Because they are talking about sales amount, not sales unit. I told you, if you remember, while computing the break even formula now, amount is there means you should multiply with ratio, not with amount. Amount into amount, what it will give? Something else only. Unit into amount, that's what we have done now. Now, if at all they give it in percentages, that means they have given sales value mix. A, B, C. Let's say they will tell 50% of the sales, 30% of the sales, 20% of the sale. Now don't take 5:3:2 and find out combined contribution and all. Listen, let's say selling price are 20, 30, 10. Variable cost 15, 15, 6. Now how much will be the contribution? 5, 15, 4. Try to understand. If at all they have given it in percentages, that means they are expecting you to find a break-even point in terms of amount. Amount, not in terms of units. So what you should do, sir, you don't want combined contribution per unit, you want combined PV ratio. You want combined PV ratio. How much will be the PV ratio, guys, here? 5/20. 25%. 15/30, 50%, 4/10, 40%. Don't take contribution into sales mix percentage because it is in terms of amount. This also in terms of amount. Rupees, if you multiply, you will get double rupees, not anything else. You should multiply rupees into ratio, units into rupees. That's why you should not multiply contribution per unit into sales mix percentage. You should find out combined PV ratio. How, sir? 0.5, 50%, 0.5 into 25 plus 0.3 into 50 plus 0.2 into 40. How much it is? 35.5%. Let's say combined PV ratio is 35.5%. And let's say fixed cost is around 7,10,000. Fixed cost is around 7,10,000. Then combined break even will be how much, sir? 7,10,000 divided by 0.355 combined PV ratio. 20 lakhs, 20 lakhs. Now this 20 lakh we are going to divide in the ratio of 50%, 30%, 20%. 10 lakh, 6 lakh, 4 lakh. If at all you felt I went faster, please forgive me. But anyhow, You can go and watch what we have already done in the class if you still have a confusion. I think that time we took lot of time, giving you guys lot of time to get a wrong answers, isn't it? Huh? Hope it's clear. So if at all they ask in terms of amount, you should do fixed cost divided by combined PV ratio. If at all they ask in units, fixed cost divided by combined contribution per unit. Okay. So if at all they give it in the ratio, that means they have given sales unit ratio. If at all they will give it in percentages, that means they have given sales amount percentages. When they give percentages, find out combined PV ratio. When they give ratios in normal digits, then take it as combined contribution. Hope it's clear. Yes? Okay. One more thing is there called as shutdown cost. One more thing is there called as shutdown cost. Sir, what do you mean by shutdown cost? Sir, shutdown cost is nothing but, guys, extra cost what we are incurring. What? Extra cost, or let's say cost what we incur even though we shut down the business. Cost what we incur even though we shut down the business, that particular cost we call it as shutdown cost. For example, let's say this building, I have taken it on lease rent. Agreement is for 10 years. Now 6 years I have run the business. 10 lakh is the rent, okay? Now I'm thinking whether I should run the business for the 7th, 8th, 9th and 10th year because it's giving me a loss. Should I run my business for the 7th year, 8th year, 9th year, 10th year as it is giving me a loss? Should I run or not? Now try to understand. Whether I run or whether I don't run, as per the agreement, for the 7th year, 8th year, 9th year, 10th year, 10 lakh rupees rent I have to pay. Now this 10 lakh rent which I can't avoid just because I shut down my business, then this 10 lakh we call it as shutdown cost. That is the cost which you should incur even though you shut down the business. Cost which you should incur even though you shut down the business, that particular cost itself we call it as a shutdown cost. Shutdown cost. Okay, sir, how is that even going to affect the decision? Very simple. Try to understand. Boss, if I shut down the business, I have to incur loss of 10 lakh. No doubt in that. Correct? Because I have to end up paying 10 lakh. If at all I run my business in the 7th year, I end up with a loss of 4 lakh. Now tell me, both are loss only. Should I shut down or no? No. Why? If I shut down, I will incur the loss of 10 lakh. If I don't shut down, I will incur the loss of just 4 lakhs. Better run the business. What do you mean by this, sir? Whenever shutdown cost exists, don't close the business just because loss is there. Loss tolerating level could be set at shutdown cost. What do you mean by that, sir? If at all our loss is something less than shutdown cost, run the business. You can reduce your loss. If at all loss going beyond shutdown cost, if at all loss going beyond shutdown cost, that we call it as, then only we will shut down the business. Then only we will shut down the business. Got it? No doubt? Pakka? So, listen here again. Shutdown cost, whenever it exists, just don't close the business because it is giving you loss. If at all loss is less than shutdown cost, better to run only. Because if at all you close, you have to incur shutdown cost as a loss. So then how to decide, sir, what is my shutdown point? Very simple. Let's say my selling price is rupees 100. Variable cost is rupees 70. Fixed cost rupees 3 lakh, out of which 1,20,000 is shutdown cost. That means out of 3 lakh, if you shut down the business, still you have to incur 1,20,000. If you run, you have to incur a whole 3 lakh. If you shut down, then you have to incur 1,20,000. Okay. Now, let's say you are selling 10,000 units. You are selling or 11,000 units. Should you shut down or no? Very simple. How much will be my sales? 100 into 11,000. 11 lakh. How much will be my variable cost? 11,000 into 70. My contribution will be how much? Fixed cost is how much? Profit. When I'm making profit, why the hell I will be closing my business? Isn't it? So at 11,000, I'm not going to close down my business. What if it comes to 9,000, sir? Then 9,000 into 100, 9 lakh. 9,000 into 70, 6 lakh. Contribution, loss of 30,000. Now the question is, should I close down my business? The answer is no. Why, sir? See, if you close down your business, your sales will be nil. If you didn't do any sales, of course, you wouldn't have incurred any variable cost. That means your contribution was nil. Minus fixed cost. I agree. Generally, that 3 lakh won't come. However, if at all shutdown cost is there, you have to incur that 1 lakh 20, no? Yes or no? That means you will end up incurring loss of 120,000. So you tell me whether 120,000 loss is better or 30,000 loss is better. 30,000 loss is better. So remember, my shutdown point, that is point at which I should close my business, will be decided by taking shutdown cost also into consideration, not because just existing loss. What do you mean by that, sir? Let's say shutdown point, that is the point at which I will close my business, be X units. Sales will be 100x, variable cost will be 70x. Correct? Contribution will be 30x. As I am running my business, my fixed cost will be 3 lakh. I will be okay up to loss of 1,20,000. Up to loss of 1,20,000. Hope it is clear. Now 30x minus 3 lakh is equal to minus 1,20,000. 30x is equal to 1,80,000. X is equal to 6,000 units. That means try to understand. Up to 6,000 units sale, I am absolutely fine. If at all my sales go less than 6,000, then I will decide to close my business. For example, if I end up making 6,500 units, if I end up selling 6,500 units, how much will be my sales? 6,500 into 100, 6,500 into 70, 4,55,000. Contribution, fixed cost, profit, 1 lakh, loss. Correct? But if I close my business, I will incur the loss of 1,20,000. So better to run the business. What if it's 5,500 units? Then sales will become 5,50,000. Variable cost will become 5,500 into 70. 3,85,000. Contribution will become 1,65,000. How much is the loss? 1 lakh. So it's better to run or close? Close. Why? If I close, my loss will be restricted to only 120. Because of running, it's going to 135,000. So at 5,500, I will sell. I will stop. Which means try to understand. 6,000 units is this thing. So at 6,000 units, if you run the business also same loss. If you close the business also same loss. That is your shutdown point. I hope you understood how to find out shutdown point. Sales variable cost, contribution minus fixed cost should give you loss as per shutdown. Then how much unit if I sell, I will be able to make the same loss as shutdown. That will be my shutdown point. If unit sold goes less than shutdown point, close the business. Unit sold is more than shutdown point, run the business. Simple. Hope it is clear. One last concept is there called as key limiting factor. What? Key limiting factor. Key limiting factor is nothing but, guys, resource is limited. Resource is limited. The resource which is limited, that itself we call it as key limiting factor. KLF. Key limiting factor. It could be labor hours, it could be direct material, whatever it is. Okay. Now, sir, on what basis? One thing is very clear here. Key limiting factor means we have demand. Let's say we have demand of 10,000 units. But due to some limiting factor, either in terms of labor or either in terms of material, we are able to produce only 8,000 units. Now the question is, should I produce 8,000 units in that? How many units of A should I produce? How many units of B should I produce? How many units of C should I produce? If that is the question, on what basis we should take a call? Which one to produce more, which one to produce less? Because it is very clear, demand is 10,000, but I have capability of doing only 8,000 units, which means I can't satisfy whole 10,000. So whether I should produce A, B, C, which one more? That decision to be taken not on the basis of contribution per unit. The decision to be taken on the basis of contribution per key limiting factor. Contribution per key limiting factor. For example, if the labor hour is restricted, then let's say A is giving you contribution rupees 10, B is giving you contribution rupees 15, C is giving you contribution rupees 20. A is giving you 10, B is giving you 15, C is giving you 20. Labor hours taken by A to produce 1 unit is 1 hour, B 2 hours, C 3 hours. Now, based on the contribution, which one you will choose? C will choose no. Second, B no. If anything remains, then A no. But you should not take call on contribution per unit. You should take call on contribution per key limiting factor. That is, per 1 hour of labor, which is giving me highest contribution. A, you see, 10 rupees we are earning because of 1 hour of labor. So contribution per key limiting factor is 10. B, 15 we are earning because of 2 hours of labor, which means per hour it is giving me contribution of 7.5. C, we are earning 20 rupees for 3 hours of labor. That means per unit it's giving me 6.66. So A will be ranked 1. B will be ranked 2, C will be ranked 3. Now, how much ever the requirement is there, A will be produced so much. If any remaining labor hours are there, then B will be produced second. If anything remains, then to the remaining extent, C will be produced. So, 3 simple steps you have to follow. Step number 1, find out a contribution per unit. Step number 2, find out a contribution per key limiting factor. Step number 3, assign the rank. Step number 4, start producing on the basis of ranks. However, if at all minimum criteria is there, first you should produce all minimum things. After that, you should allot remaining resource after utilizing it for minimum to on the rank basis. That is, for example, ABC minimum units they told. First, you should find out how much resource is going to be blocked for producing minimum. Remaining resource allocation should be done on rank basis. That one question is there that I will show it. Okay. Majorly the scale up and all we are going to learn in management accounting in a much more in depth. Here how much ever is required, that much I have told. Hope you are able to recall what we have done there. Right. I think this example what we have taken, I think T example we have taken for multiple break even. Here we have taken something else. Leave. Mushroom biryani. Correct. Number of mushroom biryani. Correct. Mushroom was limiting factor there. Correct. Hope you remember that, right? Fine then. Example we remember, sir. Fine. So that's all about marginal costing. Now we'll see few questions on marginal costing. Okay, we'll see few questions. We'll take a break of 2-3 minutes and we'll continue. Okay, now we'll see past year papers of marginal costing. So may I know the question number, please? June 23, MCQ 11 now. Which of the following factors are responsible for change in break-even point? Break-even point consists of two elements in it, fixed cost and contribution. So fixed cost will affect break-even point, contribution will get affected by selling price and variable price. So change in fixed cost, yes. Change in variable, yes. Change in sales, yes. All of the above, yes. Got it? Next up. 7A na or 7 na? Both are marginal only. Measures. Alpha Limited manufactures a single product and has the following data for the year 2022. Selling price per unit is 200, direct material cost is 54, direct wages is 40, fixed overhead is 190,000, variable overhead is 50% of the direct wages and trade discount is 5%. Measures Alpha Limited approaches you as a qualified cost accountant and ask you to one advise the PV ratio of the company, critically assess the break-even sales, evaluate the margin of safety in terms of rupees as well as percentage of sales, recommend the net profit if sales are 10% and 20% above the break-even volume. Now listen. Direct material cost is 54, but trade discount of 5% is there. Correct? I'll just show it here only if at all they have done it. A, right? 7A, right? So, they haven't done, no? Congratulations. Listen. So, how much is the direct material then? 5% of 54. Sorry? Rupees 51.3. Actually, here bit of assumption to be made, whether trade discount to be on 5% of selling price or 5% of material. They should have given somewhere. It is whether our trade discount or our supplier's trade discount. First, let's see by assuming this one. Next, we'll see what institute has assumed. So, direct wages will be 40. Variable overhead is 50% of direct wages, 20. Correct? So, total variable cost is how much? $111.3. So, contribution will be how much? 200 minus 111.3. 88.7 divided by 200 into 100. 44.35. So here they have taken 40. Then they might have assumed trade discount on the selling price. If that is the case, we'll see once again. Okay. 200 of that 5% means 10 rupees, right? So 190 will be the selling price. Direct material, direct wages, variable overhead will come to 20. Total will come to 140 now. Rupees 114. So 190 minus 114 will give us contribution divided by sales into 100. 40%. So basically, if at all in examination, if they give trade discount, just assume it on the selling price. Generally, they don't do this kind of mistakes. They will mention it is on what, but yeah, if it's silent, then take it on sales. We are giving discount. So hope PV ratio is clear. How much? 40%. Critically assess the break-even sales in rupees as well as in units. Units, it is very simple. Fixed cost divided by contribution per unit. How much is the contribution? 76. How much it is? Sorry? 2500 units. In terms of rupees, it is 190,000 divided by 40%. 4,75,000. Hope it's clear. Next. Evaluate the margin of safety in terms of rupees as well as percentage of sales. But the thing is, they haven't given how much is the total sales. Correct now? Or have they given? They haven't given how much is a total sales. If at all they had given, then only we can find out a margin of safety. They haven't given here. So what they have done here? I think they are doing it for this one. Interrelated question. Recommend the net profit if the sales are 10% and 20% over and above the break-even point is there. No, I think for that they are considering. That is, right now it is 475,000. No, 10% increase in it will be how much? 5,22,500. 20% over and above this? 4,75,000 plus 20%? 5,70,000. Contribution of this will be how much? 40%. No? First one, 2 lakh. Okay. First one, 2 lakh 9,000 minus fixed cost. Fixed cost will come to 1,90,000, right? 19,000. First one will throw you a profit of 90,000. 19,000, okay. Second one, 38,000. 38,000. We know that margin of safety is nothing but profit by PV ratio. Correct? Profit is 19,000. PV ratio is 40%. 19,000 divided by 0.4. 38,000 divided by 0.4. 47,500. 95,000. This is in terms of amount. Also, they are asking as a percentage of sales. 47,500 divided by 5,22,500. Sorry? 9.09 percentage. 95,000 divided by 5,70,000 into 100. Hope it is clear. They have taken this way. I think everything is sorted. Hope it's clear. We'll go to the B. By the way, minimum price, how much you should charge, sir? At least to recover your cost, you should be able to charge. Okay. Mr. Lurvey is a umbrella manufacturer and manufactures an average net profit of rupees 5 per piece on a selling price of 28.6 by producing 12,000 pieces or 60% capacity, which means 100% capacity is nothing but 20,000 units. Correct? Okay. His cost of sales, direct material 7 rupees, direct wages 2.5, works overhead 50% is fixed, it seems. So 12.5 I am going to divide it into 2. 6.25, 6.25. So into 12,000 will give me fixed. How much? 75,000. Works overhead fixed is 75,000. Selling 25% is variable, it seems, which means 75% is fixed. 1.2 is fixed, 0.4 is variable. Correct? So 1.2 into 12,000. 14,400 is fixed selling overhead. Hope it's clear. During the current year, he intends to produce the same number but anticipates that fixed charges will go up by 10%, while direct labor rate and material will be increased by 8% and 6% respectively, but he has no option of increasing the selling price. So selling price remains same, but direct material and direct labor will go up by 6% and 8%. So it will become how much? 7 plus 8%. If you do this, the answer will be wrong. That day also I told you, if you remember. First they have given direct labor, then they have given material. Here, material first, labor later. So 7 plus 6% you should do. How much? 7.42. Next one, plus 8%. 2.7. Okay. Under this situation, he obtains an offer for further 20% of the capacity. Of course, we have that capacity because we are just producing under 60%. Other 20% is like 4,000 units. Mr. Love approaches you as a cost accountant and asks you to advise the minimum price per unit for acceptance of the offer if he wants to ensure an overall profit of 70,000. He wants a profit of 70,000. To achieve 70,000, he expects you to determine the selling price for this new offer. Very simple. Listen. I will divide it into 2%. Two things now. 60%, 20%, total 80%. 60%, 20%, 80%. At 60%, right now we are producing 12,000 units. Offer we are getting for extra 20%, that is 4,000. So total will end up making 16,000. Now first, listen, very important. Sales. 12,000 units will end up selling 28.6 only. How much it is? 3,43,200. This sales is there, no? The 20%, that we don't know how much it is. Let it be. Minus variable cost. In the variable cost, we have direct material, we have direct labor, we have direct material, direct labor, variable works overhead, and we have variable selling and distribution overhead. Direct material per unit and all we have calculated here already. Per unit it will come to 7.42. Correct? And 2.7. And variable overheads are 6.25 and 0.4. 6.25, 0.4. Just tell me the total now, we'll take it directly. 7.42 plus 2.7 plus 6.25 plus 0.4. $16.77. So how much is 16.77 into 12,000? 2,01,240. Okay. What about this? 4,000 into 16.77.
7.5.
67,080. Total 2,68,320. Correct? Now that will give us contribution here. First one, how much is the contribution? How much ever it is. Leave. Listen here. Concentrate now. This will give us contribution minus fixed cost will give us profit. Yes or no? Now profit we know. They're expecting us to get a overall profit of 70,000. Correct? Overall profit of 70,000. Fixed cost is how much? They are telling fixed cost will go up by 10%. That is 75,000 plus 14,400. 89,400 plus 10%. So 98,340 na. My overall contribution should be how much? 1,68,340. Agreed? 1,68,340 minus 98,000 will come to 70,000. Correct? No? Now listen. How much was the contribution from this selling this 12,000 units? 1,42,960 na. What? 3,43,200 minus 2,01,240. 1,42,960. That means how much should be the contribution from this one? How much it should be? $25,380. When the variable cost was 67,80, if you want contribution of 25,380, then how much should be my sales? $92,460 na? Okay, listen here. My sales should be 92,460 by selling 4,000 units. By selling 4,000 units. How much it is? 23.11512. So minimum I am going to charge is 23.12. Hope it is clear. 7B na 23.365 because of rounding off might be somewhere. Hope it's clear here. Pakka? You understood now how we did? Next one. December 23. MCQ 3. X generate a contribution to sales ratio 40%. That is nothing but your PV ratio. Fixed cost is 60,000 per month. Sales required to achieve a monthly profit of 12,000. That means try to understand. Let sales be X. Formula, you know, fixed cost plus desired profit divided by PV ratio. But still, we don't have to worry so much. Sales, if you take it as X, contribution will be 0.4X. From the 0.4X, if you reduce 60,000, our profit should come to 12,000. Correct? So 0.4X is equal to 72,000. X is equal to 0.4. Option D. Hope it is clear. Next up. 7. The sales amount to product Z is rupees 1 lakh. Variable cost is 40,000. Fixed cost is 50,000. Break even point sales they are asking. Try to understand. Fixed cost divided by PV ratio. PV ratio, try to understand when sales is 1 lakh, variable cost is 40. That means contribution is 60,000. 60,000 divided by 1 lakh into 100, 60%. How much it is? 83,000. Option C. Next up. Hope you are able to understand. Next. Question 6. 14 marks question. New Vistas Limited is a manufacturing 3 household product X, Y and Z. Correct? Selling them in a competitive market. Great. The following details regarding current demand, selling price and cost structure are extracted from the records of the company. Expected demand are 20,000, 24,000, 40,000. Selling price are 40, 30 to 20. Variable cost, direct material, where 20 rupees per kg is the cost of direct material. Here it is 12 rupees means how much direct material we are consuming. 0.6 kg. Correct? Here 8 means we are consuming 0.4 kg. Here 4 rupees means we are consuming 0.2 kg. Agreed? Direct labor 30 per hour it seems. That means here we are taking 0.2 hours. Here also 0.2 hours. Here 0.1 hour. Correct? Variable overhead are 4 to 2. And fixed overhead per unit is 10, 8, 4. That you leave fixed overhead. Now listen. Company is frequently affected by the acute scarcity of a raw material and high labor turnover. Awesome. During the next year, it is expected to have one of the following situation. Situation number 1. Raw material availability will be only 24,200 kg. So, raw material will be key limiting factor. Direct labor hours available will be only 10,000 hours. This will be situation 2, key limiting factor. Both are not there. If both are there, you should find out as per both the situation, how many units you can produce. In that lower will be the maximum you can produce. As per material you can produce 10,000, let's say. As per labor you can produce 8,000. Then maximum you can produce is 8,000 only. Just because you have material, you start producing 10,000, because of unavailability of labor, that will become unfinished goods. So lower of those two you should select. Calculate the net profit of the company in each of the above situation. Simple one. Now listen, how much is the fixed cost compute now? 20,000 into 10, 2 lakhs. 8 into 24,000. 1 lakh? 92,000. 40,000 into 4. These are the fixed cost. This won't change now. For the given level, these are the fixed cost. Now listen. First, let's say raw material is the 24,200 is available. Let's check whether that is enough or no first. 20,000 into 0.6 m plus 24,000 into 0.4 m plus 40,000 into 0.2 m plus mrs. 29,600 is the requirement, but you have only 24,200. So we are in the situation of key limiting factor. So in key limiting factor, step number 1, we have to calculate contribution per unit. Correct? X. Selling price is 40. Variable cost is 12,604. Total 22. 40 minus 22. 18. Right? Okay. Going to Y. 32 minus 8. 16. 16. Correct? 20 minus 9. 11. But don't rank it on this basis. You should rank it on the basis of contribution per key limiting factor. That is nothing but here contribution per kg of material. Contribution per kg of material. So try to understand. 18 rupees we are getting because we are using 0.6 kg. So for 1 kg, how much? 18 divided by 0.6 into 1 automatic it is. 30. Next one, 16 rupees because we are using 0.4 per unit. So for 1, how much? Sorry? 40. 11 divided by 0.2. 55. This is contribution per kg of material. So rank 1 should be given to Z, rank 2 should be given to Y, rank 3 should be given to X. So units to be produced. First produce how much ever is possible, Z, because minimum criteria is not there. So Z, demand is for 40,000, right? Okay. 40,000 units required. So it will consume how much of the material? 0.2 kg of material per unit. How much? 8,000 kgs will be consumed with this. Now, opening was 24,200 kg of material. In this 8,000 is gone for Z. How much is remaining then? 16,200 kgs. Correct? Next, Y. Next priority should be Y. 24,000 units is a requirement. And per unit, it will consume around 0.4 kg. So it will consume around 9,600 kgs. So how much is remaining then? 6,600 kg is remaining. Next is X. How many units could be produced using this 6,600 kg, guys? 6,600 kgs divided by 0.6. So 11,000 units of X will be produced. Hope it is clear. So now listen. X, Y, Z. Sales. X we are selling 11,000 units. So 11,000 into 40. 4,40,000. Why we are producing the maximum number of units only? That is 24,000 units. So 24,000 into 32. 7 lakh? 68,000. Z also we are producing the maximum. That is 40,000. 40,000 into 20. 20 rupees, no selling price. How much? 8 lakhs. Minus variable cost. Variable cost per unit we already computed here. Material 12, 6, 4, 22. So here it is 8, 6, 8, 16. Here it is 4, 3, 7, 9. So 22 into 11,000. 2 lakh? 42,000. Okay. 16 into 24,000. 3 lakh 84,000. Next one, 40,000 into 9. 3 lakh 60,000. How much it is? 1,98,000. Correct? 3,84,000. 4,40,000. And fixed cost we already computed it as 1,92,000 and 160,000. 2,000 loss, 1,92,000 profit, 2,80,000 profit. Correct? Hope it is clear. Sixth one, let's see what these guys have done. How much it is total? Just check now. 280 plus 192 minus 2,000. 4,70,000 matching. Whoever do the self study, congratulations, guys. I don't know what your institute is thinking, to be frank. So, next one, shall we calculate? Yes? That is by keeping labor as a key limiting factor. Labor as a key limiting factor. Contribution per unit though won't change because of this. Correct? But of course, we don't want now contribution per unit. We want contribution per labor hour. 18 rupees we are earning for using 0.2 labor hour. So for 1 hour, how much it is? 18 divided by 0.2. 90. 16 we are earning for using 0.2 labor hour. So for 1 hour, how much it is? 80. 11 rupees we are earning for using 0.1 hour of labor hour. So how much it is? 110. Correct? So Z will be rank 1, X will be rank 2, Y will be rank 3. First, Z, X, Y. Opening hours available is how much? 10,000, right? 10,000 hours. Listen. Z, first let's say, will produce full possible 40,000 units. And I think per unit we take 0.1 hour, right? So 0.1, which means it will consume around 4,000 hours. So 6,000 hours are remaining. Next is X. X, let's say 20,000 is a demand. X 20,000 and it takes 0.2 hour. 4,000 hours. That means balance remaining is 2,000 hours. In the 2,000, how many units of Y could be produced? 2,000 divided by 0.2 will produce 10,000 units of Y, which will come to 2,000. Hope it is clear. Now, X, Y, Z units 20,000, 10,000 and 40,000. Now I don't start from the beginning sales and all. I will just start with the contribution here. Okay. From 20,000 units of X per unit 18 rupees. See, don't take this contribution. This is per labor hour. We want per unit how much? Because we are multiplying with unit. 18 into 20,000. 3,60,000. 16 into 10,000. 1,60,000. 11 into 40,000. 4,40,000 minus fixed cost. Fixed cost won't change. 2 lakh, 1,92, 160. 2 lakh, 1,92, 1,60,000. How much it is? 1,60,000, negative 32,000, positive 2,80,000. How much it will be? 280 plus 160, 440 minus 32,000, 408,000. Net profit 408,000. Hope it is clear. Key limiting factor, one nice question they have asked. If at all they asked both are key limiting factor, then you should check under both maximum how many units you can produce, and on that call you should take. Okay, what is it? They asked that much only, no? Next. June 20. MCQ 8. When the PV ratio is 20%, margin of safety is 30%, profit is question mark. Try to understand this. What is it, sir? Margin of safety ratio is 30%. That means if the sales is 100, then margin of safety is rupees 30. Correct? How did you arrive at rupees 30, sir? How did you arrive at rupees 30? Can I tell? Rupees 30 we will arrive by dividing profit by PV ratio. So profit will be how much then? 30 into 0.2, rupees 6. Sales we assume to be 100, profit is 6, that means how many percentage? So whenever they give like this, don't think some rocket science and all, just allot some numbers, but correct numbers. Hope it's clear. Next, question 6, Aristocrat Limited, while operating at a 70% level of activity, produces and sell two products A and B. Okay. Cost and sales data for the two products are as follows. Units produced and sold are 3000, 2000, which means total 5000. 70% means 5000 units. Direct material, direct labor. Okay. Factory overhead in this 40% is fixed, it seems. So how much is fixed in it? 25 into 40%, 10 now. So 10 into 3000, 30,000 is a factory overhead allocated to product A. Then rupees 15 is variable, right? So variable cost in it is rupees 15. Here 15 rupees it is. So 40% of that, rupees 6 into 2000. So rupees 12,000 is fixed here and rupees 9 is variable. Correct? Admin overhead 40 it seems. 40 and 25. So 40, 60% is fixed. So rupees 24 is fixed. Rupees 16 is variable. So 24 into 3000. 72,000 is fixed admin overhead. Here 25 into 60%. 15. So 10 is variable. 15 into 2000. 30,000 is fixed cost. Correct? So here fixed cost will be how much right now? 30 plus 72. Rupees 1,02,000. Here how much it will be? 12,000 plus 30,000. 42,000. Hope it is clear. Factory overhead are absorbed on the basis of machine hours, which is the limiting factor. So machine hours are the limiting factor, it seems. And it is absorbed on the basis of labor hours. Machine hour rate is rupees 10 per hour, which means here 2.5 hours of machine is required for product A. 15 means rupees 1.5 hours is, 1.5 hours of labor hour is required for product B. Correct? Understood or no? Aristocrat Limited receives an offer from the USA for the purchase of product A at the price of 87.5. So we got one offer where the selling price will be 87.5, less than 115. Alternatively, company has another offer from the UK to purchase product B at 77.5, where now it is 95. In both the cases, special packing charge of 2.5 per unit has been borne by the company. Company can accept either of the two by utilizing the balance of 30% of its capacity. So it can go for product A offer or product B offer just to utilize the remaining 30% capacity. Okay. Now, examine and advise company as to which proposal should be accepted, showing total profit for your offer. Very simple, guys. If at all, now one thing is very clear. Try to understand. 3000 units of A we are producing. Correct? Each and every unit will take 2.5 hours of machine. Agreed? How much it is? 7,500 hours. We are also producing B unit, 2,000 units, which will take 1.5 hours of machine. Correct? How many unit? 2,000 units. 3,000. Now listen very carefully. We are actually utilizing 10,500 hours of machine. Correct? And best part is we are utilizing only 70% of it. That means try to understand 10,500 is there, no? That is 70% of the total capacity. $10,500 is 70% of the total capacity. So total capacity is 15,000 hours. That means excess we have is 4,500 hours. 4,500 hours. Now listen. We have offer from USA for product A. We can produce A in 4,500 hours. Or we can produce B in 4,500 hours. Whether to produce A or B, that is the question. Very simple. Which one you will produce? Which one will give me maximum contribution per machine hour? Per machine hour. Because machine hour is a key limiting factor here. So now our work is very simple to find out which gives how much contribution per machine hour. So selling price how much in the product A? 115. Correct? But don't take 115. That is in normal case. Here these guys are offering to buy our product at 87.5. 87.5. And product B they are offering us to buy at 77.5. Correct? But there is one special cost we are incurring. 2.5. Packing cost. Extra. 2.5. That means it is as good as we are receiving 85 and 75 in the local market. Correct? Just because the selling price is decreasing. Will our cost decreases? No. So all this remains same. Material cost of 10 rupees plus labor 20, 30 plus factory overhead 15, 45 plus admin overhead of 24. Sorry, not 24, wait. 16 plus 15 plus 20 plus 10. 61. Sometimes they might also give for this extra selling expense need not to be incurred. That means you should exclude that 16. Don't take that. Next one. 20, 40 plus 9 plus 10. 59. 14, 16. Okay. 14 rupees we are 6. 14 and 16. 14 rupees we are generating by using machine hour for 2.5 hours. Per hour how much? 14 divided by 2.5. 5.6. 16 hours, 16 rupees we are generating by utilizing machine by just 1.5 hours. That means 1 hour how much? 10.67. 10.67. Now, of course, we will prioritize product B to produce in that 4,500 hours. How many units of B could be produced? 3,000 units of B could be produced. Okay? 3,000 units of B could be produced. Hope it is clear. I will just show it here only. Fine, right? 6, right? This one. Hope you understood how to arrive at answer. Company should accept the offer from UK to export 3000 with the net profit of so much. Hope you understood. Simple. Akkana understood now how we decided. This was which question? Paper number? December 24. No, June 24. December 24. May I know the question number, please? 9th MCQ. Rono Limited maintains a MOS of 25% on current sales and earns a profit of 30,000. That means margin of safety will be how much? Wait, if the company has a PV ratio of 40, what is its current sales? Very simple. Profit 30,000, correct? 30 lakhs, right? Sorry. Profit 30 lakhs divided by PV ratio 0.4. How much it is?
75 lakh.
So we know that 75 lakh, it's nothing but MOS. 25 means 75, 100 means question mark. Hope it's clear. Next up. Fixed cost is treated as a period cost. Next up. Full 14 marks. Center Limited. Give me a second. 1 second. I will read this question. See there. Centaur Limited, a manufacturing company, manufactures a single product which has a capacity of 1,50,000 per annum. Total capacity is 150,000 per annum. Correct? Summarize profitability they have given. Sales, we can sell around 1 lakh units. How many units you can sell? 1 lakh units we are selling. 15 per unit. Cost of sales, direct material 3 lakh, direct labor 2 lakh, variable 60,000, overhead, production overhead fixed 3 lakh. Admin overhead completely fixed 150,000, selling and distribution completely variable 90,000, and fixed 150,000. Profit is so much. Evaluate the following option, each option to be treated separately. Separate. First one, calculate the amount of sales required to earn a target profit of 25% on sales if the packing is improved at a cost of rupees 1 per unit. Before that, help me with this. How much is the total variable cost you compute? 3 lakh plus 2 lakh, 5 lakh plus 60,000, 5 lakh 60,000 plus 90,000. 6 lakh 50,000. 6 lakh 50,000 is our variable cost, total variable cost. Per unit, how much? 6.5. Fixed cost, just calculate 3 lakh plus 150,000, 450,000 plus 150,000, 6 lakh. Fixed cost is, hope it is clear. Yes. Now, calculate the amount of sales required to earn the target profit of 25% on sales. So, try to understand. Amount of sales required. Selling price, listen. Selling price we are not changing. 15 rupees only. Correct? Okay. 15x will be my sales. Correct? Variable cost will be 6.5 plus 1. Packing 7.5x. So my contribution will be 7.5x. Fixed cost is coming to, somewhere we computed now, 6 lakh. Fixed cost is coming to 6 lakh. We need a profit of 25% on sales. 15 into 25 is how much? 25%? 3.75. X is what we want to achieve. Now, X is the thing. 7.5x minus 6 lakh is equal to 3.75x. How much it will be x? I think 6 lakh divided by 3.75 directly. 1,60,000. Correct? But 1,60,000 units it is. 1,60,000 units. Got it? So 1,60,000 into 15. Sales required to achieve the target is 24 lakhs. Sales required to achieve the target is how much? 24 lakh. Hope it is clear. Yeah, sixth one, no? Sales required to achieve profit is 24 lakh. Hope it is clear. Shall we see the second one? There is an offer. No. In that only. There is an offer from a large retailer to purchase 30,000 units per annum. There is an offer where that our retailer is telling, boss, I will purchase 30,000 units. That is well within the limit only. Because we have extra capacity of 50,000 units still. Subject to providing a packing with a different brand name at a cost of 2 rupees. Extra cost of 2 rupees will be there. So this one also will be added, sir. The answer is no. Independent cases. However, in this case, there will be no selling and distribution expense. Awesome. Also, this will not in any way affect the company's existing business. Identify the break-even price for this offer. That is extra cost. That will be selling price. So listen here. Material cost will be as it is. Correct? 3 rupees per unit. Correct? Labor will be as it is 2 rupees per unit. Production overhead will be as it is 0.6 per unit. Selling and distribution won't be there. Selling and distribution won't be there, but extra cost of 2 rupees will be there. 7.6. Are we incurring anything extra cost because of this? No. Sir, fixed cost we are not recovering. No. Fixed cost anyhow we are recovering from that 1 lakh units only. No. Whether you accept this offer, whether you don't accept this offer, fixed cost is changing. Then only this much is the extra cost. So price at least we are going to collect is 7.6. Hope it is clear. 7.6. If at all any extra fixed cost would have been there, that we would have divided with that 30,000, we would have taken that also. Because that is relevant cost. Now it is sunk cost. Next. In study material, none of the decision making questions are there. Marginal costing. Examination, everything is decision making. Wow. Again, management accounting, you will learn the same thing. If an expenditure of 3 lakh is made on advertising, the sales would increase from the present level of 1 lakh to 1,20,000 at a price of rupees 18 per unit. Will this expenditure be justified? Guys, right now we are making 2,50,000. No. If at all our profit goes beyond 2,50,000, we'll be fine with it. Let's check. How many units we will be able to sell? 1 lakh units to 1,20,000. 1,20,000 units we can sell at the rate of 18 rupees, which will come to 21,60,000. Correct? Variable cost will be how much, sir? 6.5 per unit right now. Correct? No? 6.5 into 1,20,000. 78 lakh. Correct? No? Minus fixed cost. How much is the fixed cost right now? 6 lakh. But because of that extra advertisement, it will become 9 lakh. 6 lakh plus 3 lakh. It will become 9 lakh. So how much will be the profit? 21,60,000 minus 78 lakh. 7,80,000. Sorry. 7,80,000. 21,60,000 minus 7,80,000 minus 9 lakh. How much? 4,80,000. Now it is 2,50,000. It is justified. Good to go. 4,80,000. The amount of profit in sales. Conclusion you should give. This at least workings they have done. Luckily. Fourth one. If the selling price is reduced by 2 rupees, there will be 100% capacity utilization. Will it be justified? Simple. How much will be my selling price then? 13 rupees. So how much will be my sales? 13 into not 1 lakh, 1 lakh 50,000, because we can be able to sell whole units. Sales will become 19 lakh 50,000. Just because selling price decreased, will our variable cost decreases? No. It remains 6.5 only, no? 6.5 into 1 lakh 50,000 units. 9 lakh 75,000. My fixed cost will be 6 lakh. Just tell me how much will be the profit. 19 lakh 50,000 minus 9 lakh 75,000 minus 6 lakhs. 3 lakh 75,000. That is also more than 2 lakh 50,000. This is also justified only. Hence the reduction in selling price is justified. Hope it is clear. Nice question, simple question, but I mean 4 different things they have asked. Yeah, you can mark, these are elements. Mark. I mean that basics though required, no? Whoever goes to examination without this PYPs, discussing PYPs, gone only. In exam, what? Marginal costing? We know only break-even point, margin of safety. Sir did not teach anything. Correct. Sales volume in units required is, try to understand. Jolly Limited manufactures a student level fountain pen which is to be sold at 40 rupees. Variable cost is 22 rupees. Fixed cost is 16,000. Company wants to earn the profit of 20,000. Which means total contribution required is 36,000. Agreed? To recover 20,000 profit and 16,000 fixed cost, we need 36,000. Whereas contribution per unit is 18. That means how many pen to be sold? 2,000. Here I did the same question in formula. In one of the question, we did it in step. You can follow anything, your choice. Next. 6. 14 marks. If the company desires to maintain the same present level of profit in the next year, which of the above 2 situation would you recommend? Give your reasons. Man Limited manufactures and sells product X. Following are the data available in this regard. Raw material, conversion cost, variable, dealers, for us it is cost only. So how much it is total? 40, right? 40, no? And selling price is 50. That means contribution per unit is rupees 10. Fixed cost is 8 lakh. Present sales is 150,000. We are utilizing just 60% of the capacity. Just means 100% capacity is how much? %100% capacity is 250,000 units. Correct? Now, there is an acute competition in the market. Awesome. Extra efforts are necessary to sell the product. Crazy. Following suggestions have been made for increasing the sale. 1. To reduce the selling price by 4%. So right now you are selling at 50, no? Reduce it by 4%. 48, 4%. New selling price will be 48. That doesn't change the fact that variable cost will be 40. Correct? Next. I hope now you are able to connect to that. Variable cost won't change with the change in selling price. It changes only with the change in units. Next, to increase the dealer's margin by 20% over the existing rate. Now it is 5 rupees, right? So 5 rupees plus 20%. 6. So if that becomes 6, then variable cost will become 41. Then my selling price will be 50 only. So 9 rupees will be the contribution. If company desires to maintain the present level of profit in the next year, which of the above 2 suggestions would you recommend? Give your reasons. So if at all company wants to maintain the same present level profit, how much or which one would you suggest? Which one would you suggest? I will just show it here. Sixth one. See there, contribution per unit, it's rupees 10 right now. Correct? Total contribution we are getting right now is 15 lakh. 1,50,000 units, 15 lakh. In both the suggestion, fixed cost remains unchanged. Therefore, present profit of 7 lakh can be maintained by having total contribution at the present level of 15 lakh. So the same profit could be maintained if the contribution will come to 15 lakhs. If the selling price falls by 4%, then dealer's margin will also fall by, see this one we didn't account there. Dealer's margin, we are assuming it is on 10% on 50. So dealer's margin also will fall by 4.8. So new variable cost is 39.8. Contribution per unit is 8.2. So to achieve the same contribution, that is to achieve the same 15 lakh contribution, because if you achieve 15 lakh, from that fixed cost will arrive at the same profit. That means contribution we need is 15 lakh to achieve the same profit. If at all fixed cost is changing, contribution plus change in fixed cost is what we should achieve. Got it? I mean profit plus fixed cost including changed. That will be new contribution. So 15 lakh at 8.2 means how many units to be sold? 1,82,927. However, if at all our this one we assumed, here also they have done it on this basis also. By keeping 5 rupees we have kept it same, no? Where the contribution came to 8 rupees. That one also they have done. So alternatively they have given, luckily. Recently they have used their brains then. Hope you understood that. You can take it in either of the ways. Because in question nowhere they mentioned it is 10% off selling price. If they mentioned, that would be taken. Increase in the dealer's margin by 20%. It will go to 6 rupees. We told no. So new variable became 41. New contribution became 9. So you have to sell is 1,66,667. So as per new plan 2, you have to sell just 166,667 to achieve the same profit. Plan A, you have to sell almost 1,87,500. So it's advised to go for plan B. Because it is very near, no? From 150 going to 166,667 makes more sense rather than going to 1,87,500. Hope it's clear. Next. I think PYPs are done, right? Now we'll see model test. MCQ 4. Marginal costing techniques follows which of the following basis for calculation, classification, behavior, fixed and variable. Correct? Next. If the sales are 1,50,000, variable cost is 50,000. That means contribution is 1 lakh. PV ratio will be how much? 1 lakh divided by 1,50,000. 66.67%. Next one. Question 6. This one is crazy question. This actually in ICA examination they have asked as rice, maize and rice, wheat and maize. Here they are asking some like apple, lemon, orange, peaches. 4. There it was only 3. Nice. We'll see this question. The chief accountant of the company running an orchard with an adequate supply of labor. So adequate supply of labor. So labor is available. Following data is available. You advise about the area to be allocated for the cultivation of the various type of fruit to maximize the profit. So basically it's very simple. How much space it takes, how many acres, that is your key limiting factor. Acre is key limiting factor. So whichever gives me more contribution per acre, I will take that. However, in this question, beauty is they are talking about minimum also. So first you should allocate minimum. Remaining resource should be allocated on the rank basis. See there. Company contemplates growing apple, lemon, orange, peaches. Selling price per box they are telling 15, 15, 30, 45. Season yield in boxes per acre. Per acre, how many boxes could be produced also they have told. Costs are material 270, 105, 90, 150 per acre they are telling. Labor per acre again. Packing per box they are telling. Packing per box they are telling. Transport per box they are telling. The total fixed cost in each season would be 2,10,000. That means whatever you produce, how much ever you produce, your fixed cost remains same. That means you should ignore it while making decision. While ascertaining profit and all you should consider. While making decision you can ignore. Following limitations are to be placed before you. First one. Area available is 450 acres. But not of this. 300 acres are suitable for growing only oranges and lemons. Wow. The balance of 150 acre is suitable for growing any of the 4 fruits. First 300 acres restricted only to lemon, orange. That means extra available is 150. So decision to be done relating to this 150. Next, the marketing strategy of the company requires the compulsory production of all the 4 type of products in a season with a minimum quantity of any one type to be 18,000 boxes. Awesome. So that 150 free we told no. That is also not free. That is also minimum 18,000 to be there, everything. Calculate total profit that would accrue if your advice is followed. Okay, give me a second. Go through this question. Nice question. Listen. So 6, right? See there. First we will compute how much is the contribution we are making per hectare from each and everything. Selling price, apple per box 15, 500 boxes. Lemon also 15, 150 boxes. Oranges 30, 100. Peach 45, 200. So total is 7,500. 2250, 3000, 9000. From that, I will reduce the variable cost. Labor and material per acre only they have given. But remember this one. Other variable cost. Everything per box. So you should multiply with the box per acre to arrive at it. We got variable contribution per acre is 4680, 1245, 2310. 6,800. So first priority will be to the peaches, second to the apple, third to the orange, fourth to the lemon. Correct? Now, since the minimum quantity of production of each type of 18,000 boxes and all 4 type of fruits have to be produced, minimum acre to be allotted to what, sir? Apple per acre you can produce 500 units. Correct? So 36 acres of 36 acre is relating to required to apple. Lemon 120 acre is required. Orange 180 acre is required. Peach, 90 acre is required. Total 420 acre is required. Which means try to understand. Out of 450, 426 is blocked. Out of 450 acres, 426 is blocked. Which means 24 acres is in discussion now. Only 24 acre is in discussion. And of course, this 24, which one we will prioritize? Of course, we will prioritize peaches only. We'll prioritize peach only. Hope it's clear. But before that, listen. In this 24, there might be one more restriction. What is it? 300 acres you can grow only lemon and orange. Luckily, whatever the minimum is there, no? That gets satisfied with 300. Let's say this became 290. That means in 24 we can't grow peach. Again 10 to be allotted to lemon or orange. Sir, for which one you will allot? Which one gives me more, lemon or orange? Orange. So I will allot 10 more to orange. Remaining 14 I will take to peach. Luckily here 300 is getting satisfied. So directly 24 to be given to, can be given to peach. Hope it is clear or no? You understood what I am trying to say, right? So lemon and orange require 300 units. Moreover, 300 acres of land is suitable only for these two products. Hence, 300 acres should be used to produce only these products. The balance of 24 acres is available for any fruit. Since the peach give highest contribution, we are going to produce that more. Accordingly, these many acres we are going to produce, and how much will be the contribution? Nice question, no? This you can expect in the examination. Mark it as LMR. Hope you understood the calculation and all. And one more ICI question is there. That also you can go and search, okay? I think if you search in internet, you might get it. Rice, wheat, maize, 150 hectares. Costing question. That also is nice. That also you can go and check once. Okay. CA intermediate. You can just click on any of the website which gives this, and you can practice that question once. Okay. I'm unable to recall which one it is. I think it is a RTP question. One of the RTP question of ICAI. I'm unable to recall exactly in which question, particular year's RTP it was there in. But yeah, nice question. Similar question. Next one. Set 2. PV ratio will increase if there is a decrease in fixed cost. PV ratio and fixed cost has nothing to do. There is increase in fixed cost. Again, it has nothing to do. There is a decrease in the selling price. If selling price decreases, margin reduces. Margin reduces, PV ratio will fall, not rise. Decrease in variable cost, yes. Next up. Z Limited is planning to sell 1 lakh units of product A, 12 per unit. Fixed cost is 2,80,000. In order to realize a profit of 2 lakh, what should be the variable cost? Very simple. We are selling, sales will be 12 lakh. Correct? Variable cost, let it be V. Contribution will be 12 lakh minus V. Correct? Minus 2 lakh 80,000 fixed cost should give me profit of 2 lakhs. That means 12 lakh minus V should give me 4,80,000 total contribution. So minus V I will bring this side. This one will become 7,20,000 B. A firm has a fixed expense of 90,000. Sales is 3 lakh. Profit is 60,000. PV ratio is how much? Very simple. Sales is there, 3 lakh. You don't know variable cost. Contribution also you don't know. But fixed cost, 90,000. Correct? Profit is 60,000. From some contribution, you reduced 90,000, you got 60,000. That means contribution was 150,000. Contribution by sales into 100 is PV ratio, 50%. Next up. Sixth. 14 marks. Okay. The management is considering to close down the division C. There is no possibility of reducing the fixed cost. Analyze whether or not division C should be closed down. Try to understand. They got 3 division. Each of them will make a different product. The budgeted data for the coming year is as follows. Division A, division B, division C. Okay. Total cost are 61,60,000. Sales is 1,12,000. Division A is giving us a profit. Division B, 35,000 is cost, 56,000 is profit. Sales. So profit only it is. It is giving us profit. Division C, cost is 92,400. Sales is 84,000. It is going to give us loss. So if at all there was no shutdown cost, we would have told that, boss, don't produce C. Stop production of C. However, see there very carefully. There is no possibility of reducing fixed cost. 28,000 is there, no? You cannot reduce this. Now, just by carrying out division C, how much loss you are incurring? 84,000 minus 92,400. 8,000? You are incurring a loss of 8,400 by running. If at all you close down, then fixed cost of 28 will be there as it is. No, it will give you a loss of 28,000. So it's better to run the business rather than shut down the business. Hope it is clear. You should compare and write. You can't directly write like this for 4 lines. 4 lines answer is correct only. But yeah, your institute, if they give for 14 marks, they expect you to be like, if division C is closed down, then there is reduction in the overall profit by 19,600. Since there is no possibility of reducing the fixed cost of division C, there is a contribution, it should not be closed down. Okay. This is the thing. Hope it is clear. Next up. June 24. Set 1. Fixed cost is treated as period cost. Then now, contribution is 3 lakh, sales is 15 lakh. Compute PV ratio 20%. 3 lakh by 15 lakh into 100. Six. S Limited furnishes you the following information relating to the first half. Okay. Fixed expense was 45,000 for the half year. Sales value was 150,000. Profit was 30,000. Then find out a PV ratio now quickly. Sales was 150,000. From that we reduced variable cost. That gave us some contribution. From that we reduced 45,000. That gave us profit of 30,000. That means our contribution was 75,000. Correct? Then variable cost was also 75,000. Variable cost was 75,000. Give me a second. Sorry. Yeah, no worries. Thank you. No worries. So variable cost is 75,000, which is 50%. Contribution is 50%. PV ratio is 50%. Correct? During the second half year, company has projected a loss of 10,000. Wow. They're expecting a loss of 10,000. Find out the break-even sales and margin of safety for the 6th month ending. So break-even sales will be very simple. Fixed cost divided by PV ratio 0.5. 90,000. Correct? Margin of safety is how much? Your total sales was 150,000. In that break-even point is 90 means margin of safety should be 60,000. Hope first one is clear. 90,000, 60,000. Expected sales volume for the second half of the year, assuming that PV ratio and fixed demand remains same. What should be the sales? Very simple. Now we know that our loss will be 10,000. Second half, correct? Whereas our fixed cost was 45,000. Correct? No? That means our contribution is 55,000. Contribution is 55,000. Contribution is 55,000, which is 50% of sales. Sorry, 35,000. 35,000. 35,000, which is 50% of sales. Then 100% of sales will be 70,000. 100% of sale will be 70,000. Hope it is clear. Next, the break-even sales and margin of safety for the whole year. Whole year fixed cost will be how much? 45,000 into 2, 90,000. PV ratio is changing. No, that will remain 0.5 only. So break-even sales will be 180,000. Break-even sales will be 180,000. Margin of safety. First half we sold 150,000. Second half we sold 70,000. 220,000. So 220,000 is total sales. In that 180 is break-even. That means 40 is margin of safety. 40,000 is margin of safety. Hope it is clear. Next up. December 24. MCQ. Marginal costing techniques follows behavioral wise classification. Fixed variable. Correct? Next. 7A. A company manufactures scooters and sells it at 5,000. Selling price is 5,000. An increase of 17% in cost of material, 20% in labor cost is anticipated. Increase is so much. The increased cost in relation to the present sales price would cause 25% decrease in the present gross profit per unit. If you remember, this question we have solved in the regular class. Correct? At present, material cost is 50%, wage is 20%, overhead is 30% of cost of sales. Prepare a statement of P&L at present. Calculate the new selling price to produce the same percentage of profit to cost of sales as before. Simple. Listen. Right now I will take. Let me take right now my cost of sales as X. Give me a second now. Okay. COS, let me take it as X. Current profit, let me take it as Y. COS, let me take it as X. Current profit, let me take it as Y. We know that X plus Y is equal to, how much is sales? 5,000, right? X plus Y is equal to 5,000. Got it? Now, X includes 3 elements in it. What are those, sir? Material 50, wages 20, overhead 30. Material, labor, overhead. 0.5x, 0.2x, 0.3x. Okay. Next, what they are telling. Next year, boss, 17% increase in the material cost. So it won't be 0.5. It will be 0.5 plus 17%. 0.585x plus labor, that is 20% will be increase in the cost, that is 0.2x plus 20%. 0.24x. Overhead no change. 0.3x. And calculate the new selling price to produce the same percentage of profit. to cost of sales as before. So because of this, what they are trying to tell, listen here, because of this, the increased cost in relation to the present sales price would cause 25% decrease in the amount of present gross profit. That will cause us 0.75y. Right now, whatever the profit we are making, no, of that 25% will fall. That will give us present selling price of 5,000. Now you have two equation. How much is this total, Justin? Plus 0.24 plus 0.3. 1.125x plus 0.75y is equal to 5,000. Next one, x plus y is equal to 5,000. Now if you solve this, multiply this one with 1.125, it will be 1.125x plus 0.75y is equal to 5,000. This will be 1.125x plus 1.125y is equal to 5,000 plus 1.125 into 1.25. 5,625. X will get cancelled. Here how much it is? 0.375. Yeah? Y is equal to 625. How much is Y?
1,666.567.
So profit right now is 1,666.67. Using that, we'll find out cost. So now adjustment will be done. Hope you understood how to find out using this. Profit is 1,666. Cost will become 3,333. Now as per new one, to achieve the same profit, same percentage, because last time sales was 5,000, our cost was 333, profit was 1,667, which means it is as good as 50%. So same, to achieve the same 50% on this, how much should be the selling price is the question. Simple. Hope it's clear. Next one. Set 2 MCQ. The difference between absorption costing and marginal costing is regarding the treatment of fixed overhead. When the sales and production are same, then profit under marginal and profit will be equal. Marginal and absorption will be equal. Because the profit changes only because of the inventory. Now inventory only is not there, then obviously it is same. PV ratio will increase if there is a decrease in variable cost. Same question we discussed already. If the sales are 150,000 variable, 1 lakh contribution is 1 lakh divided by 1,50,000, 66.67. That also we have discussed. Next. 6. In this paper. This Maxwell already we have discussed in study material, if you remember. Absorption. So always remember fixed overhead to be absorbed. Here periodic it is 160,000. So 40,000 is the actual overhead. But absorbed will be how much? 160,000. We thought of recovering it from 800 units, which means 2,000 units. Sorry, 2,000 rupees per unit. But we are producing 220 units in that quarter. So we will recover 44,000. So we will over absorb 4,000. That question, I don't think so. We have to solve it again. Next. June 25, right? No MCQ. Seriously. 7. 7A. This is again that sales mix what we have studied already in the study material sum. You remember, no? Next. The technique of differential cost is adopted when to make choice between two or more alternative course of action. The differential cost means additional cost what we are going to incur. Next, 7 now. This heavy demand one also we have already discussed if you remember in the study material. Study material question only. So always remember, if at all demand is more, then go for the one with the lower variable cost. Because after reaching that heavy demand, fixed cost is anyhow taken care. So additional cost what you are going to incur is only variable cost. So try to keep it as low as possible. But if you are arriving at a lower cost, then variable cost anyhow it will be restricted. Charan spotting questions faster than go to Naha. So where were we? If it is lower, anyhow variable cost along with the units, variable cost will decrease, but fixed cost will remain same. So choose one with the lower fixed cost. So always remember, if the units demands are more, choose one alternative with the lower variable cost. If the units demand are less, choose one with the lower fixed cost. Next. Contribution is 3 lakh, sales is 15 lakh, PV ratio is 20%. 3 lakh divided by 15 lakh into 100. If sales are 90,000, variable cost is 75% to sales. Contribution will be 25%. 90,000 into 25%. Next. 6A and B now. The sports material manufacturing company budgeted the following data for the coming year. Sales 1 lakh, variable cost 40,000, fixed cost 50,000. Calculate PV ratio. PV ratio is very simple. Contribution is 60,000 divided by 1 lakh into 100, which will come to 60%. Break even point 50,000 divided by PV ratio. 83,333. Margin of safety 16,667. Evaluate the effect of the 20% increase in physical sales volume. So if at all 20% increase in physical sales volume happens, then we will be selling 1,20,000 units per rupees 1 per unit. So which will come to 1,20,000. Variable cost 0.4 per unit. 0.4 into 1,20,000. 48,000. Contribution will be 72,000. Fixed cost will be 50,000. Profit will be 22,000. Next, 5% decrease in variable cost. So sales will be 1 lakh. Variable cost 5% decrease in it. 38,000. Unit is not changing. Contribution is 62,000. So contribution minus fixed cost of 50,000, which will come to 12,000 profit. 10% decrease in fixed cost. If that is the case, contribution of 60,000 will remain same as it is. 10% decrease. So 10% decrease means it will become 45,000. So profit will become, 10% decrease, no? Oh, increase. Sorry, 55. Profit will be 5,000. Next, 5,000 variable cost decrease accompanied by 15,000 increase in fixed cost. So sales will be 1 lakh. It will become 35,000. Contribution will become 65,000. And 15,000 will be, 65,000 will be fixed cost, 0. Okay. I mean, for each and everything, you should find out that PV ratio, BEP, margin of safety, everything. Okay. Next. 6B. Last question now. 6B. Oh, 6B in that only. This is that study material question. Total sales potential in unit is limited. Which is better? Then whichever gives me contribution per unit, that is better. Right? So which gives me contribution per unit more? Material cost, wages, expense. 10 plus 15 plus 5. 30. And 15 rupees is overhead expense. How much it is? 45, no? Here it is 10 plus 15 plus 31 plus 20 variable overhead. 51, right? So here first one contribution per unit will be how much? 100 minus 45, 55. 120 minus 51, 69. Contribution per unit is 55 and 69. So in this scenario, B is better. Correct? In value, it is restricted, it seems. That means try to find out per rupee of sale how much we will be able to make. 55 divided by 100, 0.55. 120, 69 divided by 120. Divided by 120. 0.575. Then again B is better. Raw material is in short supply. So material, here we use 2 kg, here we use 3 kg. So 55 by 2. Per kg we are getting 27.5. 69 divided by 3. 23. So here A is better. Production capacity in terms of machine hour is limited. 55 divided by 3. 3 hours we are using for 1 unit. 18.33. 69 divided by 2. A is better. Oh, sorry, B is better. Hope it's clear. This is same like what we have done in study material. Next one. MCQ 11. ASA Limited manufactures a particular fountain pen called incurring a variable cost of 30. Fixed cost is 20,000. If it produces and product is sold at 50 rupees, then break even will be how much? 20,000 divided by 20 rupees is a contribution. 10,000 units. Next up. Sells product at 20,000, variable cost is 12 rupees, which means contribution per unit is 8. Sold 2,000 units. It has incurred 5,000 fixed cost. Determine the value of break even. 5,000 divided by 8. Wait. Amount they are asking, no? So how much is the contribution? 8 by 20%. Contribution percentage 40%, right? 5,000 divided by 40%. Option B. In amount. Okay. Value of break even they are asking. Next one. 6A na? 6A and B. This one I told you, if you remember. 2 sales they have given. Profit they have given. Using that you can find out PV ratio. That is change in profit 20,000 divided by change in sales 1 lakh. PV ratio is 20%. What they are asking, what would be the probable trading result if the sale is 180,000? Then contribution will be how much? 180,000 into 20%. 36,000. Yes. Using either this or this, we can find out fixed cost. Let's use 2 lakh and find out. 2 lakh into 20%, 40,000 was fixed cost. Sorry, contribution. From that some fixed cost we reduced, profit came to 20,000. That means fixed cost was also 20,000. Hope you understood. Now 36,000 minus 20,000. 16,000 will be profit. What amount of sales would yield a profit of 50,000? Try to understand. My contribution should be how much? Fixed cost of 20,000 to be recovered, profit of 50,000 to be recovered. My contribution required is 70,000. So that is 20% because 80% is variable cost. 100% is question mark. 3,50,000. Simple question. Hope it is clear. This is also ICA material question only, if you remember. Sorry, not ICA. Institute material, ICMA. Mr. Young has 1,50,000 investment in his business. Crazy. He wants a profit of 15% on his money, which means how much you want? 22,500 profit he wants in his money. Correct? From the analysis of the recent figures, he find that his variable cost of operating is 60% of sales. That means PV ratio is 40%. Fixed cost is 75,000. Correct? What sales volume must be obtained to obtain break even? 75,000 divided by 0.4. 1,87,500. What sales volume must be obtained to get that 15% return? Try to understand. We have to recover, or I will write in the normal, the way what we used to do only, table only. Fine, now. Let the sales be X. Contribution will be how much? 0.4x. Correct? From that, if we reduce fixed cost, 75,000, we should get a profit of 22,500. So, how much is 97,500 divided by 0.4? Sales volume to obtain 15% return on investment is 2,43,750. Hope it is clear. Next, Mr. Young estimates that even if he closed the doors of his business, he would incur 25,000 as a expense, which means shutdown cost. At what sales would he better lock off his sales up? Basically, he should lock his business up whenever his loss goes beyond 25,000. Correct? So, let the sales be X. Contribution will be 0.4x minus 75,000. That should give me loss of 25,000. At that point, whether I run the business, whether I close the business, doesn't matter. That is 1 lakh divided by 0.4. Oh, wait, not 1 lakh. 0.4x minus 75,000 is equal to minus 25,000. 0.4x is equal to 50,000. X is equal to 1 lakh. That is, if my sales is 1,25,000, I end up making no difference of losses if I run or if I close. However, if at all my sales is more than 125,000, run the business. Less than 125,000, close the business. Hope it's clear. With him closing the business, if at all sales are less than 125,000, we are closing our marathon discussion. Yes. Hope it was of some use. Yes. And I assume you guys learned something. Yes. So revise it well. As I already told you, your whole group will be depending upon this paper, where you can get a very good marks. Yes. So we'll meet you guys in finals or MA, Management Accounting. So had fun now. Let's meet in MA. Done. Okay. Fine. So study well. Don't waste your time. Hardly few days are remaining. Yes. Practice well. But allow iPad to class. No way. You should write in books, notebooks. Why you want to write in iPad? You bring iPad. You see the question in that. But answer should be taken like in the notebooks only. Because in examination, they don't allow iPad to write. Fine. Bye. If at all you guys are watching in YouTube, please subscribe, like, what else? Bell icon. Rough in notes, fair in iPad. In examination, you will write rough only, no? Fine. We'll see you guys. Bye. Study well.